The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
All right, good morning, everyone. My name is Mark Manuzak, and I'm an associate director in the payments division here at the board. And we have another full day in front of us, so I think it's time we get started. So opening the second day of our conference is Michael Barr, the vice chair for supervision here at the board. Vice Chair Barr took office at the board last year from the University of Michigan, where he's held a number of academic positions over the last 2 decades. Among other positions in his career, he served key roles in both the Clinton and Obama administrations. Please join me in welcoming Vice Chair Barr to the podium.
Thanks, Mark. It's really a pleasure to be here. One of the downsides of being here, however, is I got to look at the agenda and realize that I couldn't stay and listen to any of the papers. It looks like just an extraordinary conference, a great group of papers and discussants, and I'm sure your first day was really interesting, and today looks very interesting as well. So I'm really grateful for the opportunity to be able to welcome you for the second day of this conference. This is obviously a time of great change and great promise for the payment system. The Federal Reserve plays multiple roles in the payment system, including as a supervisor of banks and financial market utilities, and as an operator of some key components of payments infrastructure. The research done by experts, including those in this room, is vital in helping us to understand what works well in the payment system and what can be done to improve it. We introduced the FedNow service in July to facilitate secure and convenient instant payments. We developed FedNow in response to a growing demand for instant payments from both households and businesses. 100 years ago, the Fed facilitated payments by moving checks across the country by train. FedNow represents new rails by which payments can keep pace with today's businesses and consumers. The Federal Reserve has now made these rails available. Banks can build on this infrastructure to provide better services for households and businesses. It's hard to speak about payments innovation without mentioning the increased experimentation with new payments technologies, such as stablecoins and central bank digital currencies, happening in the private and public sectors, both in the United States and around the world. As this work proceeds, we must carefully weigh the benefits and risks of different uses of these new technologies. Stablecoins, as I have said in other remarks, need to be well regulated. When an asset is pegged to a government-issued currency, it's a form of private money. When that asset is also used as a means of payment and a store of value, it borrows the trust of the central bank. So the Federal Reserve has a strong interest in ensuring that any stablecoin offering operate within an appropriate federal prudential oversight framework, so they do not threaten financial stability or payment system integrity. We have also provided guidance to the banks that we supervise on how they should engage with their supervisors when considering use of these products. In terms of central bank digital currencies, we continue to speak to a broad range of stakeholders and to conduct basic research in emerging technologies that might support a CBDC payments backbone or for other purposes in the existing payment system. Our research is currently focused on end-to-end system architecture, such as how ledgers that record ownership of and transactions in digital assets are maintained, secured, and verified, as well as tokenization and custody models. This research helps us to consider how we could design a digital analog to the paper banknote that permits a transfer of value between two parties without direct facilitation by the issuing central bank. It is important to note, however, that while the Federal Reserve supports further research and continued engagement with a broad range of stakeholders, the Fed has made no decision on issuing a CBDC. And as Chair Powell has emphasized, we would only proceed with clear support from the executive branch and authorizing legislation from Congress. With this in mind, learning from both domestic and international experimentation can aid decision makers in understanding how we can best support responsible innovation that safeguards the safety and efficiency of the U.S. payment system. We'll hear more about the results for some of these domestic and international initiatives on CBDCs later today. International collaboration and coordination are often essential in payment systems, as we heard in John Cunliffe's keynote yesterday. In 2020, the G20 governments endorsed a roadmap for enhancing cross-border payments, aimed at making them faster, cheaper, more transparent, and more accessible globally. The Federal Reserve supports and continues to work with the international community on these issues, and I look forward to our ongoing engagement with stakeholders, both public and private, on the path ahead. Closer to home, traditional payment methods are still the backbone of the U.S. payment system, despite the surge in interest in emerging payments technologies. It's important to continue to advance research in both new and older payment methods. Questions on the use of cash and the dynamics among the players in the debit card industry remain worthy of investigation, as is evident in the conference agenda. Earlier this week, the board proposed revisions to the interchange fee cap for debit card issuers as required by law. Public input is a key element of the rulemaking process for the Federal Reserve, and I look forward to reviewing the comments that we will receive on the proposed revisions. I also appreciate the opportunity for Federal Reserve staff to engage with the broader scholarly community on this and other topics, as research is an important component for our consideration of regulatory actions. Engagement with researchers, stakeholders, and the public will help the Federal Reserve continue to support a safe and efficient payment system, which has been part of our mission since the Fed's establishment in 1913. Finally, whether we talk about traditional or emerging payments technologies in the public or private sector, innovation must proceed in a way that respects fundamental principles for serving the public good. Payments innovation should support and promote broad access and financial inclusion. Financial inclusion is affected by many factors, but too often the cost of payment services is prohibitive and represents a barrier that limits access for low and moderate income households and small businesses. I am pleased to see that so many of the topics covered in this conference touch on factors that affect financial inclusion: issues of cost, trust, privacy, and security, among others. In conclusion, I want to thank the organizers for putting together this forum, and I look forward to further engagement. Thank you all for being here and giving us the opportunity to learn from you and from your research. Thank you very much.
All right, thank you very much, Vice Chair Barr. And before we kick off with the presentations, Martin Sumer has an announcement for us.
Good morning. My name is Martin Sumer. I'm the head of the Economic Research Division at the Austrian Central Bank. And I am honored that in this function I can make an announcement that we will host the next Economic of Payments conference. And can you show the slides? We don't see it up here. Okay. So this
Some suspense.
Okay. I want you just to note and save the date. So the conference will take place at September 25th to September 27th. And the venue will be the Austrian Central Bank. You see here a picture of the bank. Initially, this building should be only the printing press of a much larger building that was planned to be the Central Bank of Austria-Hungary, but then this empire disappeared. And this remained and is now the building where we are seated and where the conference will take place. It was, by the way, also for 10 years the headquarters of the US Army in Austria after World War II, where General Clark was sitting. We have a special feature for next year's conference. If you could please show the next slide. We coordinated with some of our research partners in technology and co-host in the same week the AFT, the Conference in Advanced Financial Technology. So if some of you have time to spend a week in Vienna, you might also be interested to see this conference. It's from September 23rd to September 25th. September 25th will be the day in between. We are not yet completely decided whether we will do a joint event or this will just, So this will be a special feature. This year's AFD conference, by the way, is taking place in the same week as Economics of Payment at Princeton University. So with that announcement, thank you very much for giving me the opportunity, and I hope I see many of you next year in Vienna. Thanks a lot.
All right, and with that, we're going to kick off the session on instant payments and their effects. And first up is Sergey Sarkisian from UPenn, and discussed by Joanna Stavins from the Federal Reserve Bank of Boston. Then the second presenter will be Tamanna Singh Dubey from University of Michigan, discussed by Xavier Jean.
Thank you very much for organizing the conference and including my paper. So this is my job market paper. It's about instant payment systems and competition for deposits. Banking industry is highly concentrated in the US and in other large economies. Market power enables large banks to pay low interest rates and still keep their depositors. And one driver of this market power is payment services that large banks offer. It could be credit cards, access to payment apps like Zelle or Venmo. These things make people want to stay with large banks, although small banks pay higher interest rate. Instant payment systems are being developed around the world. We heard a lot about them yesterday. And instant payment systems have low entry costs very often for not just large banks, but also small banks. So they provide more financial inclusion to participants in the economy. Examples include UPI in India, FedNow in the US, and Pix in Brazil. And so in this paper, I ask if instant payment systems can change the way banks compete for deposits. So if they can change banking landscape by providing opportunity for smaller banks to also join the system. So I'm going to exploit natural experiment in exposure to the launch of Pix in Brazil. Pix is an instant payment system that was launched by Central Bank of Brazil in November 2020. It quickly became the preferred way to make retail payments in Brazil. It also attracted attention of most banks in Brazil. So more than 95% of banks by now joined the system. Also fintechs and other non-banks joined the system since then. And so I find that there was a persistent reduction in deposit market concentration following introduction of Pix. Specifically, deposits of small banks increase relative to large banks in areas with more usage of Pix. Let's imagine a municipality with 5 banks of equal size. A $200 increase in per capita Pix transactions would transform this municipality into the one with 6 banks. So deposit markets become less concentrated. So instead of 5 banks, you would have 6 banks. In other words, deposit market concentration declines by 20%. I find that this is not specific to movements between large and small banks. Deposits also become more convenient relative to cash. Many people move from cash to using Pix, and to use Pix you need bank account, so I also find increase in deposits overall. I argue that the results are driven by increased payment and transfer convenience. So before Pix, large banks offer payment services to their customers, such as cashless apps, better credit cards, and many households are ready to forego high interest rate paid by small banks to enjoy payment convenience paid by large banks. After Pix, first, small banks offer a product of similar quality as large banks, and also transfers between banks become cheap. So if you have account at one large bank and one small bank, and both banks join Pix, transferring money between these bank accounts will be free using Pix. So because of that, small banks are able to better compete with large banks in terms of payments and transfers, and they no longer need to pay very high interest rates. So I find that small banks reduce their deposit rates relative to large banks following introduction of Pix. In the second part of the paper, I estimate a deposit demand model to evaluate how much demand for deposits changed and elasticities of deposits changed. So first, I find that there was an increase in small bank deposit demand relative to large banks. So households demand more deposits from small banks than from large banks after introduction of Pix. I also find that deposit demand becomes more sensitive to deposit rates after the launch of Pix. So generally, even if banks change their deposit rates, many households still stay with their bank, so deposits in some sense are sticky. Since Pix reduces switching costs between bank accounts, changing interest rates make households move more between banks. That's why I find that deposit demand becomes more elastic after introduction of Pix. Finally, model allows me to study welfare consequences of introduction of Pix. So I find that average depositor would demand additional $380 to go to the world without PIX. So PIX increases welfare of households through two channels. One, you can move to smaller bank to earn higher interest rate, and second, people like the service. I'll skip the literature. So let me first describe institutional setting, although Lucas did a very good job yesterday. So PIX was launched in November 2020 by the central bank. The primary goal was to allow within-second transfers and payments. PIX requires bank account to be used, and Central Bank of Brazil had a mandate to obligate banks to join the system. So larger banks were required to join. Not just large, but medium-sized banks were also required to join. And then since costs of PIX are shared among banks, for small banks, entry costs were very low. So eventually, PIX was offered by more than 95% of intermediaries, and they joined very quickly along the way. And for the last survey I checked, PIX was used by more than 65% of people in Brazil. PIX is free for banked households. It's also cheap for banks. Although there are no costs published on central bank website on how cheap it is, there are surveys showing that merchants pay around 0.2% to accept PIX as a means of payment, compared to, for example, 2.2% credit card fee or 1% debit card fee in Brazil. Now, let me describe what deposit markets look like in Brazil before PIX. So deposit markets are very concentrated in Brazil. National Herfindahl-Hirschman index is around 0.2, like in the US. So you can think of 5 dominating large banks in Brazil. And so let me describe average large bank and average small bank in Brazil. So average large bank in Brazil would have more regional offices and more ATMs. So if you need quick access to cash, or if you move around the country and you need access to banking services, you'd rather be a client of large bank. Large banks have better online banking apps. They have better credit cards. And so they issue more credit cards than small banks. And finally, this might be a unique feature about Brazil, but not just Brazil. In my home country, it was the same thing. Not all banks offer direct deposits. So a large bank will always offer direct deposit. For a small bank, it might be complicated, and then you would need to get your salary in cash, or you would need to make a wire transfer from large bank to small bank. Without PIX, it's expensive. With PIX, it's free. So large banks offer greater payment convenience to their clients. And that's one reason, not the only reason, but one reason why large banks are able to pay low deposit rates and still keep their customers. And before PIX, transfer and payments in Brazil were not efficient. So there were wait times, up to 3 days for wire transfers. There were fees for transfers. And then merchants were allowed to pass fees that they pay to Visa and MasterCard to their customers. So it's 2.2% credit card fee, 1% debit card fee. With PIX, it even happens that some merchants give discounts. So if you pay in PIX, you will pay 1 or 2% less in price. Brazil is also heavily cash-dependent economy. There is an underground economy. Some estimates show that roughly 20% of Brazilian GDP is an underground economy. An underground economy used to be cash only. They did not accept credit cards, debit cards. Now most of them accept PIX. So it also motivates people who use underground economy on a regular basis to start using PIX and hence open bank accounts. And so in this graph, you can see that PIX, it's a blue line, it increased a lot. Usage of PIX increased a lot. It passed credit cards and debit cards in terms of point-of-sale transactions. By now, I think it also passed cash. This data that I had ends in second quarter of 2022. Okay, so let me describe the data I have. So first, I have municipality-level monthly data on PIX transactions. So municipality in Brazil is analogous to county in the United States. So there are more than 5,000 municipalities. And so for each of them, I have data on value and number of transactions done in PIX in a month. I also have branch-level data on banks' balance sheets. So I observe deposits by types. I observe loans, wholesale funds, some alternative funds. And I have bank-level data on interest rates. And so I will use this data to analyze how PIX impacted deposit market concentration. So before I jump into the identified results, let me show what we see in the panel data. So first, I'm going to see how does PIX impact deposits of small banks. So I'm going to regress deposits of bank I in municipality M at month T on value of PIX transactions in municipality M at time t interacted with a dummy for small bank. I'm also going to include various fixed effects and control variables. And I'm going to look at the 6-month window around introduction of PICs, so 3 months before, 3 months after. And second, I'm going to see what happens to interest rates. So I'm going to regress deposit rates of bank I at time t on value of PICs transactions of municipality M at time t, again interacted with dummy for small bank. So first, we can see that more usage of PICs is associated with more deposits of smaller banks. So for example, if municipality B has 1 standard deviation more PICs usage than municipality A, small bank deposits will be 3% larger in that municipality. I also see similar effects for saving and time deposits in Brazil. And since small banks get this inflow of deposits, they're able to reduce their deposit rates. So I see that deposit rates of small banks decline approximately by 14 basis points following 1 standard deviation increase in usage of PICs. So the panel results I show, of course, have identification issues. This was all happening during COVID. There could be potential confounders. Also, you can think, for example, about omitted variables. Political beliefs, for example. Conservative people might not want to use PICs. Also, they might be willing to use the regional bank in their municipality. So we might have identification issues. So to address this, I'm going to use relaxation of COVID-19 restrictions in Brazilian municipalities by September 2020. So there was a survey conducted after the first wave of COVID when many municipalities relaxed COVID restrictions. Mayors of municipalities were asked if they relaxed COVID restrictions or if they kept them in place. So I'm going to call municipalities that relaxed COVID restrictions by September 2020 treated municipalities. And I will call the ones that kept COVID restrictions in place control municipalities. I will describe my conditions in detail, but let me debrief. Relevance condition assumes here that areas without COVID restrictions use more PICs. So think about it this way. When area relaxes COVID restrictions, economic activity increases, people spend more, they can travel, they can go to parties, and people will use more PICs because PICs is used for in-person transactions. Exclusion restriction says that the only way easing of COVID-19 restrictions by September can impact deposit markets 2 months later, in November, is through PICs. So let me describe this in detail. So I'm going to plot here first relevance condition and then exclusion restriction. So I'm plotting here PICs transactions. The upper graph will be control group, so group where COVID restrictions stayed in place. And the second line will be treatment group, where COVID restrictions were relaxed. So COVID restrictions were relaxed by September 2020. And then nothing happened in October, and then in November, PICs was introduced. So PICs doesn't exist in August, doesn't exist in September, doesn't exist in October, and then when PICs is introduced, I'm assuming that PICs take-up was higher in areas with, that relaxed COVID restrictions. And the idea is that economic activity is higher in these areas, and people use PICs more, and this is something I see in my first stage regression. I see that PICs usage was higher in areas that relaxed COVID restrictions. Now, in exclusion restriction, let me plot deposit concentration, or we can think about your favorite measure. For example, we can think of deposit of small banks relative to large banks. Nothing happens in August. Now, COVID restrictions are in place in control group, so this blue line stays same. In treatment group, COVID restrictions were relaxed. And so let's assume that relaxation of COVID-19 restrictions has a direct impact on deposit concentration. And to make my life harder, let's assume that there is a decline in deposit concentration. Now, my key assumption is that once there was a direct impact, nothing happens in October. So in October, trends are parallel. So there is no delayed impact of easing of COVID-19 restrictions on deposits of small banks. And then in November, deposit concentration changes again. Why? Because PICs was introduced. So what could violate my identifying assumptions is that if relaxation of COVID-19 restriction has a delayed impact on COVID. For example, restrictions are relaxed, and then 2 months later, I decide to move to small banks from a large bank for reasons unrelated to PICs. Okay, so with these assumptions in mind, I'm going to show you second stage results. So again, I'm regressing deposits of bank I, municipality M at time t, on value of PICs transactions. And value of PICs transactions will be instrumented by the dummy variable, which is equal to 1 for areas that relax COVID restrictions and 0 for areas that did not relax COVID restrictions. And you can see that one standard deviation increase in value of PIX transactions, which is in my sample approximately 100%, so doubling of PIX transactions, leads to 3.3% increase in checking deposits of small banks relative to large banks. I also see increase in time deposits and also increase in loans. So small banks, when they get this money, they lend it out. Now let's plot something that gives more meaningful magnitudes. So I'm going to regress Herfindahl-Hirschman index on per capita PIX transactions for interpretation purposes. And first of all, you can see that there is no pre-trend. So there was no effect on Herfindahl-Hirschman index in areas that relaxed COVID restrictions before introduction of PIX. There's a little bit of decline when restrictions were eased. But then after PIX, the effects are significant and negative. So deposit concentration indeed declines in Brazil. And so to interpret this, think about a hypothetical municipality with 5 banks of equal size. In Brazilian terms, think that you have top 5 banks. Now, $200 increase in per capita PIX transactions, if average person uses $200 more in PIX, this will create additional bank. So instead of 5 banks, you will have 6 banks. And we heard some anecdotal evidence about it. There is a fintech in Brazil, Nubank, which advertises PIX a lot. And Nubank now is becoming a very large bank in Brazil. So people don't just discuss top 5 in Brazil, they also talk about this Nubank. This is just anecdotal evidence, but it confirms that there are new players in the market that did not exist before introduction of PIX. This doesn't have to be unique to reallocation from large banks to small banks. Another thing that PIX did, it made digital payments more convenient relative to cash. If before PIX, people had to use credit cards or debit cards for these transactions, and some people were unbanked, some people didn't have access to credit cards, PIX gives access to many people. So to use PIX, you need bank account. That's why I find that there was an increase in deposits overall. So not just increase in small bank deposits, but also increase on all deposits. So one standard deviation increase in value of PIX transactions would increase checking deposits by 3.7%. So to sum up, what we see is increase in both large and small bank deposits, but more increase in small bank deposits. Now let me discuss channels a little bit. So first of all, can this be supply driven? So can it be that small banks increase supply of deposits? This is unlikely. Why? Because we saw that deposit rates of small banks fall. So if deposit rates fall, it means that should be increase in demand. So small banks are able to reduce their deposit rates precisely because they got this new inflow of deposits. Now let me show a piece of evidence that is consistent with PIX making deposits of small banks more convenient, and generally deposits more convenient relative to cash. So despite the fact that small banks might become more convenient after introduction of PIX, there are still switching costs. You still need to go physically and open your bank account and pay fees. And so the switching costs are less relevant for richer households. Also, richer households have additional money to open second bank account for people who open 2 bank accounts. So I'm assuming, I'm conjecturing, and I will show that increase in small bank deposits is stronger in richer areas. Now, increase in large banks should be stronger in poorer areas. Why? So this was happening during COVID. And during COVID, there were stimulus checks paid to households. And most of them went to 2 banks that are in my sample of large banks. Those are Banco do Brasil and Caixa. They're both in my sample of large banks. And these banks process most of the stimulus payments. And so if you're a poor household and you really depend on these payments, you'd open an account at a large bank, not at a small bank. And so first of all, I see that increase in small bank deposits is more prevalent in richer areas. So in areas where average household is richer, I see that checking deposits increase more, saving deposits increase more, and especially time deposits. For time deposits, you need to lock your money for some time. So if you're poor, you don't have money for the savings, this will be less relevant for you. And I do see that increase in large bank deposits is more prevalent in poorer areas. And because these people really depend on this stimulus payment that are provided by large banks. So large banks still offer a lot of convenience to poorer people relative to richer people. Okay, so what I showed so far, I showed that there is an increase in deposits of small banks relative to large banks, and I argued that this is a demand-driven. So let's go ahead and estimate deposit demand. Let's see how much deposit demand changes after introduction of PIX. Also, it's interesting if PIX changes sensitivity of deposit demand. So can large banks still keep their rates unchanged, or will households actually move to other banks if interest rates change? So to do this, I'm going to estimate a deposit demand model borrowed from industrial organizations literature. And the model will eventually allow me to study some welfare consequences. Take this with a grain of salt. This is partial equilibrium model, but we can still make some preliminary welfare points. So I'm going to ask, how much are depositors ready to pay to have peaks? Or in other words, how much would depositors want to get now to go to the world without peaks? So there will be mass WT of households, and each household will choose to invest $1 to one out of J banks or cash. So each household can invest only one bank and only $1. And they can also invest in cash. This will be an outside option of the model. All banks in the model offer instant payment systems starting from November 2020. And I made sure that all banks in my estimation sample actually joined PICS. And I will again split banks into large and small, the same way I did in reduced form. And by the way, my results are robust to the different definitions of large and small banks. And so utility of household I from investing their $1 in bank J at time t depends on deposit rates paid by bank J, depends on if bank J has locations in areas where PICS is used. So if I want to use PICS, I want my bank to have locations in these areas. So that's a variable PJ. And then I also interact deposit rates with PICS variable. So I do this to understand if existence of PICS changes elasticity of deposit demand. Because PICS exists, people want to move more between bank accounts. And finally, I interact PICS variable with dummy for small bank. I want to see if existence of PICS makes deposit demand for small banks larger than deposit demand of large banks. I also include control variables, bank and time fixed effects, and I make standard assumptions that are made in this literature. So households will choose the bank that gives them highest utility. So this is simple. Each household will choose just one bank or cash that give them highest utility. And since for each household I know which bank they chose, I can calculate deposit shares of each bank. If I know deposit share from the model, and I know deposit shares in the data, I can estimate the model using GMM. So this model has identification concerns. Specifically, we're going to estimate deposit demand. So we're going to, in simple words, regress deposit shares on interest rates. But this is endogenous. It's true that interest rates impact deposit demand. It's also true that deposit values impact interest rates. So I'm going to use instruments for interest rates. I'm going to use fixed cost of assets and provision for loan losses as instruments. So I'm going to call these instruments supply shifters, and let me describe why. So fixed cost of assets, think about them as how much it costs to rent a building for bank. And then loan loss provision, how much money banks expect to lose in a year. So relevance condition tells us that these variables impact banks' decision about interest rates. So if it's expensive for me to rent a building, or if I expect to lose a lot of money on loans, I will likely want to pay lower deposit rate that year. Then exclusion restriction tells us that the supply shifters do not affect unobserved deposit demand. So when I choose to open bank account, conditional on all interest rates and everything I can control in the model, I don't care about fixed cost of assets or about loan loss provision. So this will be exclusion restriction. And so by doing this, I'm estimating the model. And let me describe key parameters of the model. You can check other estimates in the paper. So first of all, deposit demand increases when interest rates go up, which they should. But then the sensitivity becomes stronger with PICS. So after PICS is introduced, interest rates become more significant component of the demand. So households care more about how much their bank cares. And this comes from the fact that households stop caring as much about other things, about like payment services. So now if bank B pays me higher deposit rate, and I know that transferring money between bank A and bank B is free, I can go to bank B, I can open deposit account at bank B, earn high interest at bank B, and then if I need some services from bank A, I can still keep that account, and I can move money in between. And also I see that deposit demand of small banks increases relative to deposit demand of large banks. Specifically, 1 standard deviation increase in PIC's value will lead to 40% increase in small bank deposit shares relative to large banks. Okay, and the final part of the paper, so the model allows me to study welfare. Again, take this with a grain of salt because this is partial equilibrium model. So small banks decrease rates. So you can think that clients of small banks actually don't like that PICS was created because now they earn lower interest. But PICS also makes switching easier, and PICS makes deposits of small banks more convenient. So people who were previously with large banks, they will end up earning higher interest rate because they can move to small banks. So the question I'm asking, do depositors benefit from PICS? And so I calculate welfare by considering the following counterfactual. I consider the world without PICS. So everything else stays constant, but let's say there is no PICS. PICS was not created. And so what I find is that, so these are on the y-axis are dollar values. They show how much average depositor would want to get to go to the world without PICS. And I find that it's around $380, US dollars. So this is converted to US dollars. So if now I'm asked to move to the world without PICS, which means potentially going back to my large banks, earning lower interest, and also not benefiting from the existence of this payment service, I would want $380 on my deposit account. So this is for average depositor. So this change is quite sizable, and it shows that PICS eventually increases welfare. And so let me use last couple minutes to conclude. So I show in this paper that instant payment systems can increase competition for bank deposits. And this is relevant because payment systems are developing in many countries. It's very interesting to see what happens to banks in the US after introduction of FedNow. So I'm sure there will be more papers written in this area. So since instant payment systems can increase competition for deposits, this has direct relevance for monetary authorities, for example. We think that increase in deposits of small banks, reduction in interest rates, all shows us that market power of large banks declines. It must have implications for monetary policy transmission. So those are questions that we can later study. Also, we see that PICS in Brazil leads to increase in deposits and also reduction in bank interest rates. So there is a room for having a more advanced model of consumers and see what happens to welfare in this world. Thank you so much. I look forward to the discussion.
Great, thank you very much. Try to speak to the microphone. Thank you so much for inviting me. Great conference, very interesting paper. And again, thank you for Elena for pulling this all together in such a short time. I think it's a record for among the economics of payments organizer. So I work for the Boston Fed, therefore the usual disclaimer applies. These are my views and not those of the system. My comments are going to be fairly brief because I want to make sure to leave some room for discussion. I think this is a topic that we're all interested in, and there's so much in the paper, and everybody can sort of relate to some aspects of it. So the summary is that large banks have an advantage over small banks because they have more branches, they have mobile apps that allow people to do all kinds of transactions, and they allow direct deposit of income, which in case of Brazil is particularly important, as we learned from the paper. But then there's adoption of PICS by all banks, including small banks, and that kind of equalized the banks and made small banks more attractive to depositors. And so as a result, there was a redistribution of deposits from large banks to small banks, lower market concentration, and increased consumer welfare. So the main sort of takeaway for me from the paper is the contrast between PICS and instant payment in the US. I mean, we've been talking about FedNow, and we're all interested and excited about it, but what a success story. I mean, I think possibly the most successful instant payment system in the world right now. So even though in the US we have 2 instant payment systems, not just one, we have RTP and now FedNow, we can only dream of that kind of success. The market penetration is just astounding. Almost all banks, I think 95% is what Sergey said, and the vast majority of consumers have adopted and used Pix in a very, very short time, and I think still growing as far as we can tell. The optimist in me sort of focuses on the fact that we have many similarities in the banking system, between the banking system in Brazil and the US. So over 90% of consumers have bank accounts in both countries. There are few large banks and many small banks. I think in Brazil, it's even more of a bimodal distribution, so the small banks are really separate from large banks. But in any case, those are certainly similarities between the 2 countries. And large banks in both countries have many branches. They offer more services, but pay lower rates, which I think is true in the US as well. One of the differences is that cash is more common than cards in Brazil. So cash is very much alive in the US, but I think in terms of the share of transactions, it's lower than it is Brazil. So it's possible there was more sort of room and need, and I think some people, including some conversations I've had with people in this meeting, are not necessarily convinced that we need instant payments in the US, but it seems like in Brazil there was more need for it because of higher share of cash. But in any case, I think there's hope for the US, and hopefully we'll follow in Brazil's footsteps and grow our instant payment market now that we have it. So one question I had is to what extent there is causation versus correlation. And again, I'm just trying to be nitpicky because I think that Sergey did a great job in the paper, but some of the questions that occurred to me here is that the free transfers from direct deposit accounts where it seems to me crucial in the sort of growth of Pix, because employers require their employees to have direct deposit accounts, and only large banks are a small fraction of small banks offer, but it's really only large banks that offer it. So maybe if free transfers were introduced anyway, small banks would become more popular as well. And then you mentioned no need for credit card approval in the paper. I don't think you talked about it today, but there was something in the paper that seemed to have helped small banks at the same time. And then COVID-19 stimulus payments. Consumers who are receiving stimulus payments were required to open bank accounts. And I understand that there is this 2-month gap or maybe a few months gap, but it's very possible that the consumers who were previously on banks might have preferred to open an account at a small bank anyway, so that might have given small banks an advantage. So, it's possible that small banks might have gained deposits and market concentration might have declined even without Pix. So just to be skeptical about it. And then, obviously we can't ignore all the regulatory requirements that, occurred in Brazil that might not have taken place in the US or in other countries. So one of them is implementation cost. Large and medium banks are required to join Pix. I mean, that's certainly not the case in the US. And, we're trying to encourage them or, promote it, but that's a very different thing. And then you mentioned that the cost of Pix is shared among all banks. So it seems to me that large banks cross-subsidize entry by small banks. User costs are also, seems to me, subsidized. Pix is required to be free for consumers. I mean, somebody has to bear those costs. And the cost to merchants, this is from another study, it's slightly different from your numbers, but essentially the cost to merchants is much lower compared to other payment methods, even debit and certainly credit. And then there is standardization, user interface and experience are standardized. So it's very easy for users to switch between providers. So all those things, obviously Pix is a great thing. I'm not disputing that, but without all these requirements, would banks join? And I think it's safe to assume they wouldn't join at the same rate of speed, and consumers would probably not adopt it as quickly. So I know you're not focusing on the policy side of it, but it just can't help to wonder, is there a sufficient argument here for an intervention? You mentioned welfare effects, but you don't talk about the cost side. So, some benefit cost analysis of the intervention would be helpful. We know that there are gains, but we're not really sure about the cost side. So we know there was a redistribution of deposits across banks, and small banks gained deposit. It seems to me from the paper, and again, I must have missed some of it, but I might have missed some of it, that there wasn't an absolute growth necessarily in deposit, although you did mention that large banks gained as well. So I was wondering if there are any gains for unbanked or underbanked consumers. You have to have a bank account to have PICs, and so, the 90% of people had a bank account already, but what happened to the remaining 10%? And also people who had a bank account, what was the sort of welfare effect on them in particular? And then I was wondering if there was a shift in deposit just within local markets, or did consumers, move their deposit and open account in areas where PICs was offered? Because I don't think it was uniformly introduced throughout geographically. And also, if small banks lowered their rates of deposits, I'm not sure why consumers switched. I mean, what is the advantage of opening an account with a small bank rather than a large? Large banks still offers a lot more services than small banks, right? So all have PICs. You have, direct deposits of income. You have lots of other services, mobile apps, all that stuff. And proximity to a bank becomes less and less important if you adopt electronic payments. So I'm not sure why. So just a little more, explanation of that would be helpful. And switching banks is costly. You did talk about it a little bit, but still, I mean, I was thinking my own case. I have an account with Bank of America, which pays 0 interest rates, but I have so many automatic payment that, the idea of switching bank accounts is just a pain in the neck. So I keep postponing it and ignoring it, sort of. So anyway, I was just not convinced that people would switch, especially that everybody offers PICs. So I understand that PICs is great, but you can get it anywhere. And so another, sort of benefit cost kind of exercise would be how to measure the cost of opening a bank account, switching, transferring your potentially direct deposit or bill payments, just for increased convenience of a small bank, especially if you don't have to go there in person. And then my next comment is sort of about measuring PICs use. So you measure in terms of number or value of transactions. But that could rise because of growth in transactions in general, or it could be just a shift from other payment methods. And so the implications will be different depending on which is sort of stronger. And so maybe measuring it as a share of transactions would be helpful to whatever extent you have data on card use in particular, ideally also cash. So for example, you mentioned that spending increased after COVID restrictions were lifted. But that would probably affect all transactions, not just PICs. So just because PICs grew doesn't necessarily mean that PICs gained an advantage. It might have been sort of a coincidence. So anyway, if you have at least card transactions, and you can maybe measure market concentration as a function of card transactions as opposed to just PICs, that would be helpful and interesting. And everything you measure is on the municipality level, so that obviously introduces all kinds of questions. So one of my questions is, how does an increase in PICs in other banks in a municipality affect individual banks' deposits? So maybe I missed it in the paper. It wasn't clear, to what extent there are these network effects there. So maybe you could explain that a little more. And again, did all banks introduce PICs at the same time? Because if not, then I could see why people would move their deposits. But otherwise, I would just stay put personally. So this is sort of related to my previous comment. How homogeneous are the municipalities? And is looking at averages per person meaningful? So this is a municipality I'm more familiar with. This is the city of Boston. It's a map of the city of Boston, which is kind of weird because Boston goes in different places, and it's broken down by zip code. It's a very small municipality. I mean, Boston is a small city by US standards and probably by Brazilian standards as well. But you can just see that within this one small city, there is a huge heterogeneity in income per capita. So the median annual household income in the poorest zip code is $35,000 a year, and in the richest zip code is $160,000. And this is just one small city. So I know you have a table showing heterogeneity, but I wonder if maybe Brazil is at all similar. Looking at urban municipalities versus rural might be helpful, because maybe rural ones are a little more homogeneous. Just a thought. And a couple of small questions. I think you used 2010 census data. Is that the most recent? Oh, okay. And then a small comment. You have this table with comparing large banks and small banks. It would be helpful to know how many. I think you mentioned there are 5 large banks. I mean, it's probably in the paper, but just looking at the table, it would be helpful to see. And also, it seems to me that there is really this bimodal distribution of banks, and so I'm not sure whether increasing deposits in small banks would even move the needle if they're really so completely separate in terms of the market structure. Anyway, so those are just questions more than any criticism. The paper is great. Whoops, sorry. Should I go back?
Thank you, Yana. We have about 8 minutes for questions, if Sergey is happy taking them. Let's see if I think Scott, was that a hand? All right, Scott, go ahead. Do you want to respond first, or do you want to just go with Q&A?
Let me just take maybe 1 minute to respond
Sure,
to 2 things. So one thing about COVID stimulus. So my understanding was that in Brazil it was paid through 2 large banks, Banco do Brasil and Caixa. So if anything, that would motivate people to move to large banks rather than small banks. So I think, thank you very much for discussion. I think suggestions are great. I will try to do it. And I do think that regulatory requirements are very important. So since US cannot do it, we wouldn't have such a great experiment. That's why I like this Brazil's experiment, that Brazilian central bank could mandate banks to join, and we could see where all banks basically joined the system and they were using the system, so we could see what happens to deposits. And banks joined very quickly. So PIX was announced more than a year before its introduction. So I think within first 2 months, most of banks in my sample joined the system. Yeah. Oh, but another thing, the last thing. So even though small banks reduce their interest rates, they still pay more than large banks. So there are still incentives to move to small banks after introduction of PIX. But I'm happy to take questions. Lucas?
Yeah, very, very interesting. I would just like to pick your brain on some. So basically, the data that you are looking is just branch level data, right? In Brazil, there is this big movement of like digital banks, right? They are growing a lot. Nubank is now one of the largest ones, and they are not in our data set, right? Another thing that's also going on in Brazil is that we also have the traditional banks also open digital accounts. So if the traditional banks, they open like a digital account, what's going to happen is that all the information from the clients is going to be allocated to the headquarters. So I would like to like ask you, how do you think that these factors affect your results there?
So I think the fact that large banks open more digital accounts would actually give even more convenience to large banks. My understanding that many small banks didn't have such access to technologies as large banks. So for example, if you think of some community bank, they couldn't do the same thing. So in my understanding, digitalization would help large banks more than small banks. But I didn't know that thing about Esteban data that I'm using, that they don't include this type of transactions. So let's chat after and see what I can do about it.
No, sorry. Very nice paper, very well executed. When you refer to deposits throughout the presentation, it didn't always really distinguish between the dollar value and the number of accounts.
A dollar value.
Yeah, but you also told some stories about how some people would maybe open a second account. And so I think it would be helpful to talk a little bit more about the distinction between the extensive and intensive margins, because there's costs with each account, right, for the household. And it would be interesting to see what that actually involved. But also, the curious thing would be whether this had an aggregate effect for the whole economy. So if you would show the deposit total for the country, did this result in a higher total level of deposits in bank accounts? Because if they have to have minimum payments in each account to avoid some of those fees, it could actually have an aggregate effect that would be interesting to see.
So number of accounts, I agree, that would be interesting to see. public data doesn't show that. Doesn't show if these are new accounts or existing accounts. But one thing I see that unbanked population declined a little bit. It was 15%. It became 9%, and those are arguably poorer people. So it's unlikely that they would drive this big movement to the small bank. So I think it's both extensive and intensive margin, but potentially more intensive. And total deposits, so I had a graph in this endless appendix, they're increasing. So although we might think about like missing intercept problems, total deposits in Brazil were rising after introduction of PIX. Might not be necessarily driven by PIX, it could be COVID, but they are rising. Yeah.
So Joanna was already made the point that we want to know what payments substituted from when PIX exploded, and along with that, in your welfare analysis, then you want to think about changes in producer surplus to the extent we care about it. Depending on where those transactions came from, producer surplus at banks may have fallen, producer surplus at merchants may have risen. These are very important, policy things to be thinking about.
I agree. Thanks for suggestion.
So, Joanna talked about some of this, but I think just from a technical point of view, looking at the graph should have PIX, it's clear it's not stationary, it's strongly trending up still. Have you considered a specification that doesn't just have time fixed effects, but actually has a time trends in your panel data? Because I'm not entirely sure, you didn't show the other variables, but a little concerned there might be interacting trends going on in a way that affects things.
I can try to do it. I haven't tried.
Yes. Yeah, so I want to follow up on one of Joanna's other points, which is the issue of switching costs. So if you think about who's actually switching to the small banks, if we think about the models that we have on switching and the empirical evidence, it would suggest that people who already have an account are unlikely or are rarely likely to switch their banks. But it's new people coming into the banking system. So it could be that in areas in Brazil where you have more migration, or where the share of the younger population who are opening up accounts for the first time is where you might see more action in people moving to the small banks to open up their first account. So you might look at heterogeneity across regions with respect to migration or demographics.
So I did look at it. Deposits increase more. So generally, PIX usage is more among younger population, although a little bit. It was surprising that even older population uses PIX a lot. But movement to small banks is more prevalent for younger population. The effects are not very strong, but they are there, so I agree with what you're saying.
Hi, very interesting paper. I have a few thoughts. So first of all, when you talk about deposit rates differences between small and large bank, how big of the difference are we looking at? Because we were thinking about regular deposit account, they pay at most a couple of percentage, in interest rates. And so for that difference in interest rates to make a difference, like a household would need to have a sizable amount of deposit, so which means that these are likely to be higher income households. So, you might think that the effects on PIX and people moving more to smaller bank, the benefits are mostly going to accrue to wealthier households and not so much to lower income households.
So if I remember correctly, I should check in the paper, the difference in CDs rates between small and large banks is on average 2-3 percentage points. So it's quite sizable, but we should think that Brazil is also a high interest rate environment.
And with that, we should move to the next paper.
Yeah. Thank you very much.
Hello, good morning, everyone. Thank you for giving me the opportunity to present this work here. This is joint work with Professor Amyatosh Purnanandam. And the main question that we explore in our paper is, can cashless payments have an impact on economic growth? So firstly, why are we interested in exploring this question? As we just saw, recently there is a push towards instant digital payment systems in many economies around the world. And some examples here include FedNow in the US, Pix in Brazil, and the Unified Payments Interface, or the UPI, in India. So an interesting question to ask here is, can means of payment affect economic growth? And this is related to the old question, the old debate that what is the role of money in an economy? So what we believe is that in a world with frictions, such as transaction costs and information asymmetry between payer and payee, digital payments have many advantages over cash payments. And some of them include the lower cost of transactions, reduced cost of screening for potential borrowers and lenders, as well as reduced cost of monitoring for existing lenders. Having said that, and having explored this question, we went to India. The country recently launched its digital payments platform in 2016, and it's called UPI. It helps to facilitate instant, secure bank account to bank account transactions via mobile phones. So there are three reasons why we feel India is an excellent and unique empirical setting to answer and explore this question. The first reason is that most Indians have access to the UPI platform. And to understand this, let's quickly have a look at the architecture of the platform itself. So the UPI platform is owned and operated by a public-private partnership called the National Payments Council of India. It's partly owned by the government and partly owned by the Indian Banking Association, which has all banks of India as its members. It is subsidized by the government of India. And currently, it hosts almost 400 banks in the country and multiple third-party app providers. Now, what these third-party app providers do is that they provide quick and seamless access to customers to use the UPI platform. And the customers can do it simply by scanning a QR code. So on the right, as we can see, some of these third-party app providers are like Google Pay, Amazon Pay, and Phone Pay. And so basically, customers can quickly and seamlessly access, but then this wonderful payments platform where all banks and app providers could seamlessly talk to each other was made possible because of infrastructure that was developed before the launch of UPI. So in 2010, the country launched its Aadhaar card scheme in which all Indians, and we are talking about a country of 1.4 billion population, they received a biometrically enabled unique identity card. In 2014, hundreds of millions of unbanked Indians received access to a bank account, a basic savings bank account. So as a result, by the time UPI came about in 2016, most Indians had an access, and they had the option to use the UPI platform. And this in itself makes it a unique empirical setting. Now, the next reason why we feel this is an important empirical setting is not only did people have an access, they also were, in fact, using UPI. So as you can see on the left-hand side, what I have here is a graph of, in green, which shows the value of transactions per month on the UPI platform. And as of June 2023, we are looking at $180 billion per month. And every time we update our paper, we just add like a couple $1 billion to it. But this is the last time we added, and it's explosive. The growth is explosive. It's not looking to stop anytime soon. In the black, we have the number of transactions happening on the platform, which is currently at 9 billion per month. And lastly, what is the most interesting part of the whole adoption story is the fact that there is a huge geographical variation in adoption of the UPI platform across the country. So what I have here is a heat map, which shows the average per capita transaction amount on UPI across all the 500 districts in India. And as we can see, some districts are darker in color, which have a much higher UPI adoption versus other districts which are lighter. And no one enabler is able to explain the adoption story. So this does not have a one-to-one mapping with number of bank branches or financial development of a district, or availability of internet or smartphones. And that is what makes this setting unique. And we use this heterogeneity in our empirical design. So what do we do in this paper? We try to answer this question, can cashless payments have an impact on economic growth? What we find is yes, they can have an impact on economic growth. And in fact, the reason how they can do it is by increased level of business activity and by increasing household income. The key mechanisms that we have in mind are relaxations of credit constraints and reduction in transaction costs of cash payments. We find that our results are stronger for households that are present in districts that are less financially developed. And by financial development, we go by the traditional measure of number of bank branches per capita in a district. So a quick point here, districts in India are very similar to counties in the US. So whenever I talk about anything that is district level, just imagine it to be county level. So what is the data that we use for our outcome variables? We use a household level survey data, which covers 200,000 unique households starting from 2014. So we have monthly data, and the survey itself is taken 3 times a year. It includes demographic information, employment information, income and expenditure data of these households. For our digital payments data, we use data provided by PhonePe. PhonePe happens to be a third-party application provider on the UPI platform. And they enjoy more than 50% market share, both in terms of value of UPI transactions as well as the volume of UPI transactions. This data is available from 2014. And we also use data from the Reserve Bank of India, firstly to construct our measure of financial development, which is, again, number of bank branches per capita. We also use district quarter level credit data, aggregate credit data provided by the RBI. And that helps us to do a bunch of robustness tests on using credit dispensed in a district as a proxy for economic activity. So let me just show you a bunch of correlations in our baseline model. So what we have as our outcome variables are household income, likelihood of a household to own a business, and the total business income of a household. And my X variable is cashless payments, log of cashless payments in the previous quarter. So what we are essentially looking at is elasticity of income of a household today with the cashless payments in their district in the previous quarter. We use a bunch of fixed effects in our baseline regression. So household fixed effects to soak away any time invariant household characteristics. Year quarter fixed effects to soak away any aggregate shocks in that year quarter. And we also have an interesting urban year quarter fixed effect, which is basically interaction of whether a household resides in an urban area interacted with year quarter dummies. And the reason we do this is to soak away the impact on household income or business income due to any time varying government policies that specifically target rural households in a district. Yeah. So, okay. So now, if you look at the elasticity numbers, the beta values themselves, we see that we have positive correlation between income to lagged cashless payments. And one way to think about it is that, because these are log numbers, so one way to think about it is that if cashless payments in a district double today, in the next quarter, the household income goes up by 6%. We find that our results in the baseline model are stronger for households that are situated in districts that are less financially developed. So basically, less number of bank branches per capita. We also find an interesting result in which we see increased borrowing for business purposes, increased borrowing from banks, and reduction in borrowing from informal sources. So informal sources include money lenders, friends and family, and money lenders in India are extremely predatory. So the loans can be as high as 50% interest rate. And we see a reduction in that and an increase in banks, which we also feel is a good impact on economic growth. So after having looked at all these correlations, Let's go for causality. So we test for causality using two complementary identification strategies. The first strategy is based on the lead bank system in India. So all banks in India in 1969 were nationalized. Suddenly, whether you were a public sector bank or a private bank, you were owned by the government. And post that, in 1969, in July of 1969, every district in India was assigned a lead bank, which was government-owned. There was another wave of nationalization in 1980, but after that, the system has pretty much stabilized. Every district in India has a lead bank, and as an example, I provide a state of Madhya Pradesh, one of the 28 states in India. This state has more than 40 districts, and as you can see on the figure on the left, every district has a different color, and on the right, I have names of banks which can be mapped to this color, which is basically the lead bank of that district. So we use this system because of something very interesting that happened in 2016. So UPI, there was a pilot program which was launched in April in which a short cohort, a small cohort of 21 banks joined the platform and they tested it. But in August, towards the end of August 2016, it was rolled out for banks throughout the country. And this is the last thing that Raghuram Rajan did as the chairman of the Reserve Bank of India, and then he left the country. So some banks were early to adopt the UPI platform. So what we see is between August to November of 2016, 13 lead banks joined the platform. And some banks were slightly late. Now, the delay was not a lot. The delay was only 6 to 9 months. But the impact of this delay was magnified because of demonetization that happened in November 2016, which nobody saw coming. So suddenly, there was no cash in the economy. And we had some districts that had lead banks that were early. They already had UPI. And some districts that did not have it figured out yet. And we used this timing of lead bank adoption for this identification strategy. So again, just an example here. Let's go back to the state of Madhya Pradesh. There are two districts here, Burhanpur and Betul. These two districts. So as we can see, one of them was early. The green district, Betul, was early. And because their lead bank was the Central Bank of India, which was an early adopter. And we have another district, Burhanpur, which had a lead bank, Bank of India, and they were late. And as a result, on the right-hand side, you can see that there is a difference in cashless payments itself, the volume of cashless payments, and this is at a log scale in these two districts. Now, specifically for this group, we see that the difference is kind of, there is a huge difference for a long time, and then it kind of deteriorates after a while. But we don't see that in our match sample, which I'll talk about shortly. So when we use this identification, what we essentially are assuming is that, number one, there is stickiness in Indian banks when it comes to adopting new technology. And we refer to a paper by Mishra, Prabhala, and Rajan in 2022. We assume that the timing of participation of the lead bank is not driven by changes in expected growth rate at the district level. And I feel that this is a good assumption because imagine only 20 lead banks that cover more than 500 districts in the country. And this is a central decision that whether should I join, are we ready to join UPI, do we have our systems figured out? And it's difficult for them to account for the fact that all the economic growth of all the districts that they are lead banks in. Some of them are doing well, some of them not so well. So at the district level, the timing was an exogenous shock, and that is the assumption that we are going with. And lastly, demonetization, which was the key driver of UPI adoption, came as a complete surprise. So with these identification assumptions in mind, what we do is that we match districts, early districts and late districts, and we compare outcomes across them. And the way we match them is that we find these early and late districts within the same state, so that they are immune to any state-level policy decisions. And we match them on the number of bank branches per capita, the literacy rate, as well as the population. So this is what our matched sample looks like. So we match on the first three criteria. We match on bank branches, we match on literacy rates and population, and we get pretty similar kernel densities. We also check for the kernel density of the average household income of these districts in 2016, which is around the time UPI was launched, and we find that they are pretty similar in that regard as well. So in our match sample, so we have around 61 early districts and about 50 late districts. What we have is that there is this persistent difference in the volume of digital payments in these districts. So in fact, it's about 15 to 25%. So this is a log scale, but in a level setting, we have 15 to 25 difference in volume of digital payments. We also check for pre-trends for all three of our economic outcome variables, and we find no pre-trends. So I only have an example of income here, but the figure for do you own a business, likelihood of owning a business, and business income looks pretty much the same. In fact, what we see here is that there is nothing happening even up till 2018. So there is a lag, there is a lag in adoption and the lag for the economic factor to come up after the adoption happens. So this is our main result from the first identification strategy. We do a difference in differences design on our estimates, on our matched sample of early and late districts. So again, in addition to all the fixed effects that we use for our baseline model, we have a new fixed effect, which is demonetization year-quarter fixed effect. So what we do is basically all districts in India are pulled into 7 bins, depending on how deeply they were impacted by demonetization. And then we just classify them similarly into these 7 bins. And this demonetization year-quarter fixed effects helps us to soak away any impact due to time-varying changes or due to the impact of demonetization in these districts. And what we find is that if you are a household in an early district post-2016, you will have 7.5% higher income, 2.4% higher likelihood to own a business, and 25% higher business income. We also find that our results were much stronger if we look at households in districts that were less financially developed, again, less bank branches per capita. And another thing that we look at is durable consumption, which is a proxy for investment. So is that going up? So if you are a household in a district that was early, post-2016, you are likely to have 1.8% higher durable goods. We also see an increase in consumption of two-wheelers, TVs, ACs, etc. So that's the end of our first identification strategy, which is basically lead bank system. And if you're early, if you're an early adopter, you do better. The second identification strategy focuses on the fact that some households were impacted more than other households because of increase in cashless payments in their districts. So our identifying assumption here is that self-employed households are more likely to be impacted. These are entrepreneurs. So they are farmers, they are small business people, and they report themselves as entrepreneurs and self-employed in our survey. And so we check for this result, and what we find is that if we were to compare self-employed households to salaried households, as you can see in column 1, they have a higher elasticity of income to lagged cashless payments so that's what we find in column 1. And the most interesting part about this identification strategy is column 4, where we look inside the self-employed group of households, and we identify that hawkers, which are street vendors and small traders, like the picture on the right. So this is a typical example of a hawker in India. So what we find here is that hawkers, in fact, benefit the most. They have an even higher elasticity of income to lagged cashless payments. Why the focus on hawkers? So typically, hawkers have a lower collateral. They face relatively larger credit constraints. And as a result, we were interested to see if UPI is actually helping this particular subset of self-employed individuals, and that's what we find. We also look into borrowing. So our main mechanism here is that people are able to borrow more because now they have this history, this transactions history, which is transferable, verifiable source of their business, which they can take to a bank and then get a loan against. And that's what we find for hawkers. What we find as statistically significant is that there is a definite decline in borrowing from informal sources, such as family members, money lenders, etc., that I spoke about earlier. And there is a definite increase in borrowing from a bank. So, and we look at, we also introduce district year, fixed effects year. So we are still in the second identification strategy. So yeah, so basically to sum it up, digital payments can positively impact real economy. We have some other results. There are, for our lead bank identification, we look at differences in income of entrepreneurs. So I think I have like 5 minutes, so maybe I can go to that too. We compare income of entrepreneurs in early versus late districts, and we find that there is higher income of entrepreneurs in early districts. We also look at the impact of RBI credit and how and lagged cashless payments, and we find that there is a positive correlation here as well. We are also working on light data to check as a robustness test to check the same result. Instead of district quarter level, we also use annual measures of income, and we find similar results. So yeah, so thank you once again, and looking forward to hearing your thoughts on this. Thanks.
All right, thank you so much for the invitation to come to present this paper. I really enjoyed reading it, so I guess okay. So just to, Tamara did a fantastic job. So basically this paper uses a definitive approach to compare districts where the lead bank was an early adopter to those where it was a later adopter. And they basically find, what they define as economic activity, so increases in average household income, probability of owning a business, and formal work, okay? So in terms of contribution, I guess, with the audience here, I guess, you don't need to be reminded, but, the fast payment systems are a big deal, especially in places like India and others without interoperability, right? Allowing this instant payment clearance between accounts, even with different providers, right? So again, it's a very timely paper in a relatively new literature. Actually, there's a paper here on UPI, Tamana. So maybe you should. Yeah. Anyway, so I am not going to comment much on the empirics. I'm definitely not the person to do so. But I'll talk a bit about sort of making sense of the numbers. And so let me show you some pictures. In front of the mic. Oh, I'm sorry. Okay. All right. Okay. Okay. Can I use this? Sorry. Okay. Is this work?
It's better for the live streaming if you are right in front of the mic. Oh, I guess you could use that one. Yeah.
Okay. I'm half blind, so. All right.
No,
anyway.
We have that. It's coming to you now. Yeah.
Oh, I can use this.
Just check that it's
on. Yeah.
Perfect.
Okay. Thank you. Sorry. So this is data from Findex. So Findex is data on financial inclusion collected by the bank, funded by the Gates Foundation, and it's basically it's a module built on the Gallup World Survey. Okay, so what do we find there, and particularly for India? So basically, yes, it is true that 70% of individuals of adults in India have a bank account. But basically about a third are inactive, okay? And by the way, this is data from 2021, okay? So when we think about making a digital payment, making or receiving a digital payment, so that's the question is, have you basically used the phone to make a payment, okay? So in India, basically, we find that it's less than 20% that only make a digital payment. About 10% that only receive digital payments, and so when you put it all together, it's basically less than 40% that actually report making or receiving a digital payment. Okay. So anyways, it's just background data for to try to understand the results. So when we talk about fast payment systems, so of course we talk about PIX, we talk about India. These are successful payment systems, but there's basically been a lot of other initiatives. So actually, I didn't know that Mexico had one, and maybe that's the point, right? So there's a lot of diversity in terms of fast payment systems, and so it'd be not, of course, not for this paper, but I think there's a lot of research that can be done to try and understand what are the factors that makes payment systems thrive in some countries and not in others. Okay. So let's talk a bit about so how do we interpret the results of the paper. So the baseline specifications show that digital payments affecting next quarter items or this diff in diff. Again, demonetization happened between the early and late adoption by banks. So I guess so the question is, so is this a story about growth, or is this among treated, so early adopters, or is this a story about decline in control or late adopters? Okay, and I think so one way to make headways here is you could exploit the severity of demonetization by these papers that kind of do the same thing, right? Also, I don't know to what extent you could also exploit construction of new cell towers like what Apurv Gupta and et al. Do in this paper. Now again, this is data, so I don't know the extent to which India is still building towers in this day and age, but especially for rural areas, this might be important. Okay, so another point here is, so we think about UPI or fast payment systems. There's definitely a component of network externalities. Okay. And so basically, the analysis that you do kind of assumes that most transfers happen within the district. But so is there any way that you can check this? So would there be data for inter-district transfers or trade flows? And if those are large, right? I'm thinking about remittances, for example. You send the kid to the capital, and the capital happens to be not in the district. Or so on and so forth. So anyway, so if there's a lot of flows across districts, then maybe we should what you should be looking at is the fact that the impact should be highest for early adopting districts trading trading with other early adopter districts, right? So this gives you sort of another another analysis that you can kind of do. Okay, so what I was hoping to find in the paper, and maybe of course this is not your fault, Amana. I mean it might be that the data is just not there, but it would be reassuring to find sort of first stage outcomes, right? Like for example, is actually income deposited into their account, right? I mean, do you see an increase in balances? And actually, so again, Findex data can be important here. So if we look at, I think, sorry, maybe you guys don't see anything here, so apologies. So on the left-hand side of the left panel, we have government to person transfers, okay? Reports of people receiving government payments, and that includes if I'm a public teacher, that might include the salary, right? So salary or transfers directly deposited into my accounts. And in India, that's fairly small, okay? So into the account and then in cash or using other methods. So this is, having received, and if so, what method? And so basically in India, it's about 10% that receive government transfers or payments into their accounts. That's private. So in the right-hand panel, we have, so basically wages directly deposited into their accounts. And then again, in India, it's even smaller. It's about 5%, okay? And so basically, again, so what this means is, in order to use UPI, I need money in my account. If I'm paid in cash, that means that I'll have to go to a branch and deposit the money so that then I can later use my UPI, the account, and therefore UPI, right? And so basically, there's sort of a bit of a disconnect. I mean, if we believe these numbers, there's a bit of a disconnect between having to use a branch to deposit, and this finding that actually it's in low branch density districts where we find most of the impact, right? So anyway, so there's some squaring that needs to happen. Maybe there's a network of banking agents that we're not looking at. I don't know. Okay. So other first stage sort of outcomes. So we talked about income deposits into the account. What about share of purchases made via digital payments? What about the decline, actually, in the use of cash for purchases, right? I mean, so even if we just have access to the kind of transfers, I guess we should see a lot more deposits than withdrawals in the data, right? So, they don't need withdrawals in cash. They actually just use UPIs. But of course, because they're paid in cash, typically, then we should see a lot more deposits than withdrawals, okay? Just a quick point on the use of survey data or household survey data. So basically, first point, data is collected at the household level, so we cannot really look at gender issues, and these might be important because while account ownership has converged, so this is showing account ownership of all the data from the Findex. So Findex started to be collected in 2011 up until 2021, and so this shows sort of the share of adults that report having an account, and basically by 2021 actually it converged. So men and women are equally likely to have an account, but when we look at account ownership in India, so there's a gap here, right? Sorry, account ownership, cell phone ownership, sorry, and of course you need a cell phone, a mobile phone to use UPI. Okay, so there's a gap, and so that might that's why it might make sense to look at heterogeneous impacts there. Also, another point here is that again it's a minor point, but responders may be more aware of their income and savings if using UPI, as maybe balance might be more top of mind, right? So non-UPI users rely on imperfect recall when they tell you, when they report about their income and so on. I mean, it's well known for data collection methods that if you ask how much did you consume or how much did you spend in food in the last week versus how much did you spend in eggs, in meat, in what have you, you get very different numbers. In fact, you get much larger numbers when it's disaggregated. I don't know how the income was actually collected, but again, it might make sense that UPI users, because they see the balance more often, they might have a more accurate. Okay. So, and then other outcomes. So I'm very happy that you guys are using night lights as a proxy for GDP. I mean, that would give you a really nice other outcome. So fantastic. Yeah. So in terms of mechanisms. So so the paper focuses on access to credit as an explanation for growth. I think that there's more detail in the paper that should be provided in terms of who does the lending, who owns the history of the transaction data. I mean, so how easy it is for me to go as a UPI user to go to a bank, and I presume that there's a lot of fintech that this is a space it's rife for profits, and so I'm pretty sure there's a lot of and being India, I'm pretty sure that there's a lot of entrepreneurs and activity happening. So, but I'd be curious to know what's happening here. But again, I mean, the issue here is, you know, just like income, you know, and so to what extent is the increase in credit that we see commensurate with increases in income that you're showing, right? So again, using Findex index, so this is a Findex data. So basically, yes, 45% of Indian adults report borrowing, but notice that formal borrowing is quite limited. So this is formal borrowing, meaning borrowing from a bank. So again, you know, do these average numbers at the district level kind of make sense with this kind of data? Also, I mean, it'd be fantastic to see whether, you know, so what else is happening here? If we think about businesses growing and businesses being more productive, is this about, you know, the ability to purchase inventory from or sell to further away suppliers and therefore getting you know, better deals? Is it about you know, do business profits increase or business revenues increase because of increases in supply, labor supply? Again, it would be nice to separate female and male supply. I mean, you know, Erica Field and co-authors have these nice papers showing that, you know, when women are given accounts and you know, they control their, they have more you know, they're empowered with their own finances, they basically increase labor supply, okay? And I think I am done. Sorry. So thank you very much. Fantastic paper. Thank you.
We have like 8 minutes for Q&A. So Tamara, I don't know if you want to start by responding and then taking questions or whatever.
Yeah, sure. So firstly, Javier, thank you so much for your wonderful discussion and for all the paper references. We'll look into it and we'll incorporate most of them in our next iteration. I have some quick responses. So firstly, Findex data. I remember looking at the Findex report back in January this year. And I remember the 2021 Findex index. And it's a wonderful way to like compare cross-country, like what's going on, where are different countries. But when I went to the data source, it showed us that they had interviewed 3,000 individuals from end of July to end of October in 2021. So that was, in my opinion, one snapshot of 3,000 individuals, which may not like represent the entire country and the demography. And we don't know for sure. So they do have households which are middle income, lower income, upper income, but we don't know where they are situated geographically. And as I was able to show in my presentation that there is a huge variation. And everyone has a different story depending on where they are coming from. So I wouldn't be able to comment on the mismatch or the gap between what we find from this nationally representative 200,000 households 2014 to 2022 survey data and the Findex index. So that was my first comment. My second comment was, you're absolutely right. This money is not parked outside the banking system. It is within the banking system, unlike M-Pesa and other mobile money platforms that have money actually outside the banking system. So you need bank branches, you need bank accounts, and which is why I emphasized on the fact that the government started a banking scheme for the unbanked, and most Indians already had a bank account by the time UPI came about. And the way UPI works, and this is a little interesting, is that it's linked to your biometric identity card. So for example, I have 4 bank accounts in India. I have a UPI ID, I have an Aadhaar ID. So if as soon as I enter my Aadhaar into UPI and authenticate myself, all of my 4 bank accounts show up on any UPI third-party app provider that I go to. Everybody's talking to everyone on this platform. And it also has this unique feature that if suppose I'm spending, I'm shopping, and I run out of my deposit from one of my account, it immediately goes to my next account and withdraws the balance. So it's like everybody's talking to everybody. These could be 2 completely different bank accounts, but they are happy to help each other out and make sure that I get all my shopping done. So yeah, so there is an option. And as a result, thinking about this setting from a small business owner's perspective they need to have a bank account, they need to go travel to their bank branch, but as soon as that's done and that's set up, they don't have to go to the bank branch again. So unless they're earning in cash, which they don't want to. So in India, if you were to travel to India today, they want you to pay them in UPI. It goes directly to their bank account. They don't have to travel to bank branches. So if they are paying to their vendors, if they are paying to their employees, it's bank account to bank account. In fact, if I can take 30 seconds, here's a funny story. In India, whenever you go to a temple, there is a tradition that you pay some money to the priest. And these days, priests show up with a UPI ID. So you don't have the option to tell them, oh, you know what, I don't have the cash right now. Can I skip on paying? You really can't. So they'll just give you a UPI ID that, please make your donations. So that's the extent of adoption of UPI in the country. Another good point, which I would like to address is how to show that there is an actual lending happening and that people can actually take their transaction history, these small business owners, they can take this transaction history, go to a bank. So we don't really have data to show that, but we did speak with a lender, a fintech lender in India. And what the story that they told us is that you have these hawkers and these small vendors, and when they have digital payments history, transactions history, as short as 3 or 4 month history, they lend some amount of money to them, a small amount of money, and then they monitor how well they are doing. Based on that, they can then dispense more loan. And sometimes they also get repayments from their revenues itself, from the UPI app. So it's like revenue-based lending model, but you're able to monitor your borrower. And these are some of the fintech startups which are now operational because of UPI in India. All the other points well taken. I know we can't see gender in our data, we may have to come up with some creative way to think about how this is impacting different demographics within a household. So yeah, thank you. Looking forward to any more questions.
Yeah, we have 2 minutes, so maybe one question or two. Let's see. Does anybody have questions? Go ahead, Lulu.
I guess one question is, you make a big point about this borrowing mechanism, but we can have all kinds of other mechanisms, just convenience or whatever. And is there something in the growth theory that you have in the back of your mind that says that the borrowing is, say, more or less important than the fact that it used to be really hard to get a POS machine and now it's super easy because you just have a QR code, or any of the other kind of more convenience type stories?
So I agree with you. So there are 2 mechanisms at play here. Borrowing is definitely a big part, but the other part is the fact that you actually have transactions happening. We will have to think about how to show that in the data, other than the fact that the income is increasing for entrepreneurs. They have more income now, but yeah, point well taken. We'll have to think about how to show there's actual increase in velocity of cash or increase in activity.
Catherine, you have a question?
Yeah, hi. My question is about the same topic as the previous one, and the potential sources of growth. So when you're talking about credit, you're emphasizing on firms, but first question is, do you have any evidence that it's also consumer credit? And second one is one would also imagine that on one hand there is entry of new firms, but it's also plausible that the existing ones, because of cheaper payments, can reduce prices, which can be another source of growth. So in addition to the credit to the firms, do you have anything to comment about these 2 potential channels?
Yeah, no, good point, Catherine. So yeah, I mean, regarding activity, actual increase in payments, I guess Nightlight could be one source in which we can check for actual increase in GDP, and we are looking into that data right now. So hopefully in our next iteration, we will have some convincing results. In terms of consumer credit going up, we don't really have data on that, except for the fact that households are consumers as well. So in our data, what we have a very detailed consumption data, and which is why we focus on durable consumption, because we see a proxy for investment. Are they actually increasing spending for buying tractors or cars or TVs? But we can definitely look at, we do have data on on discretionary items, and other kinds of consumption. So we can look at that. Did you take a home loan? Did you spend on these discretionary items? They have a list of items. So it's a very detailed, granular survey. So we can definitely look into that and think about consumers and at the consumer at the consumption, other kinds of consumption, and how if it's being impacted by UPI. Thank you.
All right, time for a break.
Okay, thank you.
Get back to our sessions. Hi, Paula. Just give us a couple of seconds so that people get settled, all right? Perfect. All right, the next session will be a little different. We actually have 3 papers, and they're all data papers, and we're going to have a general Q&A following each paper. And the first presenter, Paula Boel from the Federal Reserve Bank of Cleveland, unfortunately got sick, and so she's joining us remotely. I hope you do feel better, Paula. So we're going to have her over on Teams, and then we're going to have Zen Fairweather from the Reserve Bank of Australia, and then Hoi Kwon from the Bank of Korea. So Paula, feel free to start, and hopefully you don't have problems unmuting yourself. Let's see.
Can you hear me okay?
Perfect.
Okay, great. So thank you so much to the organizers for allowing us to present our work, and also thank you for allowing me to present it remotely when needed. I really appreciate that, and you don't want to be around me right now. So I'm going to talk about a research project that we're conducting together with Daniela Puzzello from Indiana University and Peter Zimmerman, my colleague from the Cleveland Fed. And the overarching theme is CBDC and financial inclusion. Next slide, please. So thank you. The usual disclaimer applies, of course, since I work at the Cleveland Fed. The views expressed are those of the individual authors and do not necessarily reflect official positions of the Cleveland Fed or the Federal Reserve System. Next slide, please. So the motivation is easy. So financial inclusion is often cited as a potential benefit of a CBDC. That is true for developing countries. You know, it's true the fact that it's mentioned as a potential benefit. It's also mentioned as a potential benefit for CBDC in the US, but we want to put this claim to the test. So we want to try to understand, to better understand what are the frictions that lead people to be financially excluded. And I'm going to be specific about what I mean with financially excluded. And then we want to try to understand if a CBDC could help mitigate those frictions. Next slide, please. So I'm talking about financial exclusion in the United States. And so I'm going to talk about unbanked individuals and underbanked individuals. These are data from the 2021 FDIC household survey, and it plots unbanked rates by year since the FDIC survey was conducted. So what we see here is that the unbanked rate, and these are individuals who don't have either a bank, a checking or a savings account in the household in the U.S. So the unbanked rate has been going down since 2011, but in the United States, compared to other developed economies, the unbanked rate is still higher. So the unbanked rate in 2021, according to the FDIC, was 4.5%, but Findex data that were cited before as well for European countries, show that bank rates in Europe, in the Nordic countries, in the UK, for example, as well as in Canada, are much higher and are basically 100%. So the US stands out, still stands out in this dimension. Next slide, please. So the FDIC also reports data for what are called the underbanked. So these are individuals who have a checking or a savings account in their household, but also use what are called alternative financial services. And so for the FDIC, alternative financial services are money orders, check cashing, international remittances, payday loans, as well as pawn shop loans, tax anticipation loans, and auto title loans, and rent-to-own services. So we see that the underbanked rate in the US has also been going down since 2013. It's at 14.1% in 2021, according to the FDIC. And I would also like to point out that very little is known about the underbanked in the literature. So there is a literature on payday loans, but there's much to be researched about why the underbanked use these services. And so we try to shed a light on that. Next slide, please. So I reported unbanked and underbanked rates, for the overall population in the US in 2021. But I also want to point out that both unbanked and underbanked rates can be substantially higher for some segments of the population. So we see that, for example, for individuals with an income less than $15,000, the unbanked rate goes up to 19.8%. The underbanked rate is also substantially higher. Also, if we look at Black households or Hispanic households, both rates are substantially higher. So this is something we think that we should pay attention to. Next slide, please. So this is a description of what we're doing, and this is very much ongoing work. So all your feedback is very much appreciated. So this is a two-wave study. So we finished wave 1, we're still conducting wave 2. So, and it's a mix of different tools that we're using in trying to understand the issue. So we've used focus groups, individual in-depth interviews, and we're conducting a longitudinal survey to better understand. So in wave 1, we try to better understand reasons for being unbanked and underbanked, with a particular focus on issues of trust and privacy. We also want to better understand the attitudes of unbanked and underbanked individuals towards technology and their financial literacy scores. Wave 2, which is still ongoing, is focused on understanding whether, given the frictions that these individuals are facing, would they be interested in adopting a Fed-issued digital money? Would they find it beneficial? Which features of a CBDC would they, be mostly interested in? So this is stuff for which I don't have results today. This is work that is ongoing, but I can report some of the results that we have from wave 1, which I think are very important to inform wave 2. Next slide, please. So this is the progress so far. So we conducted focus groups in Houston and in Cleveland, 4 in total last summer. We also conducted 9 in-depth interviews in Memphis. So overall, through this qualitative research, we reached 27 unbanked individuals and 18 underbanked individuals. And we finalized the first wave of the survey, through which we were able to reach 800, basically close to 900 unbanked individuals and close to 2,300 underbanked individuals. We are conducting a longitudinal survey. So in wave 2, subject to attrition, we're going to talk to the same people. And we're also using a representative panel of the US population, through which we are reaching the underserved. In this survey, we asked many questions, and I'm going to show you results for some of them. We have, however, just very recently, a couple of days ago, received data that are weighted according to demographic characteristics. So the results I'm going to show you are not weighted according to demographic characteristics. We also conducted information treatments in wave 1 for the unbanked and the underbanked. We conducted 2 separate informational treatments. For the unbanked, the informational treatment has to do with, in which dimensions having a bank account could be beneficial. For the underbanked, the informational treatment has to do with the role of the Fed. And for wave 2, we conducted 12 individual interviews, and we are launching wave 2 of the survey, which is going to be focused on CBDC. Next slide, please. So we're going to talk about, or I'm going to report data on unbanked and underbanked from our survey. We make a distinction in our survey between strongly unbanked and weakly unbanked. So the first thing we do in the survey is we screen out individuals who say they are not they don't make financial decisions. If they tell us that they make financial decisions, then we determine whether they are unbanked or not. We call strongly unbanked individuals who have no checking or savings account, individual or joint, at the bank or credit union, and it could be a physical bank or an online bank, plus no one in the household has a bank account. We call weakly unbanked individuals who have no checking or savings account, individual or joint, but someone in their household has a bank account. So think about college students whose parents have a bank account. think, a family where only the children, actually, the grown children have a bank account. Underbanked is a subset of the bank population that uses check cashing, money orders, bill payment services, or payday loans at least twice in the previous 12 months. So we don't look at international remittances to define underbanked households. And this is different from the FDIC. Next slide, please. Okay, I'm going to show you some preliminary results. So the first thing we do in the survey, once we determine whether the respondent is unbanked or underbanked, is we ask them, once we determine if they are unbanked, we ask them for reasons why they are unbanked. And we propose them a long list of reasons separated in different questions. Based on their first answers, then we ask them, are the reasons you selected minor or major reasons? And among the reasons that they identify as major reasons, we ask which one is the main reason for not having a bank account. So the main, the main reason that is cited most often is that they cannot meet minimum balance requirements. But then we see, and here I'm highlighting in yellow the reasons I want to focus on in my discussion here. So not trusting banks is very important. Not trusting that banks would protect their privacy is also very important, and this is very much in line with the FDIC. But they also mention that they're concerned that banks could fail and they could lose their money, and they're very concerned that banks could get hacked. And this concern of getting hacked is something that stood out in the focus groups as well. This is something that participants talk a lot about. Now, bank hours being inconvenient, bank locations being inconvenient do not appear to be as important. So let me say one more thing. These are all important reasons because these are all cited as main reasons for being unbanked, but some are more important than others. Next slide, please. Similarly, once we identify that the respondent is underbanked in our survey, we ask them, we try to identify the main reasons for why they are underbanked. So first we ask them for general reasons for why they're underbanked. We ask them then, are these minor or major reasons? And among the major reasons, we ask them which one is the main reason. Now here, the result appear different from the reasons that the unbanked put forward. So fees are the most important reason. Okay, so for some services, and this is something that we learn also in focus groups, it's better not to go to the bank for these individuals. Trust and privacy are also important, but in terms of ranking are not as important as for unbanked individuals. They're also concerned about banks being hacked, about banks failing, and bank locations and bank hours are more important for the underbanked than for the unbanked. And this is something we learn in our focus groups as well. So they might go to Walmart, for example, to conduct some transactions just because it's more convenient. It's closer to their home. It's open 24 hours sometimes, so they don't have to think about going to the bank or at particular hours. Now, one thing I want to say so you see that we also ask them for other reasons for why they might be underbanked, and they can insert their answer in a text box. And so other reasons that they talked about is that very often, particularly for money orders, they can only pay with money orders. So they really become underbanked because that's the only mean of payment that is accepted typically by their landlord. Next slide, please. Okay, so then among the reasons they mention for being unbanked and underbanked, we try to tease out reasons for why they don't trust banks. So the green lines are the unbanked respondents, and the blue line is the underbanked ones. And the main reason for why they don't trust banks is that they think that banks can fail and they could lose their money. And then the other reasons really have to do with past bad history with banks for the unbanked, or banks being too expensive. So that translates then into a lack of trust. Next slide, please. So for privacy concerns, we try to do the same thing. We try to tease out why are they concerned that banks would not protect their privacy. And so the main reason they put forward is that both unbanked and underbanked is that they're concerned that banks could get hacked. And also in focus groups, they often said that sometimes, even if they have a bank account, they'd rather conduct a transaction online with prepaid cards, for example, because they want to protect their bank account. They're really concerned about being hacked. And then I have to mention that when we ask them for other reasons, and they can insert their text answer, very often they say, well, these are all reasons for why I'm concerned that a bank would not protect my privacy. Next slide, please. So we mentioned, so I described what we ask about trust or lack of trust in banks. We try to understand where that lack of trust comes from. But then we also ask, who do they trust, right? And so here we give them a list of, let's call them financial institutions, and we ask them about their level of trust. So a score of 1 is low trust, a score of 5 is high trust. Sorry. So again, the green are the unbanked, the blue are the underbanked. So the institution they trust the most is the Postal Service. We call it here a financial institution because that's a place where they might go to get money orders. They also trust credit unions, and that was obvious in focus groups as well. They trust credit unions. They've heard good things about them. They think they would get a better interest on a loan. And then the third one is the Federal Reserve. And so this is important, right? If we're thinking about CBDC, this gives us some information. The least trusted are cryptos, and I'm going to say something more about that. And the government appears to be quite low in the ranking as well. Now, we separated the government. So when we asked them about levels of trust, we separated the question about the government because in focus groups we noticed that then the trust or lack thereof in the government could then influence the answers for other institutions. Next slide, please. So lack of familiarity. We also asked them if they're not familiar with some of these institutions or some of these tools. And the tool or the institution they're least familiar with are cryptocurrencies. That's at the bottom of the list here. And but the Federal Reserve is also pretty low. And that's why then we decided to introduce an informational treatment about the role of the Fed. Next slide, please. So other things we learned. So I don't have much time, so I just want to say a few things here that we learned both from focus groups and from the survey. One is that the underserved use fintech tools primarily for payments. So in both in the focus groups and in the survey, they often cite Chime or Cash App or PayPal as tools that they use to pay. We also asked them in focus groups why if they thought that having a bank account could be beneficial to them. And so something that they mentioned is that they thought having a bank account is like a form of social credit. So they said when they when they need to rent an apartment, it's important for them to show that they have a bank account. A lack of a bank account leads to a lack of trust in them having a steady source of income. And also, they think that having a relationship with a bank would allow them to get better terms of credit, lower interest rates. Also, sometimes the distinction between bank and fintech accounts is not obvious to them, right? So sometimes in focus groups, if they had Chime, some of them view themselves as being banked, some others didn't think they were banked. So it took us a long time to design questions in the survey to really figure out who is unbanked and who is not. And also they complain about a lack of interoperability among apps. So if you have a bank account, you can do basically everything with your bank account. If you don't, then you have to use all these apps that don't talk to each other. That's what they said. And next slide, which is the last
Paula,
one.
you're out of time, so you should probably conclude.
Okay, so I just want to say that what we learned about CBDCs is from focus groups so far. And what we learned, I'm just going to mention the last point, that really framing matters. So how you present the concept, it's a concept that is difficult to understand for them, and I think for everyone, and really how you present it matters in terms of also the answers that you might get. Thank you.
Thank you very much. And we now have some time for Q&A. Are there any questions for Paula?
How are you doing, Paula? I just wanted to learn a little more about the mechanism of the survey. Is this an internet-based panel? How did you do that?
Yes, it's an internet-based panel, but the company that owns the panel provides respondents with phones or tablets and internet access if they don't have it.
Anyone else?
Yeah, I have a question. So Russell here. So I'm wondering, so how likely they become unbanked or underbanked because they are rejected by the bank? For example, I apply for a mortgage and then the bank turned me down. So that's why they have to go unbanked. And the other question may be related to before. So how likely they are become unbanked? Maybe, for example, for now the online banking is important because they lack of access to internet, especially broadband. So how that might be related?
Yeah, so we have questions about both. So the literature shows that being rejected by banks is an issue. So there is, in particular, people could be, imagine they might not have pay overdraft fees, and then they're put on a database that is called check system. And many banks use check system to determine if you have a good banking history or a bad banking history. So your credit history doesn't really matter for you when you open a bank account, but it's your banking history that matters. And if you have a bad banking history, then it becomes problematic to open a bank account. Some banks are getting away from check system, but if they use check system, sometimes if you have a bad credit, a bad banking history there, that might make it difficult for you to get a bank account for up to 5 years. So that is an issue. And that's something we ask about, and that's something they report that they don't have. So in the chart, one of the first charts I showed you, having problems with the past banking history is one of the main reasons for not having a bank account. And then the second question, I forgot what the second question was.
About the internet, so maybe they have difficulty have access to broadband. That's my broader.
Sure. So we asked them about internet access. So internet access in the form of a smartphone doesn't seem to be an issue. So most of the respondents, both in the survey and in the focus groups, had internet access. They had a smartphone. Now, they might not have broadband, but they have internet access through the form of a phone that should be enough to conduct basic financial transactions.
Any other questions? Yep.
Hi, quick question. So among the people that were concerned about fraud as a reason why they were unbanked, how many actually had been banked at some point, but then they sort of, you know, because of you know, being a victim of an attack or what have you, decided not to. So in other words, is these people that were never banked and this is the fear that they have, or they were sort of, you know, a victim?
So, yeah, I don't know at this point. I cannot answer your question, but we asked them if they had a bank account in the past, and so that's something we can look at. We don't know if I wouldn't know if they've been, you know, attacked. I don't know. I wouldn't be able to know that, but we know if they've been banked before. So that's something we can look at, if that made a difference.
Yeah, and I guess, sorry, just related, I mean, so, you know, this concern about scams and, you know, not wanting to have an account because of, you know, because of potential attacks, you know, how does that, you know, these expectations jive with the actual, you know, actual data that you guys might have on prevalence of these attacks? So, I mean, are these, you know,
So
did they
one
exaggerate
these
preferences or these expectations?
So actually, one thing that, I mean, now that we're talking, I'm thinking in real time. So one thing that we know are zip codes. So probably we can, you know, we would be able to tease out the, you know, how likely you are to get mugged in a certain zip code and how that correlates with the answers that they give. Now, one thing I want to say is that I think they're concerned about being hacked in general. You know, it's not just specifically about bank accounts. Also, when they talked about fintech accounts, they were concerned about that. Maybe they were more concerned about those than with bank accounts. So I think that's just a general concern that they have.
We have time for maybe one more question. I might have given them too little coffee, Paula.
That's okay. I appreciate the questions I receive and the opportunity to present.
I think you were just very clear. Then why don't we move on to Zen? So we can move on with the presentation. And then maybe, I know you're virtual, but maybe people can reach out to you by email, Paula, for any questions.
Good morning, everyone. Thanks for having me here. So I'm Zan Fairweather from the Reserve Bank of Australia. And with Denzel Firebig, Adam Goracek, Rochelle Gutman, June Maher and Jack Mulqueeny, we're very grateful to be able to present this early stage work with you on valuing safety and privacy in central bank digital currency. Nothing too original or surprising here. I've also got a disclaimer to share with you. So the views expressed in this paper are those of the authors and not of the Reserve Bank of Australia. So I'll jump right into it. To issue a retail central bank, digital currency, policymakers really want to be confident that that people will use it. Otherwise, they risk wasting startup costs and investment costs in setting one up. This does create a problem for policymakers, though, because it's unclear what take-up of a retail CBDC would be. We have very little experience with retail CBDCs in the real world so far, and so it presents a bit of a dilemma for policymakers. So the objective of this work is really to contribute to that, that discussion and lower the level of uncertainty about potentially issuing retail CBDCs. So, as our research question, we really ask what are the prospects for retail CBDC uptake, and that research question has two subcomponents. The first is how much would Australians value having access to a digital form of money that's a claim on the RBA and not on a commercial bank. Obviously, that's a key value proposition of a CBDC because a CBDC is a claim on the central bank and so it has a higher level of safety than a claim on a commercial bank. Our second sub-question is, to what extent choices about design for privacy might affect uptake of a CBDC. So policymakers are obviously constrained about how much privacy they could offer in a CBDC, but there is some scope to decide which institutions would be able to see the data. So this is also potentially an important value proposition for a CBDC. Obviously, we're far from the first to consider these questions. So just to walk through some of the themes in the literature so far. So on safety, a lot of central bankers have sort of opined that people don't clearly see the differences between central bank and commercial bank claims. And there's some survey evidence from Europe that's broadly consistent with this point. But we also see cash holdings rising during times of economic stress in many countries. And so it's unclear whether that's due to the physical nature of cash or the fact that people do value central bank claims at some times and not at other times. On the privacy literature, there are very mixed messages from that literature. So public consultations on CBDC tend to elicit very strong responses and concerns from members of the public about privacy and sort of the risk of government overreach. On the other hand, if you run a more representative focus group, you might find slightly weaker views. And in general, there's a literature on the privacy paradox that suggests it's quite hard to interpret survey evidence on privacy preferences as well. So that, is in general, a very mixed literature on privacy. Our key point of difference for this paper is that we use a discrete choice experiment to address our research questions. This technique is a lot more common in environmental and health economics and is really designed to help value goods and services which don't have markets at the moment. And it does so in a way which addresses a lot of the concerns that people might have with stated preference analysis, which is obviously important because we don't have much revealed preference data on CBDCs yet. So as far as we're aware, we're the first to produce willingness to pay estimates for CBDC attributes. And I want to be clear that we value willingness to pay as a metric, not because we're expecting fees for CBDC, but because it's a useful format for cost-benefit analysis for policymakers. So to run through the results quickly, we find that Australians, on average, don't value the added safety of a central bank claim. And we think that's consistent with sort of the range of other measures that are already in place to make commercial bank deposits very safe in Australia, and a lack of recent banking stress in Australia as well. On privacy, we find that Australians, on average, are more comfortable sharing data with the RBA than with commercial banks, and the estimated valuation on that being about $5 Australian or $3 per person per year. So, it's far from clear what privacy settings a retail CBDC might or could have, but this estimate does suggest that, under some conditions, privacy could be an important value proposition for a CBDC. At the same time, we're talking about, single-digit dollars here, so it's not potentially an amount that would overwhelm some of the other considerations that you might make when you're doing a cost-benefit analysis of CBDC issuance, such as taxpayer costs of the infrastructure. Also important to note that these are averages, and they probably disguise a wide amount of variation between individuals. And it's pretty clear from other public sources that there are some individuals who have very strong aversion to sharing their transaction data with the government. And equally, there could be pretty significant differences if you ran this experiment in other countries as well. So on to my plan. So I'm going to spend a fair bit of time on the methodology before I get to the results. I'm going to omit a discussion of heterogeneity and preferences by demographic characteristics, which we also have data on just on account of time, but that analysis will be in our paper when it does come out. So some of you might not be familiar with discrete choice experiments. So rather than explaining it sort of conceptually from the ground up, we're just going to walk through the application and highlight some of the key features and reasoning along the way. So I'm going to start with the survey question itself that we implemented the DCE with, and spend a bit of time on that because in DCEs, the question is really fundamental to the conclusions that you can draw from the exercise. Unlike techniques that use revealed preference, the econometrics here are pretty straightforward, so it's really the question and also the sample that we use that are our main concerns in interpreting the results. So the survey question, given its importance, just going to put it on the screen and read it out. So there's a debate about whether people should be allowed to have a bank account at the RBA, which is government-owned. People would be able to access their money using mobile phones, computers, or cards, just like they can at other banks already offering bank accounts. This question seeks to understand how much you would value this option. So assume that you're opening a new bank account You've found two options, both offering the same functionality for making withdrawals, deposits, and payments. The only differences are described in the table below. Which account looks more attractive to you? So we're asking respondents to pick between two accounts here. I'll now show you what that table looks like. So we'll start out with the first row. So we gave respondents two options for account fees, either 20 or 25 Australian dollars per year, although sometimes in different columns as we randomized the entries. We then showed them two options for who provides the account, so either the Reserve Bank of Australia or a commercial bank. And then we showed a richer array of privacy possibilities on the third row. So sometimes cash-like anonymity for the account, sometimes Australia's Financial Crime Authority could see the data, sometimes the account providing entity, so either the RBA or a commercial bank, and sometimes a combination of those entities, so the Financial Crime Authority and the commercial bank, or the Financial Crime Authority and the RBA. So we think that these privacy options are sort of a useful simplification of the policy options that central banks are considering for privacy in CBDC. There are just a few other sort of features of the question and the setup that I want to highlight at this point. So we've randomized all of the entries that you can see in square brackets here. So not all respondents will see the same table, and that's how we generate the variation that we use to estimate willingness to pay. And that's sort of a key feature of discrete choice experiments in general. It's quite challenging to write a question about CBDCs without taking a lot of time to explain what they are, so many people aren't familiar with them. So instead, we just relied on analogies to bank accounts in our question instead of trying to explain CBDCs. So we thought that was sort of the fastest way to get respondents up to speed with what they needed to know. A common concern that people have with sort of basic stated preference analysis in surveys is that respondents might feel that the question is inconsequential, so they give an answer that's different to what they might actually do in practice. So to manage this, discrete choice experiments try to make the question seem more consequential, which we've done in the question preamble as well. We also included fees so that we could estimate willingness to pay, so I'll go through that in just a moment. And the final thing to point out is that you'll notice that we're requiring respondents to pick between two different accounts. So we're only asking whether they value the difference in safety and privacy by more than $5 or by less than $5. So this more than less than setup is also a deliberate feature of discrete choice experiments, and its intention is to circumvent anchoring problems. So suppose someone valued the differences between these accounts at, say, $13. You might be concerned that by seeing $5, their valuation is anchored towards that $5 amount. But the point with this setup is that as long as their valuation doesn't go below 5, they still answer the same thing, and we still get the same information on the survey. So that's the setup. Now talking through the survey sample itself. So we included this question in the 2022 RBA Consumer Payments Survey. It's basically the best attempt by a reputable firm to generate a representative sample of Australians. It also includes some respondents who preferred to respond to the survey offline. There was material amounts of attrition in the sample, so we had 9,000 people that we randomly contacted, and we ended up with a final sample of about 1,000 people. The survey includes some demographic information, which we used to do our heterogeneity analysis at the end, and the survey was in the field from October 2022 to February 2023. So now how to estimate willingness to pay. So this is a standard approach in discrete choice experiments, so I'm just going to go through it conceptually. What we're doing here is modeling the probability that a respondent will choose account A as a function of the differences in utilities between the accounts that we present them. So that looks like the conditional probability of choosing account A as a function of the differences in fees, claim types, and privacy attributes between the two accounts. The full model that we use, we account for those differences using dummy variables, so it's a bit longer than this, but this is the sort of conceptual framework here. To get willingness to pay from this model, we just compared the coefficient estimates for beta 2 and beta 3 with beta 1, which tells us the extent to which people are willing to trade, say, a more attractive price for safety and privacy characteristics. The function that we use for F is the cumulative density function for the standard normal, which gives us a probit model, and we estimate that with maximum likelihood. So I just want to highlight here that it's a bit of an economist's dream to have such a simple econometric setup because we've generated the data ourselves. So the thing that we focus a lot more on here is the sample and the question design. And that's reflected in sort of the features that we'd like you to keep in mind when you're interpreting the results. So this is obviously our best attempt to make a clean and credible attempt at our research questions, but there are also a few caveats to keep in mind. The first is that our respondents filled out the survey during a period of pretty intense media scrutiny on the RBA's forward guidance program during COVID. And it was also just before the US-Europe banking stress from earlier in the year. So, had the timing of those events been a little different, our safety estimates might have been a bit higher, potentially. On privacy, we surveyed people during pretty high-profile data breaches at private companies in Australia, which could have increased their aversion to sharing data with commercial entities in particular. On the other hand, we do question whether the most privacy-conscious people in the Australian public would have agreed to respond to a central bank survey in general. So those two factors are pushing in different directions, and the net effect is potentially a bit ambiguous. Sort of a few other factors that I'll just run through quickly. So I guess the most policy-relevant question is how much people value the option of safety or more privacy. Our question is unlikely to pick up option value because we're asking people to choose between opening accounts rather than the existence of accounts. And we also can't be confident that, for example, there are behavioural reasons for people sort of reacting to $20 and $25. I said that the difference between the account fees is the important thing. So $0 and $5 in theory should give us the same results, but there could be behavioural reasons why people might react differently to different numeric values. The other question that we have is whether we're fully isolating preferences for safety. So someone might see this question and also think about their attitudes towards the role of government when they're answering this question. So CBDC, some surveys show that CBDC support differs quite significantly by political party, for example. Or some people might just be sort of skeptical that the government should be providing products like this, or that they couldn't offer other features that a commercial bank deposit could, like a mortgage offset account, for example. So now to the results. So I'm going to step through our key results sort of step by step. So the first row is our estimate of the valuation of safety. So if you read down the vertical axis, it's telling us the estimate of the value of an account provided by the RBA instead of a commercial bank, and that estimate is pretty much $0 per person per year. And we have 95% confidence intervals in there too, and that's holding constant all the other features of the account differences. If I talk through the privacy results next, so the next three are people's valuation of sharing data individually, so with each entity individually. And you can see that those are all centered around $3 per person per year. There is slightly more aversion to sharing data with a commercial entity over public entities, but given the size of the confidence intervals there, we don't take too much stock from those differences. Where things get a little more interesting is the next two results. And I say interesting because it might not be possible for sort of policymakers to issue digital money that doesn't have financial crime protections. So the next two results I'm going to show you are the estimates of sharing data with AUSTRAC, the Financial Crime Authority, along with either the RBA or a commercial bank. So the first one shows us an estimate of sharing data with no one as opposed to AUSTRAC and the RBA at the same time. And you can see that that estimate is roughly the same as the estimate of sharing data with either of those entities individually. And what that tells us is that people might take an all or nothing approach to sharing data with public entities. So once I've shared with one entity, I don't care too much to share with another entity, potentially. Where people do seem averse to incremental infringements on their privacy is when they share data with public and private entities at the same time. So the next one is an estimate of sharing data with no one instead of AUSTRAC and a commercial bank at the same time, and that one's around $6 per person per year. So interpreted literally, if we take the difference between the last two bars, Australians are willing to pay around $3 per person per year more for a form of money that makes transaction data available to the RBA instead of a commercial bank, if we assume the Financial Crime Authority can also see the data in both cases. If we aggregate that number over the adult population, it's about $60 million per year. So although it's unclear at this stage what privacy settings the CBDC could have, these results do suggest that privacy could become a more important value proposition for CBDC than any safety benefits, at least in Australia. Again, a good point to acknowledge the heterogeneity that these averages are potentially masking. So they are averages, and we think that individual level heterogeneity could be a pretty important factor here, and that's something that we're exploring with the demographic data in our full paper. I should also mention that there is a potential tension here with the assumption about how a retail CBDC might be distributed. So a lot of central banks are contemplating a two-tier model where a central bank and a commercial bank are both involved in distributing a CBDC. And so there is a question about whether you could have a CBDC that just shares data with public entities and not with private entities. In any case, sort of coming back to that final number that I mentioned in the results, it's our view that that number's pretty small, and it wouldn't potentially overwhelm some of the other factors you might want to sort of think about when you're doing a cost-benefit analysis of CBDC issuance. So we see a fair bit of value in work that sort of considers the other elements of the CBDC cost-benefit analysis, as well as approaches that help us tighten up some of these results on safety and privacy. So just to wrap up, I'll throw those results on the slide again, but won't read them out. And yeah, thank you for having me, and happy to take any questions you might have.
We have 13 minutes for questions. Are there questions? Yep. Go ahead. I saw a hand right here. Go ahead, Narayan. Yeah.
So I'm wondering to what effect the proposition that data wouldn't be shared with the OSTRAC would be taken seriously by respondents. I mean, you would expect that the Financial Conduct Authority, whichever, right? So are you at all concerned that they might even ignore that option?
That's a great question. It is a possibility, although I'd say that some of the central banks who are sort of most advanced in thinking about retail CBDC are sort of contemplating a world where the lowest risk transactions might be sort of have cash-like anonymity. So my understanding is the ECB is looking at a model like that. So it is within the realm of possibility that could be the case for some transactions. But yeah, I do acknowledge the possibility that some Australians might have thought that.
And if I can piggyback on that and ask another question, it's why do you focus on a retail versus a retail CBDC? You could, I mean, if you thought of another distribution model where, it's the banks that are providing it anyway. So is there a particular reason why you focus on the central bank, the Reserve Bank of Australia, providing the accounts?
Yeah, another great question. So we focus on that because it is within the realm of possibility that one way of providing a CBDC is just with public infrastructure and not with private infrastructure. So again, my understanding is that the ECB is sort of considering a base level of CBDC accounts where it's just the ECB that provides the services and it doesn't have any private companies involved. So we're not far enough advanced to know whether that it makes sense for our particular jurisdiction, but it's sort of something we still wanted to understand how people value that option. Thanks for your question.
So, thanks. This is very interesting. There's been talk in our country about accounts for people, and one of my things is that I've never really thought that the central bank provides as much sort of account services to its current account holders as as retail people expect. So I guess the sort of central premise, a question about the central premise here is that the RBA would provide all the same services, or as good a service as the private. On the downside, whether it's a question whether the central bank actually could do that. On the other side, we've heard talks before about people sticking with banks because of all the additional services, credit cards, loans. In Brazil, being with large banks because they provide more than small banks. How does that type of dynamic affect? That all seems to be sort of out there, somewhat not covered by your sort of questions in the first place.
Yeah, that's a great question. So I think considerations like that will be captured by the account provider question in our survey. So when people see they choose between who provides the account, so the RBA or a commercial bank, I think one risk is that they're considering the broader suite of features that they value in financial services and not just basic transactional services. So that could be one reason why our safety estimate is close to zero, not necessarily because people don't value safety in their accounts, but because they don't think that a central bank account will give them all the same services that a commercial bank account could. And so those two features could be sort of pushing against each other, I think.
Yeah, I sort of wonder whether the framing on these questions matters. I sort of wonder whether the question, would you rather your bank provide this or the RBA as opposed to, a hypothetical bank versus hypothetically the RBA providing it?
Yeah, I think that's a great suggestion.
So I have a stupid question and maybe a less stupid question. The first one is, if I'm literally looking at the instrument on your slide, if that's what the instrument was, it's not immediately obvious to me that people would perceive that as a question about a digital currency as opposed to an electronic account or an e-money account or something like that. And the somewhat less stupid question might be answered by the first one, which is that you put this in the field about 5-6 months into the crypto winter, which might have affected some people's perceptions about risk, and yet you don't seem to find any evidence of that.
Yeah, I think they're both good questions for the record. So on the first one, again, I think the safety estimate will be capturing a pretty broad array of things. So again, I still think that's an informative thing for central bankers because they are offering, this is from a consumer perspective, they're getting an array of services that are comparable to some of the features of their commercial bank accounts. On the crypto winter, that's not something we'd considered that much, but I guess in the sense that people still have access to their commercial bank accounts, and in Australia they perceive them as quite safe. So the marginal difference between the central bank account and the commercial bank account was the thing that was being tested. So I guess the question is whether that would have fed into that perception or not. Yeah, I think it's a good point. Thank you.
I think I see a hand right here. Yeah.
The stated preference surveys are difficult, so I appreciate the careful setup for trying to overcome survey design issues and so forth. But I'm wondering, did you consider whether if you were to add an extra dimension of an outside option for payment, because the most important thing in this atmosphere is whether they actually use a CBDC at all, and whether you included that in the structure, whether it would shift the results at all, or make the results stronger or weaker. I don't know.
Yeah, so I guess one concern we have is that people are lumping together, or they're answering this question in the context of all of the payment options they currently have available, and whether that's a useful comparator for a central bank considering issuing a CBDC. So one of the things we've thought about is how people think about cash in the context of this question. So, knowing that they have the ability to already hold safe central bank money in a physical form as another means of payment, do they value a digital form of that as well? And if you take the results literally, the answer seems to be no. That's giving you a piece of information, at least, that if cash were to coexist with the retail CBDC, the marginal differences between those seem to be small. Given that a lot of central banks are talking about the CBDC issuance decision not being tied to cash existing or not, that's sort of still a useful frame potentially. Sort of take the point that it'd be difficult to include in the simple bank account setup that we've used to try and explain CBDCs as simply as possible, to add sort of other options if that was what you were.
I think I'm kind of wondering about the person's because it's a stated preference. You're not getting revealed preference here. Whether the way that they're thinking or framing the question in their own minds is how much do they care about the choices they're making there if they're saying to themselves, I'm not particularly interested in using this anyway.
Yeah, I think, one way we could get at that is that, we do have the luxury of having this in a consumer payments survey, so there's a lot of pretty detailed actual revealed preference payments data, so it's like a diary survey where people actually say what they paid with over a week or 2 weeks. So one possibility is that we could explore heterogeneity with people's responses to this question with what they actually choose to pay with. I think that's something we're looking to explore. Thank you.
Go, Mark. Mark has a follow-up.
So I'm going to kind of follow up on what Jeff said. So it strikes me that what you're doing in this paper is you're abstracting from the notion of what a CBDC is by just focusing on the account. And the issue that then comes up is, well, how do people interpret what that means? So you've kind of moved the ambiguity to a different place. But I think it's still a useful exercise because, you know, on some level, if you go to a pure retail CBDC, that's exactly what it is. And Jeff's asking about, well, would they use it? Well, if they had the account, they would use it, you know, almost by definition. So that's just more of an observation that you're kind of shifting the locus of where there's maybe ambiguity and people are thinking about what this account means as they're interpreting it. So that's an observation. But then I have a question. Are you going to repeat this exercise in future surveys? Because you mentioned the banking turmoil in the spring. Bob brought up the crypto winter. And you could envision that this notion of central bank money and safety, you know, it might not necessarily really resonate with people until it really does. Yeah. And so I'd be interested in knowing if you're going to try to kind of do this again in a future wave.
Yeah, I think it's a great suggestion. So no plans at the moment to run it again. Given we could run it again, and then there could be a second winter, and then we're in the same issue. But there are some of the sort of research questions we're asking do require multiple observations. So one of the ones that we're exploring is whether we have data on age. And one thing we're interested in is are there generational or age effects on preferences for CBDC? And as the population ages, might those preferences change over time? So to answer that question would also require sort of multiple observations. Also just wanted to, I appreciate your first observation and sort of wanted to be clear that this approach is really telling us only on the extensive margin how much people value CBDC. So we're asking them in the context of opening accounts. But another important question for central banks is how much CBDC would people hold and how much would they use as well. So there are other papers out there that have attempted to look at the intensive margin, which we think is useful as well. Thank you.
There are two people that have had their hands up for a long time. So let's go, Catherine, and then, yeah, there you go. So go, Catherine, and then.
Yeah, my question is also about...
Your mic is off. The speaker button. Perfect.
Hi. So my question is also about the fact that you find a small effect, which may be explained by the framing and the type of questions that are asked. Because in a way, one could expect that, as I had described, the CBDC is like a bank account, and the sort of information sharing is also very similar to what individuals might expect that is happening already. It kind of already a bit surprising that they see a difference, which might be just reflecting the degree at which like the central bank is more trusted than commercial banks. So I was like, wondering like whether if you do have follow-up service, like why not to ask like more broad questions as well? Like what if like the information is shared not with your bank, but also other banks, or on your agreement with other banks and fintechs, companies, and so on. And second, in terms of framing, maybe it would be interesting also to vary the sort of descriptions, that whether it's like a bank account as opposed to like physical cash that is electronic and so on.
Thank you. Yeah, I think those are great suggestions. I mean, sort of one of the constraints we're battling here is slotting this into an existing consumer payment survey where people have sort of gone through a few weeks of being in the field, and then they've had a few dozen questions. So there's a real trade-off with how much information we can give to people before exhausting them. And we ran this survey in a few pilot iterations before it ended up in the final survey. And one of the pieces of feedback we had from the pilot was that giving people more information about the sort of CBDC options and what it means led to a bit of survey fatigue, and sort of some people were just randomly picking the first account rather than considering the question. So do sort of notice that we have a limited window to explain this in a way that people might understand it enough to give an informed response, but it's a trade-off in that people won't understand every single aspect. I guess once a central bank does get to an issuance decision, hopefully they've also gone through a period of public education and there's been consultation, and people might have a bit more of an in-depth understanding, and running a survey like this at that point might give you different results as well. Thank you.
Yes, yeah, so one short comment and a question. So on the comment, so if you ask the question of, suppose the government would open up a bank, that would more or less be the same question that you've asked, or the question that you showed us, in the sense that the government is owning the account or owning the institution which provides the account. So it would be interesting to in a follow-up survey, to ask that question directly in the sense that, do you get the same results as if you would just nationalize banks? And related to that, I was wondering if you have any information on what people know or think about deposit insurance in Australia. Because if you're emphasizing the safety aspect, you would expect that it's people who have no clue about or deposit insurance who might have strong preferences for this government-provided account that you're eliciting here.
Yeah. I really appreciate your first suggestion. I think we have a nice long list of things we can improve if we run this again. On your question, so we don't have much information about public awareness of deposit insurance in Australia. I think there was a survey in Sweden that we rely on in our paper that was sort of around half of the population is aware of that deposit insurance exists. Wouldn't be unreasonable to think a similar ballpark might apply in Australia. One way we did try to get at that question was to look at differences by income in their responses to the survey. If you think that awareness of deposit insurance is correlated with financial literacy, or even how much money people have in their bank accounts and their incentive to figure out whether they have deposit insurance coverage. And again, the results were pretty much the same across all income groups. So it does suggest to us that it could just be a state where a lack of banking stress and a lack of incentive for people to look that up just means that most people don't consider it, and they consider their commercial banks to be pretty much ultra safe at the moment, is our interpretation.
All right, and with that, we should move forward. Thank you.
Hello, this is Oikon from the Bank of Korea. I'm originally affiliated with Bank of Korea. Now I'm seconded to the BIS as a visiting central bank research fellow. I would like to thank you for giving me the opportunity to present my work at this wonderful conference. I'm very happy to be here. Today I'm going to present a paper entitled Predicting the Payment Preference Possibility, a Discrete Choice Experiment. The paper is co-authored with Sungju Choi and Bong-Sub Kim, Young-Si Kim, and Sohn Park, all from the Seoul National University. The usual disclaimer applies. The views here are not those of mine and those of authors, and do not necessarily reflect the views of Bank of Korea and BIS. The central bank digital currency refers to money issued in digital form by the central bank for use by general public, including household and non-bank business. An increasing number of the central banks are studying the issuance of the central bank digital currency at the retail level. There has been a growing body of theoretical research that examine the implication of CBDC for payment system and financial stability and monetary policy. However, in order to investigate the impact of CBDC, it is essential to predict the preference or demand for CBDC in advance. Predicting the payment preference or demand for CBDC is challenging because CBDC is a completely novel form of central bank money. Furthermore, it's closely related to the design issue of CBDC because of its multi-attribute nature, including issuance form, anonymity and privacy, and enumeration policy, and cost and benefit, and so on. In this work, we employ a discrete choice experiment to predict the preference for CBDC as a means of payment. The discrete choice experiment is a conductive method used for eliciting preference when revealed data is unavailable. This method is increasingly utilized in economics and more widely used in other social science, especially in marketing science as well. Using discrete choice experiment, we first examine the preference of individual respondents for the relevant attribute of payment method. And we then use the estimated preference to predict the payment preference demand for CBDC, which is characterized as a new vulnerable payment attribute. I prepared this slide. When I prepared this slide, I thought that you might not familiar with this discrete choice experiment, but you must be now familiar with discrete choice experiment because Jen presented this paper. But I think it would be better to do my own. I'm not skip this paper, this slide. I'll provide a brief explanation of how to use discrete choice experiment with an example. Let's consider the supplier's problem of designing option or product while facing uncertainty in market demand. These products could include items like mobile plans, durable goods, insurance products, and payment methods. Now, let's say that a product consists of attributes X, Y, and G. For instance, option A has attributes XA, Y, and GA, and while option B has attributes XB, YB, and GB. Respondents are asked to choose between option A and B, with attributes being randomly varied across option and individuals. In the context of economics, specifically within the framework of the random utility model, choosing A over B means one prefer A over B, which eventually implies that option A provides higher utility to individual than option B. We can calculate the average marginal effect of an attribute X on choice. More precisely, we estimate average marginal effect of a change in the value of each attribute on the expected probability of choosing the payment method profile with the corresponding attribute. Intuitively, the average marginal effect tells us on average how much the expected value of dependent variable change when we make a small or incremental change in independent variables while holding all other variables constant. This method allows us to predict the demand for option A with attribute XA, Y, and GA as a fraction of people choosing it relative to other options. More importantly, this method enables us to examine the most of the relevant attributes that influence the payment choice, some of which are difficult to identify in observational data. Further, discrete choice experiment enhance the plausibility of the prediction regarding the preference for some product and allowing for causal inference, causal interpretation. Now, let me summarize the main finding of our paper. The effect of attribute on the choice of payment method align closely with previous literature. For instance, the preference for payment methods is highly responsive to attributes that are related to financial incentive, pecuniary incentive. And non-monetary attributes also have a significant but more modest impact on the choice of payment. Furthermore, our simulate-based preference for existing payment methods closely match the data from the survey of consumer payment choice conducted by the BOK in 2021. More importantly, our study predicts that CBDC is likely to become a popular payment method, second only to the credit and debit card, which are issued by financial institutions. If CBDC is introduced, it's likely to be more readily used than cash. And preference for CBDC can be influenced by various features of its design. Specifically, payment preference for CBDC show a high level of responsiveness to the discount rate or financial incentive, which suggests that pecuniary reward for CBDC could play a crucial role in its adoption. There are three alternative approaches for predicting the demand for CBDC. The first approach is to ask participants to allocate funds to a CBDC account directly. The second approach employs structural estimation technique and use data from survey of payment choice. This method use various structural assumption and decision to predict demand for CBDC. The third approach involves conduct lab experiment. Now, let's move on to the detail of our discrete choice experiment. In November 2021, we conducted an online survey in partnership with Hanguk Research, a reputable survey company in South Korea. Our survey includes a regional representative sample of the 3,561 participants, all of whom were born in South Korea and ages 19 years and above. As you can see in the table, our sample is a close reflection of the South Korean population. In the survey, participants were asked to choose between two payment methods with randomly assigned attribute. We carefully select the 9 attributes of payment method for random variation, which includes issuer, issuance form, disclosure of information type, vendor acceptability, risk of loss, discount rate, payment delay, timing of settlement, and monthly fee. The table provides a full list of the attribute value in each attribute. While our attribute may not cover every aspect of the payment method, but they encompass key features that are relevant to today's payment landscape. And they are essential for studying payment preference, especially in the context of CBDC. Let's take a look at an example of actual discrete choice experiment we conducted. Participants were presented two payment methods bundle, A and B, each with corresponding value listed in this table. And they had to choose A and B. This selection process was repeated 5 times with randomly varied attribute. In case option A, issuer is central bank, issuance form is smartphone app, and once vendor acceptability is 50%, monthly fee is 3,000 Korean won, which is equivalent to about 2.5 US dollar. And in case of option B, issuer is private financial institution, issuance form is plastic card, and vendor acceptability is 100%, and monthly fee is 5,000 Korean won. So we asked participants to choose 2 payment options. Let me provide a brief overview of the econometric framework we applied. Our approach is based on the random utility model. To estimate preference for attribute of payment method, we start by assuming that the choice process can be expressed through an indirect utility function as follows. Here, Ui, Jk represent an individual i's utility from a payment method scenario J for a choice pair K. XI, Jk is a vector of attribute that individual I encounter in payment method scenario J for choice pair K, and Cij, represent the monthly cost incurred by individual I when using a payment method J for choice pair K. We estimate this equation using a conditional. We estimate this equation using a conditional large model through maximum likelihood estimation. Basically, this equation represents the probability that an individual I choose a payment method J over another J prime in a choice pair K. Participant repeat this this choice, this selection 5 times with random attribute, varied attribute. Okay, now let's see the average marginal effect for each attribute. Most of the coefficient estimate of the parameter are highly significant, and this figure shows how a change in a particular attribute or payment method affects the expected probability of choosing the payment method profile which has the corresponding attribute. Each estimate is specified relative to a particular baseline value for the corresponding attribute. In this figure, the top is the baseline value for each attribute. Here, the demand for payment method increased by 2.3 percentage point when central bank is an issuer. And the demand for payment method increased by 7.5 percentage point with plastic card and smartphone app compared to paper. It increased by 2.3 percentage point when neither personal ID or no transaction information are disclosed. And it increased up to 6.8 percentage point when vendor acceptability increased from 50% to 100%. The demand for payment method increased by up to 11 percentage point with a discount incentive, and increased 3 percentage point with shorter payment delay, and it decreased by up to 14 percentage point with monthly fee with 5,000 Korean won. Now we will move on the predicting demand for existing payment method to check the external validity of our discrete choice experiment. We start by assigning attribute value to existing payment method, including cash and credit and debit card and mobile pass payment. This table displays the combination of attribute value assigned to each of these payment methods. The assignment of attribute value reflects the current payment landscape in South Korea. Next. We used the conditional logic model, which we introduced in the previous slide, to predict the payment preference for cash and debit and credit card and mobile pass payment. According to Bank of Korea survey of consumer payment choice in 2021, the use of credit and debit card is highest at around 64%. In our simulation, this payment method also make up the largest portion. They are accounting for about 59%. And mobile pass payment make up about 20% in the simulation, which is higher than 12% reported in the actual survey. But the use of mobile pass payment is increasing in Korea very rapidly. In short, this graph shows that the simulated demand from DCE match quite well with the actual demand of existing payment method. We're now introducing CBDC into our simulation as an additional payment option. We explore various CBDC design scenarios. Across all design scenarios, we assign common attribute values, such as central bank as an issuer, card and smartphone app as the issuance form, 100 vendor acceptability, and 1 to 5% probable loss, and 10-second payment delay, immediate settlement, and no monthly fee. We think these attributes are considered inherent feature of the CBDC as an electric form of the central bank money. So we set scenario one where in scenario 2, the degree of the information disclosure is reduced to only personal identification information. In scenario 3 and 4, the discount rate increased to 3% and 5% respectively. In this figure, we present simulation-based prediction of the payment preference when CBDC is introduced on the benchmark design scenario. The likelihood that CBDC is chosen as the most preferred means of payment is about 21%, ranking the second highest after credit and debit card. We also investigate how CBDC demand varies with the change in the information disclosure type and discount rate. You can see the scenario 2 to 4. And in scenario 2, where only personal identity information is disclosed, demand for CBDC increased by about 0.7 percentage point compared to baseline scenario 1. And the discount rate increased, which as the discount rate increased, which are the scenario 3 and 4, CBDC demand rise about up to 9 percentage point. This suggests that peculiar incentive when using CBDC could play a significant role in each preference as the most preferred payment method and its adoption. We also investigate the simulation situation in which private financial institutions and big tech companies actively respond to the introduction of CBDC by adjusting attribute of credit card and mobile payment to sustain their market competitiveness. It's possible that they respond by providing financial incentive in the form of lowering monthly fee and raising the discount rate or pecuniary benefit. We examine how the demand for CBDC change in this scenario. This figure shows that demand for CBDC in each scenario. If both P and discount rate adjust to favor consumer, the demand for CBDC decrease. Yes, as you can see in this figure. Specifically, the demand for CBDC decreased by 1.5 percentage point, which is amount to 7% decrease relative to that in the baseline scenario when monthly P decreased and discount rate increased, the scenario 4.
You're out of time, so you might want to conclude.
Yes.
To have questions.
Yes, two more minutes, please. We also conducted a heterogeneous analysis across subgroup in our paper. We analyzed four key social and demographic factors such as gender, age, education, and income. However, for this presentation, I focus solely on the age group. We estimate the same model separated by age, and the AME results are presented in this figure. The most notable difference is in the valuation of issuer. For older age group, when the issuer is the central bank, the probability of choosing the payment method increased by 3 percentage points. However, for younger age group, there is no significant impact. When the issuer is big tech company, the payment method increased by 3.2 percentage point for younger age group, but decreased by 1.5 percentage point for older age group. This figure shows that the preference difference in the attribute by age lead to difference in the preference for payment method. CBDC is preferred similar to mobile pass payment among younger age group. but CBDC is distinctly preferred over mobile pass payment among all the age group.
You are really, really out of time.
Yeah, okay,
like your
sorry,
time
sorry.
ended
Okay.
way before.
Let me conclude.
Thank you.
We use discrete choice experiment to measure the demand, to examine the demand for CBDC. When CBDC is introduced, CBDC predicted to be popular payment method after credit and debit card. There is room for manipulating the market demand for CBDC by varying its multiple attribute nature in the design of CBDC. Okay, it's over. Thank you for listening to my presentation.
Thank you.
So I have a question.
Yes.
Quick. So the juxtaposition between the previous paper and this paper is very interesting because the previous paper was very high level, asking just sort of a generic question, and there you could say, well, how are people thinking about what that thing being proposed to them was? Here, you're taking the opposite approach. You're specifying all sorts of detailed characteristics of something and then asking people to evaluate that combination of things, which is extremely ambitious. But I wonder if people get overwhelmed by that list of things. So, because in the previous paper, there was a question of what does it mean? Here it's a question of, do people actually, as they're looking at these options, actually, you're giving them 12 characteristics or however many. So what I was wondering was, did you think about saying, you know what, for some people, I'm just gonna give them 3 of these things and ask them about these three characteristics, not give everybody that laundry list, and just see if there were differences in the way that people responded, simply because the 10 or 12 or whatever may just cause fatigue and people can't process it. So I don't know if you have any thoughts about that.
Actually, companion of this paper, we did the ICT with respect to privacy design aspect. So in that paper, we measured how private design affect the willingness to use CBDC. In this paper, the purpose of this paper is to predict the demand for CBDC. So that's why we consider the 9 attributes. We refer to this attribute from the survey of consumer payment choice. In the survey of payment choice, there are 4 attributes. The one is that ease of use. The other is, I have no idea, the cost and benefit, and security. So we think that, we thought that we need to suggest more detailed information regarding the ease of use. So we thought that the form of the money can be related to the ease of use. So we consider this type of value. So, but I'm not sure that how people understand this scenario. But in the literature, this could be useful to predict some situation. Yeah.
Of comments and encouragement. So XII, John, and Lowenstein in the Journal of Empirical Legal Studies in 2013, they did a very interesting experiment. What they did was they wanted to value privacy. They intercepted a whole bunch of people in a shopping mall. They gave them a task to do, but the really thing they really wanted to elicit was people's privacy concerns. So then the actual experiment was how they were paid for their participation. So this is where they varied the treatments in terms of getting paid with a prepaid card that gave you anonymity versus another payment instrument that's you had to provide your personal information. So from this, they were able to infer the value for privacy. So I think for these discrete choice experiments, it's very interesting if one could do this. And you could conceivably do this because you run this survey with the market research firm. and especially in your case about timing and availability of the funds, how people are paid and their incentives. So you could offer somebody an instant payment right away, and then you can offer another payment, but then with a more monetary value. So it's my encouragement to start thinking about this, and of course, please talk to your IRB. They make sure that this experiment passes the muster test.
Yeah, yes, I want to do that kind of experiment if I have the abundant budget, but I don't have no money. And when we did this experiment, we considered how to give financial incentive to the participant, but we forget to give a financial incentive to the experimenter, participant to the experiment.
All right, with that, we should go to lunch.
Okay, thank you.
think we will kick off. Don't want to shortchange the presenters. So if you haven't yet, grab your coffee, but we will kick off with Konstantinos. We will kick off with Konstantinos Serfes from Drexel, and Fumiko Hayashi will be the discussant. And we will then...
Guys, listen to Chris.
If you don't listen to me, Elena will come after you. And the second presenter will be Lulu Wang, and discussant will be Devesh Raval. So, Konstantinos, the floor is yours, and we will give you back any time that the coffee stole.
And I'm not supposed to move away from the mic?
If you really want to, I think we can give you the traveling mic.
Okay. Oh, my slides, okay. Let me get used to this. All right. Thank you very much for including our paper in the program. This is joint work with Bob Hunt from the Philly Fed. Okay, thank you. And I'm at Drexel University. Okay, the usual disclaimer applies. Whatever I say here, don't treat it as a legal advice. Okay, so let me start by giving you a very quick preview of our model and what we are trying to do. So this is like a two-sided. I'm trying to find the. There's no laser, right? I'm sorry. Okay, so this is a two-sided market model. The main ingredients are two competing networks. So we start with one network, like a monopoly network, which issues a credit card that consumers use. And then we allow for entry of a second network, and we examine what happens when, obviously, competition intensifies. So each network issues a credit card. Then the other ingredient of our model is a product market. So this is like a main innovation. I'll talk about it again later. So we model the product market with N competing merchants who choose prices, choose quantities, but prices endogenous as a consequence. And then we have consumers who choose which credit card to use, and they make purchases. Okay? So the goal of the paper is to study how competition, and by competition here we mean competition both between the networks and in the product market, and possibly the interaction of the two. So how competition affects the determination of the interchange fees, the rewards, and the credit card tax incidence. So in other words, who pays what, okay? So, you all know here what interchange fees are. Interchange fees are paid by the merchants to the network. These are wholesale prices, and being wholesale prices are not visible to the end user. But of course, they affect the welfare of everyone. So in the US, merchants pay about $160 billion in order to accept credit cards, debit cards, and prepaid cards, but also incur expenses in the amount of $35 billion for rewards. Okay? Obviously, both are important. Both are sort of prices which affect the tax we're talking about and affect welfare. Policymakers worry about the interchange fees being high. News accounts suggest the Board of Governors will revisit the debit interchange fee caps, trying to lower the interchange fees, or introduce ways that would instill more competition between networks in the form of giving the choice to the merchants to choose the routing method, which network to route the transaction to. hoping that, again, that will intensify competition and lower interchange fees. Another important question in the literature is who pays these fees. There are many papers, here we just cite very few. Might be the borrowers, the revolvers, might be those who pay in cash, might be the poor, and so on and so forth. Now, in the theoretical literature, and here I'm talking about the literature on two-sided markets, most prices, goods prices, are exogenous. And for obvious reasons, I mean, the models are quite complicated. Like 20 years ago, when all these theoretical papers in the two-sided markets were starting to appear, the issue of adoption was important. To model that, you had like to make sacrifice some realism on other dimensions. Now the issue of adoption nowadays is not a big deal. Most merchants accept all cards, or the major ones. In most of these models, demand was very simple, like the product market demand. Either it was discrete or the intensive margin was missing. And also, equally important, most of the fees, interchange fees and rewards, were not ad valorem, were specific. Again, given the assumptions, maybe it didn't matter much of unit demands, I mean, but obviously when demands are not unit, the way we model them, it matters. So here are the main modeling components of our model and our contribution. So as I said, we develop a two-sided market model with merchants and consumers. We model competition in the product market with endogenous prices and quantities. We assume we assume more general demand functions. I mean, not super general, but demand functions that allow for extensive and intensive margin. And we assume that the fees, interchange fees and rewards are ad valorem, okay? The questions we ask, first of all, are the merchant profits a potential source of interchange fees? Yes, I mean, okay, we know that. But if yes, if so, then we have to model the merchant markups more generally. So that's one thing we do. And then, as I mentioned before in the first slide, how do interchange fees and rewards depend on competition between networks? So in particular, as I said, the exercise we do is this. We have a monopoly network to start with. We do all the analysis with a monopoly network, and then we allow a second network to enter the market. And we look at the level of the interchange fees, what happens. And welfare, prices consumers pay, and so on and so forth. And then how does competition in the merchant market affect, or in the product market, in the goods market, affect the interchange fees and the rewards? And again, a third question or fourth there would be, say, how the interaction of the two types of competition, or the two tiers, affects the equilibrium prices. We haven't done that yet. Okay, main findings. The first one, surprisingly, it can be the case that more intense network competition, so in other words, when a second network enters, interchange fees can go up, okay? That's something, obviously, we were surprised by that. And then as a result, as a consequence, the prices consumers pay increase and welfare goes down. Well, is this always the case? No. It depends. But it depends on something I think that is very very intuitive and very prominent. It depends on the degree of network differentiation. So we allow networks to be differentiated, like in the hoteling horizontal style. So if networks are sufficiently differentiated, then entry leads to higher prices, higher interchange fees. And I'll give you the intuition. If not, they go down. So it depends on the degree of differentiation. And then as competition in the product market intensifies, profits of merchants go down. So it's like a sort of double marginalization story. Then the interchange fees go up. But prices consumers pay go down because there are two forces. One, the product market becomes more competitive, interchange fees go up, but the overall effect, at least with the demands we have examined, prices go down, consumer prices. Okay. All right, the model. So there are n identical merchants. So we start with the most basic product market environment, which is homogeneous product. Okay, so just to isolate any effects from product differentiation and of course, make it easier, the model, more tractable. So homogeneous product, n merchants. The output of firm J is capital X, sum of individual outputs, marginal cost constant. The elasticity, I mean, the inverse demand is like P of X. And the elasticity is there. I put it there because it matters. It's just like, we all know the formula, but just to put some emphasis on that. Okay? So this is the market elasticity. So there's, that's the market elasticity. Capital X is the aggregate output. So networks, there are two competing networks. As I said, we start with one, and then we introduce the second one. Okay, here we don't model the structure of a network. Let's say there is a network, there is an acquiring bank, there is an issuing bank. So all these three are into a network. And they maximize joint profits, assuming that profits are perfectly transferable. An extension would be to look at more into the structure of the network with the acquiring and issuing banks. Of course, it's going to be much harder. Okay, so there are two competing networks. Each network issues one credit card consumers use. Ad valorem interchange fees, II, IL, L is denotes the network. Ad valorem fees paid by merchants as a percent. Then you have the R, the rewards, or it can be a fee. So we allow the R to be between -1 and 1. And each consumer has a more preferred credit card. So that's the horizontal differentiation. It's like from the consumer's perspective, how they view the credit cards or how easy it is to switch credit cards. So the game, it's a three-stage game. So in stage one, networks and banks, together, like as I said, each network sets its interchange fee and rewards to maximize joint profits. Then in stage two, merchants compete in quantities. And in stage three, consumers decide which credit card to use and make purchases. So again, we know that in these two-sided market models can have multiple equilibria. As I said, the adoption issue question is not an issue anymore. Most merchants, in reality, most merchants accept the major credit card. So we do want to focus on that, on the adoption decision. So therefore, we focus on an equilibrium, which is an equilibrium, where consumers single home, so in other words, they use one card, the more preferred one in equilibrium, and merchants accept both cards. And no one has an incentive to deviate from that equilibrium, but we didn't look for other equilibria. Okay? And consumers have no reason to use a second card to multi-home, given that merchants accept both cards. So, all right, so here we have the price consumers pay now is multiplied by the reward, 1 minus R. Then we have the inverse demand. So I can point with this? No, right? That's okay. I'm used to like where it was lower and I could. It's too high.
Bring over a stool and help.
And I'm trying to point there, but it's only me, so I'm losing my focus. Anyway, so, but yeah, I mean, you see the important thing here is that the profit function of merchant Z, so this term, depends on the interchange fee. So as the interchange fee goes up, the I, profits go down, but also depends on the reward. As the reward goes up, profits go up because consumers are willing to pay a higher price when the reward is higher. So the Z here, this Z, is what we call the tax due to the credit card. So if I is greater than R, which must be the case for the network profits to be positive, otherwise they would be negative, then Z is greater than 1, and it's a tax due to the credit card. So if it's 1.1, the tax is 10%. And by tax, we mean the difference between the price consumers pay and the price merchants receive will be 10%. So it's like a public finance taxation model. Okay, and then we use, to simplify the analysis and model competition in the product market, we follow the conjectural, we adopt the conjectural variations approach, where lambda is how aggregate output will respond when firm J, merchant J, changes its output. So that lambda varies from 0 to n. So if it's 0, it's like Bertrand outcome, perfect competition. If it's 1, it's Cournot outcome. N is like perfect collusion. So then we divide lambda by n, and we have the gamma parameter. So this is very convenient because gamma captures the competitiveness, the degree of competition in the product market. 0 means perfect competition, 1 means collusion. And as gamma increases, competition becomes less intense. All right, so here, and I have 10 minutes, right? Or 8, 9. So then the equilibrium price merchants receive, the expression up there, is a function of marginal cost, okay, numerator, and the denominator is 1 plus gamma over the elasticity. So if gamma is 0, perfect competition, then price equals marginal cost, okay? Or if the elasticity is constant, then the price doesn't depend on Z, the tax. But the tax now affects the price through the elasticity because it affects the aggregate output. So that's why I was saying the elasticity is very important. Then the price buyers pay is multiplied by this Z, so the price wedge due to the credit card here depends on Z.
Please use your handheld mic if you're moving away from the podium.
Oh, okay.
You always have to have a mic for the live streaming. Otherwise, I get yelled at as much as I yell at you.
Okay, okay. Anyway, oh my God. We need training before. I mean, come on. Okay, so, all right, so that's the price wedge, which depends on Z. So this is like, okay, this is like a public finance taxation sort of problem. Then the monopoly network maximizes its profits. Its profits are the price wedge times the output because of the, yes, so it's a fraction of the value that is transacted that goes to the network. And so this Z star, I mean, it's not very intuitive. I put it there just to show you. So this is the Z for the monopoly network, that the equation that Z implicitly must satisfy. But I put it there, the reason is to see that all these elasticities matter. Not only the elasticity epsilon, but epsilon prime, which is how the elasticity changes when aggregate output changes. Say if there's more output, does demand becomes more or less elastic? Again, depends on the demand. And also depends on capital E, which is the elasticity of the slope of the inverse demand. So these appear also, again, in taxation problems. So this is nothing new. And the pass-through in taxation literature depends on this capital E and so on and so forth. So they do appear here. So here is a list of some demands we've looked at. And the signs of these different elasticities, you can see with constant elasticity, for example, this epsilon prime is 0. But then with a linear is positive. With a generalized Pareto, it depends. So that's more general, and we can choose different parameters to have epsilon prime positive or negative, because it matters. And in the logit demand, okay, so you see the different signs. All right, let me skip, because I'm running out of time, the constant elasticity. So here you see some numerical results. Sorry, I'm going to get yelled at again. We see some numerical results for the linear demand. So the marginal cost is 0.8. And when gamma is 0, for example, start from the left column, then the tax is like 12.5%. That 12.5% is the difference between the price merchants receive, which is 0.8. That's marginal cost because it's perfect competition, and 0.9, which is what consumers pay. And as gamma increases, then the tax decreases. And then you can see the tax incidence down there. So again, this is, again, I don't know if it's surprising or not, these results, but these are, I think, quite standard, not in this literature, but from the taxation literature, yes. So I want to get to the more interesting stuff, which is when a second network enters the market. And we start, so we proceed step by step. So we begin by assuming that the fraction of users of each card is fixed, mu, doesn't depend on the rewards or the interchange fee. So in other words, consumers, users don't switch. Then we relax that. So it's step by step to develop the intuition. If that's the case, then the profits of the network L, one of the two, it looks like the profits of the monopoly network, except that the aggregate output, the output that is being bought and sold and bought using that card is now mu times x. And then the elasticity depends both on the tax both taxes, Z1 and Z2. So when gamma is 0, then entry has no effect on the tax Z. because when gamma is 0, the elasticity disappears, okay? Or when the elasticity is constant, like in the constant elasticity demand, again, it doesn't disappear, but it's not a function of z. In all other cases, the elasticity matters, and how it varies with x, where x is aggregate output, where x is affected by this tax, that's important. That's the epsilon prime. So our first result here is that, as I said before, so I'm not going to read that entry mitigates competition between the networks and increases the tax when the market share of the network, of each network, is fixed. Why? Okay, here I have some results, but I'm running out of time. Let me give you the intuition. In the first bullet, we have a monopoly network. So Z goes up. When the tax goes up, either because the interchange fee has gone up or the rewards have gone down, aggregate output decreases. Consumers buy less because it's a higher price. The elasticity, the demand becomes more elastic if epsilon prime is positive. I mean, think of the linear demand. When there is less output, it's more elastic. It's not always the case, though. With Pareto, it can be the opposite. But when it becomes more elastic, merchants now, because demand is more elastic, the market price goes down. And that means less network revenue, because the value goes down from this effect, holding everything else constant, okay? So this makes the network reluctant to raise the Z, right? Because the network revenue goes down from this effect. There are other effects, right? This is not the only, but this is what drives the result. Now, with two networks, when one network increases its Z, then the effect on aggregate output is less, because that network sells less output than in the case of a monopoly network, because mu is less than 1 when there are two networks. The second one has some market share. So the effect of one network on the aggregate output is less than when there is one network, monopoly. This mitigates this negative elasticity effect. Now the network is less reluctant to raise the Z, because that increase in Z has less effect on the price, because it has less effect on aggregate output. And that's why when there are two networks with fixed market shares, Z goes up, the tax. So competition increases the interchange fees. That's the takeaway from here. And then quickly, we endogenize the market shares now. There is a second effect, which is like a competition effect, what you would expect. So networks now compete to attract users. The previous case is like, say, switching is infinitely costly. Now they switch, so that drives the interchange fees down. Which effect dominates? Well, depends on the degree of horizontal differentiation. If networks are very differentiated, then switching is very costly. It's like the transportation cost in the hoteling model is very high. Therefore, we are in the elasticity effect dominates, and competition increases interchange fees. If not, if they're not differentiated enough, then competition decreases the interchange fees. And that's the conclusion, and I ran out of time.
First of all, I want to thank Irina and the teams of the board to organize this conference. Conference. And thank you also for giving me the opportunity to discuss this paper. As some of you may know, interchange fees have been one of the areas of my interest for the last 2 decades. And my focus has been more on empirical side, but I have a few theoretical papers more than 10 years ago. So I really enjoyed reading this paper. Well, before I start discussing, I need to say that the views are my own and not necessarily reflect those of the Federal Reserve Bank of Kansas City or the Federal Reserve systems. Okay, so this one. Okay, so when Jamie and Will organized this conference series the first time in 2004, interchange fee was a very, very hot topic. And 20 years later, interchange fees are still significant issues in the US. Some other countries, they move on, but here, this morning, Vice Chair Barr mentioned that 2 days ago, the board proposed the cap of the interchange fee received by largest debit card issuers will be reduced. And in contrast, credit card interchange fees are not regulated in the US. The Congress tried to introduce bills that aims to reduce the credit card interchange fees multiple times, but so far no success. And as many of you know, that there are lots of lawsuits around interchange fees. And in the context of payment modernization, interchange fees and rewards may impede consumer adoption of instant payment systems or CBDC if implemented. So this is a big issue. And we need an analytical framework to examine these issues, and this paper can contribute to that. Konstantin did a really good job what this paper does, but from my perspective, the contribution of this paper is to provide a new theoretical framework to examine the incidence and welfare implications of interchange fees and rewards. And the models consider important institutional features such as the mature payment card market, and various situations from the retail goods market and competition and market powers. And findings have important implications, and to me, 2 things stand out. First, at least some consumers' incidence of interchange fees and rewards. So consumer incurs something, not just the merchant. And card network competition may reduce consumer surplus and merchant profit and social welfare under certain circumstances. So these 2 findings are really important. So Bob told me that this paper is still early stage, so hopefully my comments are useful to to improve this paper. But my comments are basically 4 areas. So first, I'm wondering the purpose of the model. In particular, which programs of interchange fees and rewards you try to examine. Obviously, distributional issues is one, because this paper analyzes the distribution, incidence distribution between merchant and consumers, and this paper can answer some of the questions like, would savings from the interchange fee regulations be passed on to consumers? And one side say no, one side say yes. So this paper definitely say yes. But significant heterogeneity among consumers and among merchants exists, and this paper cannot address that. Many recent empirical papers found out there are significant heterogeneity among consumers, and merchant side not so much examined, but still, smaller merchants are paying higher interchange fees in the U.S. So I'll come back to this later, but your model can be include consumers without card by, when you're analyzing two networks. So one network is card, but the other network could be non-card. That means non-card users. So what about efficiency? So this paper doesn't consider efficiency in the payment payment system itself. But instead, it measures welfare as a surplus in the retail goods market. But interchange fees and rewards actually affect efficiency of the payment system, and many of us already know that credit card is one of the most costly, resource cost intensive payment method relative to other method, and potentially overuse of credit card, especially in the US, unless transaction benefit excluding rewards is extremely high. And as I mentioned, credit card rewards may impede future innovation, adoption of consumer adoption, instant payments or CBDC, those type of things. So I wonder if your model can also include transactional benefit into the consideration, and analyze two different payment methods. One method have higher transaction benefit for some consumers. Then that way you can analyze that. And where am I? Okay. So in terms of the model, I think you can, as I said, you can include consumers who use alternative method. Probably I don't need to explain this, but some consumers do not have credit card, and not all transactions are credit card. Actually, it's a minority. Only 36% of the in-person payments are credit card, and others are other method from DCPC studies. And because merchant discriminatory pricing is not, common in the US yet, so interchange fee, the effect of interchange fee extend to non-card holders. So that consideration is important. And again, DCPC has really nice statistics, so you can refer that. So as I said, your paper section 5 can be extended or a little bit changed to include non-card holders. And now I will switch to the findings. So, Z is a really key variable, representing tax, but it's not tax per se. I mean, tax rate or tax amount. So, I was trained as a public finance economist, but still, to me, understanding what is Z is really hard. So maybe another measure is T, which is a tax rate for merchant on the inverse demand function. So instead of arguing Z, you can use this T, which is Z minus 1 over Z, which is really simple calculation. So maybe that measure you can use. And so from your linear demand model, the G, Z is like 1.12 or something like that. So that means T is around 11%. And what Z means, translate into reward rates and interchange fee. This is a little bit unrealistic because Z is 1.125. This is the case for perfect competition. If reward rate is 1%, that means interchange fee rate is 12%, which is not the case in the US. Even if the US has one of the highest interchange fee rates, it's not 12%. So So, for example, if we use the data or from the recent paper, Z is around 1.014, or T is around 1.4%, not 12%. So maybe your parameters can be adjusted so that G is around in plausible area. So here's I show some of the plausible range using the actual data from the Nielsen reports and others. So maybe this will be useful. And finally, my comments on the policy implications. So your model predict that the proposed Credit Card Competition Act will reduce reward rates as well as interchange fee rates, but I'm not so sure. And again, this is my view. So maybe we can learn lessons from what's going on in the debit card market, regulation II. So if we look, for non-US people, regulation II is many different provisions. One is, the cap applies to large issuers only. So small merchant, small issuers are exempt. So card networks can set freely exempt interchange fees. But Reg II also requires all issuers to have at least 2 networks so that merchant can choose which network to route, which is quite similar to what CCCA, Credit Card Act, tried to do. And what happened for the exempt interchange fees is I show in the chart, but unlike we expected or the regulation expect, the interchange fee amount didn't decline over the more than last 10 years. Instead, last 2 years, some networks increase exempt interchange fees. So something going on, and what drives this increase? So here again, this is my own view, but because of the open banking, BAS, banking as a service, new issues like fintech account providers, service providers are entered into this market. And then, card networks want to attract these new issuers. And what they do is increase interchange fee, give them higher interchange fees, so that they put their network logo onto their card. So that's one force. And another possibility, both people may not like this, but the Reg II amendment in 2022. So a second network is required for all card issuers, but make sure that also apply to online transaction. That was the 2022 amendment. So after that, card issuers need to make sure that they have second network for online transactions as well. So that time, the card networks may use this higher interchange fee as a enticement to attract to their network. So that's probably what's going on, I think. But maybe different people have different idea. But anyhow, the point is your model combine issuers and networks, but I think modeling issuers and networks separately might be really important to describe this type of phenomena. So thank you so much.
So
Thank you very much, and I think in the interest of time, we will jump straight to the second presentation.
Can I use the portable mic? Great. Let me audio check it. Hello? Hello, is this coming through clearly on the audio? They say in public speaking training that you're supposed to stand in the front so that when they throw tomatoes, you're an easy target. I've done my part by wearing a white shirt, and I hope you have brought some food from lunch. So thanks to the organizers for having me present my paper. I'm Lulu Wang. I just graduated 6 months ago now, and then I am now at Northwestern. I want to thank the organizer for having me, and then also the work of so many Federal Reserve economists. I think Scott, Joanna, and Kevin Foster's, all the work on the diaries and surveys of consumer payment choice really played a large role in this paper. And I'm probably one of Fumiko's biggest fans of her 2 decades worth of interchange writings. So this is my paper on regulating competing payment networks. Consumer payments in the US are card-based, concentrated, and costly. So out of 10 trillion in consumer payments every year, around 8 are on either credit or debit cards. 3 companies, Visa, MasterCard, and American Express, process 85% of these payments, and merchants pay high fees at around 2.2% for credit cards in the US, which is roughly 3 times various international regulated benchmarks. Given this market structure, governments around the world have tried 2 main strategies to get it under control. The first strategy is to directly regulate prices. And so most recently, the Canadian Competition Authority has come to voluntary agreements to lower interchange fees for Visa and MasterCard for small businesses. The US has taken a different approach. In the US, our emphasis is instead on trying to increase competition between payment networks. So for example, the DOJ blocked Visa's acquisition of a nascent payment platform, Plaid, on the idea that that competition would have brought down merchant fees. Now, the reason governments can't seem to agree how to regulate this is because these payment markets are two-sided. With every swipe of a card, there's a merchant who pays a fee and a consumer who might get a reward. The theoretical literature highlights that in this environment, a lot of our usual intuitions on competition and regulation just don't apply. Maybe when you cap the merchant fees, you reduce the rewards, which reduces welfare. Alternatively, in different classes of models, network competition can actually increase merchant fees to fund more rewards, which can then lower welfare. But to tackle this question empirically, the theoretical literature highlights that we need a model that captures 3 things at the same time. We need to grapple with the fact that merchants vary in their benefits from card acceptance, that consumers can carry multiple cards in their wallet, and that merchants compete with each other to accept cards and also compete in retail prices. No existing theoretical work does all 3, which makes them unsuited for empirical analysis. So for example, this Edelman and Wright paper is a very nice paper documenting that platform competition can increase merchant fees and lower welfare. But in that paper, they assume consumers can only carry 1 card at a time. This rules out the possibility of networks competing for merchants, and therefore leads to a mechanical answer of how competition affects merchant fees and rewards. And so my paper combines these 3 into an empirical framework to allow me to answer the question of how, say, regulation and competition affect merchant fees, rewards, prices, and welfare in equilibrium. To attack this question, I'm going to build and estimate a 2-sided model of payment network competition. So I'm going to model network competition for heterogeneous consumers and merchants. I'm then going to estimate this model by matching variation from natural experiments. With this estimated model, I'm then going to solve for counterfactual regulations and market structures to evaluate their effects. My main finding is that capping prices can be very beneficial, but more entry is not. So when you cap credit card merchant fees, then payment networks reduce their rewards, and therefore people use credit cards less. Because merchants tend to charge one price to all consumers, no matter how they pay, then cash and debit card users benefit from lower retail prices, whereas the credit card users are hurt from the lower rewards. In aggregate, because credit card use is excessive in the current equilibrium, overall welfare actually increases, which I estimate by around $30 billion a year. In contrast, when you simply introduce one more card network, think Discover becoming very large, you actually increase the amount of rewards without really cutting the merchant fees, exacerbating the overuse of credit cards and lowering welfare. And so you can think about my contribution in 3 different ways. First, I contribute to a finance literature on payments by quantifying the equilibrium effects of new payment innovations on how they affect the market structure. I also contribute to an IO literature on two-sided markets by estimating the model by using variation from natural experiments. I also contribute to a finance literature thinking about how competition in the presence of externalities can be harmful. In my setting, because my payment choices create externalities on others, competition can make this externality worse and lower welfare. And so for the rest of the talk, before diving into exactly what I do, I want to give some background on how this industry works and some intuition for the results. So suppose a credit card consumer comes to my store to buy a $100 pair of pants. Last time I checked, they're around $100, and then I, as the merchant, might pay around a $2.25 merchant discount fee to my bank called the acquirer. The acquirer keeps some of this money to cover their own costs, but importantly pays around $1.75 in interchange to the issuer of this card, who in this case is Chase. The issuer and the acquirer collectively pay around a 14-cent network fee to Visa, and then the issuer can then pay rewards to the consumer. On average, this is around $1.30 in the US market. I wanted to remind everyone of this market structure. And the numbers in blue are the numbers that Visa controls directly. But in controlling these prices, they control the merchant and consumer prices. The reason merchants pay high merchant fees is because their bank has to pay this interchange. The reason consumers can get rewards is because their bank is receiving the interchange. Now, relative to this full market structure, my model is going to make 2 important simplifications. The first is that I'm going to assume that network competition has no effect on interest rates. I make this assumption because when Australia capped interchange fees, we saw huge adjustments on rewards, but not much on interest rates or annual fees for regular cards. The second assumption is that I'm going to group these top 3 intermediaries together and assume that they can maximize joint profits. So it's one player setting the merchant fee and the reward to maximize their joint profits. This is compatible with a variety of market structures. So for example, if you thought that the issuers and acquirers were perfectly competitive, then this would hold because Visa is the only one with market power and they're maximizing the joint profits. Alternatively, if you thought that issuers were local monopolists but could bargain with Visa under lump sum transfers and complete information, then they still too would operate as if a joint profit maximizing entity. In fact, 20% of Visa's gross revenue goes towards non-linear incentive payments to issuers and acquirers. These are under investigation for being anti-competitive, but I think there's strong evidence that these players can maximize their joint surpluses. So now I want to share some intuition for the results. And so if you thought about Visa as a traditional one-sided platform, you would focus on its role in charging fees to the merchant. In this view, under more competition, Visa should cut its margin, expand its market share, and therefore try to compete in that way. In reality, Visa is a two-sided platform. It charges fees to merchants to fund rewards to consumers. In this environment, when a new platform enters, Visa may find it profitable to actually raise its merchant fee to fund more consumer rewards. This works because merchants tend to charge one price for all consumers. And so the consumers get the full 50-cent increase in rewards, but only bear part of the cost of higher retail prices. This is particularly effective if consumers are very sensitive to rewards, but merchants aren't that sensitive to merchant fees. And so for the rest of the paper, I'm going to be trying to show a framework in which we can talk about these sensitivities clearly and then evaluate the effects in the US market. And so for the rest of my 20 minutes, I'm going to show you how I model this competition. I'm then going to estimate this model by matching variation from natural experiments, and then use the estimated model to evaluate counterfactual effects of regulation and competition. Great, so now let's talk about the model. The model is necessary to help me map my reduced form facts into estimates of consumer and merchant demand for payments. And it allowed me to empirically evaluate a lot of the channels discussed in the existing theoretical literature. So in the model, there are three types of players. There's consumers, there's the merchants, and then there are the payment networks. In the first stage of the game, the networks are going to set per transaction fees for the merchants and pay rewards for the consumers. In the baseline model, there's going to be three multi-product payment networks. So Visa has both credit and debit, same with MasterCard, and then American Express. Cash is an unpictured outside option. In the second stage of the game, the consumers and merchants are going to make their adoption and retail pricing decisions. The consumers are going to put up to 2 cards in their wallet. So this blue consumer you see up here carries both an American Express card and a Visa credit card. Consumers are more likely to pick cards that pay high rewards and that are widely accepted. Some other consumers might only carry 1 card. So this orange consumer carries only a MasterCard. Others consumers will only carry cash. And so in this model, consumers will vary in their preferences over, say, cash versus card, credit versus debit. On the merchant side, they're going to choose the optimal subset of payment methods to accept. So for example, this blue merchant is going to accept Visa credit cards and MasterCard debit cards only. That orange merchant on the right only accepts MasterCard debit cards. And that green merchant in the middle is cash only. Now, in equilibrium, many merchants will find it optimal to accept all the cards. But in the off-equilibrium path, where, say, Visa is way more expensive than MasterCard, it's important to allow merchants to accept MasterCard without being forced to accept Visa. The merchants will also set retail prices that will pass on these transaction fees into final retail prices. In the paper, I show how this is compatible with the CES Micro Foundation for merchant demand. These merchants will then vary in their benefits from card acceptance. That's, say, your local dive bar where everyone knows your name. Maybe payment acceptance doesn't matter for sales there. But that e-commerce merchant that you might have never heard of, it matters a ton. And so merchants will vary in how much they need to accept cards. In the last stage of the game, the consumers will then make their shopping and payment decisions, with the key idea that card consumers are going to buy more from merchants that accept the cards they want to use. So this blue consumer buys more from this blue merchant because that merchant accepts Visa credit cards. They buy less from either the green or orange merchant. Although the orange merchant accepts MasterCard debit cards, that's not the card the consumer wants to use. And so in the full equilibrium, the consumers are consuming optimally over all the stores. The merchants are setting optimal retail prices and choosing the right cards to accept. The consumers are putting the right cards in their wallet. And the networks are setting their fees and rewards to maximize their profits. And so with that model framework, we can then think about how to estimate it. So in the estimation, I essentially need to answer two questions very well. The first is how sensitive are consumers to rewards? And the second is how sensitive is card acceptance to merchant fees? On the consumer side, I'm going to be relying on a bank-level panel of payment volumes derived from the Nielsen report, as well as some data from the Nielsen HomeScan panel. On the merchant side, I'm primarily relying on aggregate prices, as well as the aforementioned surveys and diaries of consumer payment choice. Shout out to Kevin Foster for all of his help in the job market. And so this shows you how the prices were set from the original thing, and it'll be helpful in thinking about the intuition for the identification. The first step is to estimate how consumer choices of payment methods responds to rewards. And this is going to be a fairly standard I/O exercise where I have a price instrument, I shock rewards, I see what happens to demand. Once I estimate that, I can then recover the marginal costs of different payment methods. And the intuition is that if Visa is paying huge rewards at the same time as charging high fees, well, the only way they can afford to pay rewards to consumers is if they're making profits off of the merchants. But for the profits to be there, the costs have to be low. And so I can figure out how costly it must be for transactions to rationalize the level of rewards. Now, once I have the marginal costs, I can actually back out how sensitive are merchants to fees in equilibrium. And the intuition is that if I know merchant fees are way above marginal costs, then it must be that merchants are very demand inelastic with respect to the merchant fees. Why would Visa charge such high fees if it were not for the fact that merchants are very insensitive to those fees? This exploits the idea in Roche and Tirole that platforms should tax the price-insensitive side of the market to subsidize the price-sensitive side. But if the taxes are so high, it must tell me that the side is very price-insensitive. The last step is then to rationalize why are merchants so insensitive. And this is where the diaries of consumer payment choice come into play. I can use this data to show that typical merchants increase their sales by around 30% from card acceptance. And therefore, when you think about the 30% sales increase versus the 2% in fees, most merchants are then very insensitive to the fees when it comes to their acceptance decision. And so I'm going to give you some illustration of how I get this reward sensitivity here and how I learn about these benefits from card acceptance. So to estimate the reward sensitivity, I'm going to use variation in the rewards on debit cards. So before 2011, debit cards in the US charged high interchange fees. And so banks would then take these interchange fees and use them to pay rewards. After 2011, with the implementation of the Durbin Amendment, large banks with assets of more than $10 billion had their interchange fees cut in half. In contrast, small banks were unaffected. And so large banks stopped paying debit rewards. And so if you read Fumiko's 2009 paper on this, they were around 25 basis points. And so what I'm going to do is I'm going to estimate a difference in difference approach looking at these debit card payment volumes for these large treated banks against the smaller control banks. This difference in difference approach has been used by Mark and other work to think about interchange fees and bank fees. And it's really important here because there were other things like the Card Act that might have affected the relative attractiveness of, say, credit versus debit. What I find is that this small 25 basis point decline in rewards led to an almost 30% decline in debit card volumes. And so the x-axis shows the number of years relative to the policy, the y-axis is the treatment effect estimate, and it's that debit card volumes fell at these large treated banks by around 30%. In contrast, credit card volumes at these banks actually increased as there was a substitution from debit to credit. And so the net result is that small changes in rewards lead to big changes in payment choices. And so consumers are very reward sensitive. That's on the consumer side. Now, how do I think about the merchants? So The merchant demand for payments is shaped by this idea of how much more would you sell to a consumer who wants to use a card by accepting the card. That's what I call gamma in the model. The ideal variation to study this is to have exogenous variation in whether a merchant accepts a card and see what happens to the sales. Studies that use this approach in foreign markets find pretty large effects, 10 to 30% of sales. Unfortunately, in the US market, most merchants accept cards. So the marginal merchant deciding on this is not representative of what's going on overall. And so to deal with this, I'm going to use the diary as a consumer payment choice. And I'm going to show that when you compare card consumers to cash consumers, the card consumers have a higher expenditure share on stores that accept cards. And overall, most transactions are at stores that accept cards. So formally, I'm going to run a logit regression in the diaries where I ask, for a given transaction, does the merchant accept the card on whether the consumer prefers the card and various fixed effects. As I introduce these demographic fixed effects, what I end up finding is that a card consumer is going to spend roughly 30% more on card stores compared to a cash consumer. And so this is roughly the average effect of how much card acceptance increases sales. And therefore, the fact that that coefficient is like 30% will tell me that the average benefit is quite large. The fact that most merchants accept cards tell me that the variation in that benefit is quite small, and therefore I can rationalize why merchants are so insensitive to merchant fees. And so I estimate that consumers are very sensitive, merchants aren't very sensitive, and I can verify because American Express over time has actually cut its merchant fees relative to Visa. And at the same time, the acceptance gap between American Express has essentially closed. And I show in the paper that quantitatively, this response matches what would be predicted by the model. So now let's talk about counterfactuals. So in my main counterfactual, I think about what would happen if we capped the merchant fees for Visa and MasterCard and held everything else and didn't change any other regulation. And so to be clear, all the merchant benefits from card acceptance, all the consumer preferences are fixed, but the choices of which cards to put in your wallet, which stores to go to, which cards to accept, they're all allowed to endogenously adjust in response to prices. What I find is that after you cap the merchant fees, consumers reduce their use of credit cards by roughly 30 percentage points. And so 2/3 of those consumers go to debit and 1/3 off to cash. Interestingly enough, because I only regulate Visa and MasterCard, American Express optimally decides to charge about 1% higher merchant fee than Visa and MasterCard, and they're willing to accept lower merchant acceptance for more consumer adoption. Indeed, this exactly matches the Australian experience after the capping of interchange fees there. And so now we can think about welfare. The first cut at welfare is to think about this distributional question. And I'm going to focus on the consumers who don't change their payment method. For these consumers, welfare is quite straightforward. It's just going to compare their rewards to the retail prices. So on the x-axis, I've grouped consumers by their primary payment method in the baseline equilibrium. And we see that everybody benefits from lower retail prices. In contrast, it's the credit card users on the left that are hurt by the decline in rewards. And so when you net out these effects, it's a progressive transfer from regulation. The relatively richer credit card users are hurt, and the relatively lower income debit and cash users help. Now, this is a weird notion of welfare because it ignores changing payment choices. But to say anything stronger, I'm going to need to make an assumption of revealed preference. And so that requires thinking about the characteristics of these cards. Credit and debit cards are obviously similar in many ways. You can not have to carry cash. On top of that, credit cards get rewards. If this was all that mattered to consumers, everybody would use credit. But in the surveys, we see that there are debit card users who own rewards credit cards who say they prefer debit cards. So to rationalize that, there must be some non-pecuniary factors, that debit cards are easier to think about, they don't want to risk getting into debt, that explains their decisions. I call this credit aversion. Now, suppose rewards go up by a little bit, which causes a debit card consumer to switch from debit to credit. In switching, they're doing something that's privately beneficial because the rewards offset this bad credit aversion. But from a social perspective, it's a disaster because the rewards are just transfers. They're just transfers from other consumers who are now paying higher retail prices. And so when you add up these effects, you actually get a decline in total welfare because too many people are willing to incur this credit aversion to earn the rewards. And so when I do this in math, I find that overall, for all consumers, they benefit from lower retail prices. They're hurt by losing rewards. But because of this credit aversion term, the net effect is actually positive. And so total welfare rises for consumers by $40 billion a year. Now, you can also ask for social welfare. So consumers benefit. The merchants are actually roughly flat because they can adjust their prices in response to the interchange. And the networks lose a lot of profit because they lose a lot of market share to, say, cash, and they also have to cut their margins in response to this regulation. And so the net effect, I estimate, is around $30 billion a year. Now, to put this number in context, the CARD Act was a major piece of legislation that changed terms on credit cards, and that was estimated to have created consumer benefits of around $12 billion a year. And so these questions of network regulation are quantitatively at least as important as these more classical questions about issuers. Now, in my paper, I consider other counterfactuals. I show that in some sense, the current US system, where we cap debit card interchange, but not credit card interchange, is the worst of all worlds. That if we relax restrictions on debit interchange, that debit card fees would go up, debit rewards would go up. This would be a progressive transfer from credit card users to debit card users, and total welfare actually rises by $7 billion a year. I show that trying to simply introduce more competition makes things worse. If you add, say, a fourth credit card network, then the merchant fees fall a little bit. But to attract more consumers, these networks raise rewards a lot. As a result, the cash and debit card users are hurt by higher retail prices, credit card users benefit, and total welfare falls by $4 billion. There's been a lot of interest in this conference on central bank digital currencies, and I also estimate a counterfactual that shows it basically won't work for retail payments. That there's a specter, to paraphrase Karl Marx, there's a specter haunting the launch of these digital currencies, and the specter is that of two-sided markets. Right? That if you introduce, say, a public debit card network that charges low merchant fees and pays no rewards, then existing credit card networks will want to raise their merchant fees, pay more rewards to hold on to their consumers, and stifle the entry of this new network. Now, I want to emphasize some bigger picture points about the economics of payments and relevant for regulation. The first is that successful payment systems need to attract both consumers and merchants. And so you need to find the use case for consumers that makes it uniquely appealing. That I think a lot of the writing about digital currency, we want public money, feels a lot like a regulator concern, not a consumer concern. The second point is that high interchange fees increase card use. It may be socially excessive, but they increase it. So for example, if you thought that cash use is socially costly because of, say, tax evasion or crime like those Brazilian robberies that we heard about yesterday, then you should actually want high interchange fees. In some sense, Visa and MasterCard are doing God's work by taxing the cash in every drug dealer's pocket. The third point is that even competitive payment markets can be inefficient. So a lot of the historical antitrust and payment markets has been worried about Visa and MasterCard not competing with each other. The point of my paper is that even when they do compete, that can lower social welfare. So I'm out of time. This is my brief conclusion. I estimate and develop this two-sided model, and then I use it to evaluate regulation and competition, and I look forward to the discussion.
moving for me, I think.
The job market,
The award
So,
to the most slides goes to him with 167 slides that we're now going to go through.
So the previous discussion, Fumiko, I thought about this for 2 decades. So I've thought about this for maybe 2 days. But this is my best attempt. So that was the generic clip art from PowerPoint, but I thought it was a good indication of where fees have been going, which are up. So these are, in general, if you look at fees, Amex, Visa, MasterCard, Discover, all charge about the same, about 2.2%. If you look at private label credit, so this would be like your local retailer has its own thing going on, it's maybe a half. And then debit, because of the Durbin Amendment, is much lower, like 0.7%. So these are huge fees. And if you look at the left, I don't know if you can see this, but in total, just the interchange fees are $110 billion. So they're very large, and they're going to go up. So both Visa and MasterCard have been saying for multiple years that they're going to raise fees. It's a bit odd to me as a competition regulator. Why are they both doing this at the same time? Are they doing some kind of tacit collusion? But in any case, fees are high, and they're likely, absent some kind of intervention, to go up even more. So I'm going to first go over the kind of like the basic economics. So this is coming from Justice Clarence Thomas in the Ohio versus American Express case. And what he says is that when you have a two-sided platform and indirect network effects, you may want to vary the price between one side versus the other side, because the goal is to get the most number of people on. And in particular, what you want to do is you want to charge a lower price to the side with more elastic demand, a higher price with the side with less elastic demand. That may even mean negative prices, which in this case would be rewards. And he talks about how with credit cards, you often are going to charge the cardholders a lower fee than the merchants because the cardholders are more elastic than the merchants. This is what Justice Thomas says, and that's exactly what the paper finds. So this is my very simple version of a very, very complicated model. So I think there are 3 big parameters here. The first is alpha, which is consumers' reward sensitivity. And that's being identified by the Durbin Amendment substitution. So as Lulu showed you, once the Durbin Amendment lowers rewards for debit cards, you see this huge substitution to credit cards. So that says that consumers care about, have a pretty high sensitivity to rewards. On the other hand, if you look at the merchant side, there are 2 parameters. So first is gamma. This is actually a footnote in the Thomas opinion. But there's about a 30% gain in demand when a merchant adopts cards. So there's a very big reward for a merchant for allowing a card, and the 30% is coming from this payment survey data. On the other hand, if you don't allow a card and lower your prices, the demand elasticity, which is sigma here, is not that high. It's about 7, so you don't get much extra demand. So in general, what I'd want to do if I'm a merchant is accept all the cards because I'm not getting much gain from lowering my prices if I don't have to pay this fee. So in fact, what he finds is that if you increase both rewards and fees by 1 basis point, Visa transactions are going to go up by 3%, but there's going to be a 0.3% decrease in the share of merchants that accept the card. So in general, these incentives are very much balanced, where you're getting a much higher gain from more consumers than you're losing in terms of merchants. That's going to generate high fees and high rewards. So I want to talk about policy. So there are 3 basic models of regulation. So this is coming from Anu Bradford, who's a law professor at Columbia. The first is the EU, kind of a rights-driven regulation, which in this case would be the right for like a fair marketplace that's treating cash users and debit similar to credit. And their policy is to regulate fees, which I think is what the EU does and what the paper recommends. The second is a US model, which is market-driven regulation. And here that would mean more competition. And the paper says that's bad because all the competition is over rewards and not over fees. And then lastly would be a straight state-driven model, which is what China does, which would be a state network, which in this case actually India has. So this is the UPI, United Payment Interface, is a 0-fee model, which is taken over India because essentially instead of the 2% that we have in the US, it's 0. So these are the 3 models, and the paper says this won't work essentially because this substitutes for debit, not credit, and so the extra gains are not that large because you're still going to have everyone using their credit cards for their rewards. So now I am a both an American and a competition economist. And I feel like saying that competition is bad is like waving the red flag. So I'm going to talk a little bit about why I think I'm a little bit skeptical of the conclusion that competition is bad. I think competition is maybe bad given the current rules of the game. And if you look at the past, both the past, present, and future, there's been a fight between Visa and MasterCard, trying to sabotage maybe ways to try to lower fees. So let me go through that. So this is the ghost of antitrust past. So there have been a bunch of lawsuits. So the first is all the retailers, Target, Walmart, Safeway, and so on, sued Visa and MasterCard. They basically won summary judgment, and then there was a huge settlement, over $6 billion. I think it's too late for everyone here to claim this, but one of the big effects of this was to remove a bunch of steering provisions that said that you couldn't steer people away from, say, Visa or MasterCard or something like that. In addition, the government sued. They settled with Visa and MasterCard, but they lost with Amex. So this is Justice Breyer in his dissent, and he's talking about Discover. And he says that when Discover first entered, they entered on a low fee model, and the idea is we're going to charge low fees, and we'll try to get the merchants to steer demand to us instead of Visa and MasterCard. That failed, and the reason it failed is because there were these steering provisions that basically meant that there was no way for the merchants to steer people to Discover instead of Visa and MasterCard. And then eventually Discover said, well, if you can't beat them, you join them, and they raised their fees a lot, and they basically matched Amex and Visa MasterCard. So he's quoting the district court, but it seems like maybe in the past, if not for Visa and MasterCard's provisions, you might have had entry that lowered fees. If you look at antitrust present, so first, Block, which is actually Square, is suing Visa and MasterCard. So in the paper, these guys are doing some kind of joint profit maximization, but in real life, they're suing each other. And if you want to look at why they're suing each other, it's over a different steering provision, which is honor all cards. So what this says is, if I accept any Visa card, I have to accept all Visa cards. And at some point, I think due to competition with Amex, Visa and MasterCard both switched between some low fees cards, like this Visa Classic, and a high fee card, like this Visa Signature. And there's no way for retailers or merchants to steer people away from the high fee cards. And so a lot of this lawsuit is saying, well, maybe if we could steer these people away from the high fee cards, that'd be another way of lowering fees. Second, which is I think Lulu talked about in the first slide, there's a threat of fintech entry. So Visa was willing to pay $5.3 billion to buy Plaid. I don't know if, I guess in this audience you may know what Plaid is, but Plaid is powering Venmo and other kind of fintech apps. And what the DOJ was saying was that this was a potential entrant in the debit card market that would maybe lower fees in the debit card market. And Visa was trying to buy them in order to suppress that kind of competition. So here, I guess, the breakup is due to the DOJ, but this did not happen. So lastly, if you think about the future of this fight, now in Congress, I think Senator Durbin is proposing the Credit Card Competition Act. And as the graphic indicates, the whole point is to take a bunch of the pie that Visa and MasterCard now have. And the idea is that if you have a Visa or MasterCard card, you have to have a second payment network that's not Visa or MasterCard, and then the merchant can decide which one to substitute to. And so this could potentially allow competition for merchant fees, which I think is a force that's not in the model. Now, if you think about how this is going to go, I think it's helpful to look at what's going on with the dual networks on debit cards, which came in with the Durbin Amendment. So we, the FTC, sued MasterCard, basically saying they were using technical reasons to suppress this kind of substitution. So they've settled to say that they're not going to do it. According to the press, the Department of Justice is investigating Visa for similar things, basically making it difficult or impossible to substitute. So if I was to predict what's going to happen in the US, I think we're probably going to try to have more competition in the credit market, and then Visa and MasterCard are going to do their best to make sure it doesn't actually happen. So this seems to me like, I think competition could potentially, result in reduction in fees. We needed some change in market institutions so that merchants can actually substitute. And I think Visa and MasterCard will probably do their best to ensure that does not happen. So I want to end with a question, which is, this is also coming from Justice Thomas' opinion, and he says, Amex is actually quite different than Visa and MasterCard. You know, Amex makes most of its money from these merchant fees, whereas Visa and MasterCard makes most of their money from interest payments. So that's something that's missing in the model. So do we think that credit terms and all are going to change if you make huge changes in interchange fees and other things? So I think that's a question for the paper. But otherwise, this is a great paper. It's very, very complicated. He made it seem simple, but it's very, very complicated. And I think super important.
Excellent, thank you. So Lulu, if you want to respond at all, or we have about 5 minutes for questions before a break.
Yeah, thank you for the discussion. I think that was very fair, and then we can talk offline. I think the one thing on the credit terms is that the main empirical experience is Australia, and then I actually have a chart in the paper showing that when Australia capped the interchange fees, the rewards rates on credit cards fell. The annual fees on rewards credit cards increased a ton, but the annual fees on regular credit cards and the interest rates on those cards was essentially flat. And so there's I think although the lawyers are kind of worried about it, there's in practice this interesting segmentation between those two dimensions of pricing. But I'm happy to take any other questions about the paper. Yes, James.
This one. Great, thanks. Wonderful paper and great presentation, Lulu. Thank you. The parameter tau, it tells you how much electronic payment is less expensive than cash payment in your model. Is that right?
No, tau is the fee charged by the network. So like 2.2% is what tau is.
Yeah, I'm sorry. But there is a parameter that says cash is more expensive to merchants?
So I have cash at some estimated value from some of these Bank of Canada papers, around 30 basis points. And so at the current prices, it's cash in the model is cheaper for all merchants compared to any of the cards.
Right. So thank you. So the least expensive way to make payments in this model would be everyone use cash. Is that right?
If you're just measuring accounting costs, that's true. But there's other kind of convenience benefits that would not be in that calculation.
Right.
Yes.
And then consumers have this utility for different payments, different card types. They like this card or they like that card. That's right.
Yeah.
So kind of as John Russ said yesterday, money in the utility function. This is sort of like the devil's in the utility function. I am reluctant to, I liked your point at the end talking about if you wanted electronic methods, then you might countenance these interchange fees. But a lot in the model is just not related to, fixed cost, variable cost of adoption or payment. It's related to these this utility that people get from the cards. And then this game of interchange fees, merchant discounts, and rewards is really all a mug's game for society. So, kind of the view you get from this model and many others is, damn it, we have all these electronic payments. It's just a loss to society. And so I just question that particular foundation upon which to build such large statements like excessive use of credit cards and stuff like that.
So I guess a couple of things. I think as a society, we spend a lot of costs to do things that I think increase either the quality of the consumption, the experience that we have, right? And I think that's the way I'm modeling card acceptance. So I think the reason I do that is I kind of take a more IO approach. If I buy more of something, that must be because I like it more. You can put that in a variety of micro foundations. If you thought that was relieving credit constraints, then that increase in sales, the way I'm doing it, you can transfer that into a change in utility. That's certainly in the model for, that credit cards or debit cards might enable that convenience, and I'm definitely not trying to say electronic payments are bad. I think in particular, if you cap the credit card fees a lot, everyone used a lot more debit cards, welfare is certainly a lot higher than in a world without cash. And I think actually in the model, welfare is higher with the existence of electronic payments compared to cash, because people enjoy it. That's in the utility. Now, on the point about the costs, I think there may be other operational costs. I think Scott has views on that. I don't model fixed costs in this paper because I think that for a typical merchant in the US, the fixed cost of a POS machine is quite small compared to the overall costs of running a store or like running a restaurant. And so that's why I chose not to model that. Yeah. Scott?
I also thought this is a terrific paper. Two things. One is just to double down on Devesh's discussion. The one thing, and you cited this in my most obscure paper ever, the one thing that's missing from this entire market is a recognition of the fact that there's limited and asymmetric information and all kinds of frictions. So before we start talking about how we fix a market that looks like it's broken, we should try to get closer to a competitive market, like making sure that every player understands every price and there's available information to make rational decisions. We're treating the whole thing as if everybody's making rational decisions. That's certainly not true from the consumer side. So I'd encourage you to, if you can, in the paper as it is, to go back and reread it with the view that the analysis that you're making may be influenced by the fact that some players in the market don't have full information or have asymmetric information or have frictions and can't act in ways that they want.
Can you elaborate a bit on the asymmetric information?
The typical person that walks in the store doesn't understand that the price is higher because of credit card use, right? So they don't even know that that's happening.
Okay.
Anyway, that's not the point I wanted to make. The bigger point is and now I understand why we didn't understand each other yesterday. So I think the limitation of the IO view, which I love and I've come to learn to understand a little bit, the problem is that consumers are heterogeneous for another reason, not just because they have different payment methods, but because their incomes are so wildly different. And to a first approximation, the upper half of the income distribution has credit cards with rewards and the bottom half doesn't. And that's why merchants have to accept credit cards, high-priced credit cards, no matter what. It's just it's a consumption problem. It's like, where am I going to get my revenues? I'm going to get it from the high-income people. So until we build that consumer side in more realistically, I think we have to withhold some conclusions about what's happening here and what the best remedies are.
So I guess a couple things is you can think about the welfare results in two legs, right? There's the redistribution, and then there is the total welfare results. I think the redistribution result is actually quite robust to, I think, those information assumptions or I think it's much more sensitive to this question of how much do you think merchant fees are going to be passed on into prices? I think any model, regardless of your information assumption, as long as you have some pass-through, will generate the grades of redistribution that we see. I discussed in the paper why, for a variety of reasons, that pass-through is reasonable, thinking about examples from sales taxes, and also thinking about extended models in which prices may not adjust, but firms may exit. On the overall welfare results, I would also say the reason I got my number is really not about the information assumption, but rather from the observation that if you compare credit and debit, rewards are paying consumers to use credit cards, even though we don't have any corresponding external social benefit on the other side from that credit card use, right? And so as long as you believe that, credit cards might create all kinds of benefits, it helps you create a credit history, it might help you smooth consumption. As long as you believe those benefits are internalized by the consumer, then my model will say the fact that we're paying consumers rewards to use credit cards means there's excessive credit card use. So I don't think that's really sensitive to the information. I think it's a bit more sensitive to how much you believe revealed preference in this setting, right? Maybe consumers are confused, maybe consumers don't have access to credit cards. I show some evidence from the wonderful surveys that, there's actually a fair number of consumers on the margin kind of making a choice. But I think that would be the area where I think that result is sensitive. Yeah.
Okay. And I believe this is the last question we had time for. So I encourage everyone to take advantage of the break and for the conversation to continue. Otherwise, thank you.
So we're ready for the last session, which, as you can tell from the name, Topics in Payments, is because we ran out of the good names. And the only common denominator was Rod Garrett. So I thought for a second that we should call it the Rod session. And then we settle with the Topics in Payments. So the first presenter is going to be Travis Naismith from right here at the board, discussed by Andrew Sweeting from the University of Maryland. And then Rod will present, followed with a discussion by Russell Wong. All right, Travis?
Thanks, Elena. And I've made a promise that somehow in the midst of this presentation, I will actually use the word payments, because this could also be called topics and not in payments. So, but maybe it's payments, you know, nearby to payments, because we are talking about financial market infrastructures, and in particular, central counterparties. So I need to give the usual disclaimer. This is not the Federal Reserve Board or its staff's opinions. This is joint work with Rod Garrett, as you guys know, David Murphy, formerly of the Bank of England, now LSE, and Xiaoping Wu, who's up at the University of Toronto. And I should also say that since they haven't vetted my presentation, these aren't necessarily their opinions either. They might have, they might have different opinions about this paper, and since Rod's here, he's free to express them. But to be fair, I'm also free to pass any difficult questions to Rod. So we're talking about central counterparty default auctions. And I don't want to explain what central counterparties are too much. Hopefully some of you know. But why are we sort of interested in this topic? The first reason is that at least some of the central counterparties, the large ones, are systemically important. So these are important institutions. Secondly, when they have default auctions, which thankfully, since that's sort of my day job, hopefully to keep those from happening, they can be material. Large sizes, we'll get into that. And sort of the core function of central counterparties really is risk management. And the default auction sits at sort of the tail, near the tail end of their risk management, and almost determines how good their risk management turns out to be ex post. So it is a critical sort of step in the risk management process. So that is on one side why we care about this importance. On the second side, why we got into this is there's not much research. So there's obviously a voluminous body of research in auctions. There are, as far as we can find, excepting this paper, 3 papers on central counterparty default auctions. And in particular, in 2020, CP/IOSCO had a report on CCP default auctions, which frankly, if you have a chance to read it, is one of the most academic reports I've seen coming out of CP/IOSCO BCBS. And it does not cite a single academic paper. So it's sort of a weird consequence. So it's not to say there's not lots of writing about CCP default auctions, mainly by CCPs. And there's lots of discussion, lots of ink, lots of sort of throwing spaghetti against the wall, seeing what sticks in their rule books about what they're trying to do, and so on and so forth. And some of it's a little bit weird if you look at it and have any sense of auctions. You know, lots of discussion of punishing people for not bidding well, which as far as I can tell, Sotheby's doesn't do. So it's a little bit of an unusual circumstance. So talking to Rod and my co-authors, started getting into the auction theory. And I think there's an explanation, and this, again, motivation for our paper, an explanation for why we have these really important auctions. We have this really important and very successful literature dealing with auctions, and we have very little intersect between the two of them. And that's because there really is a disconnect between standard auction theory and the types of auctions we're doing. You can pick up any of the standard texts on auction theory. You'll quickly find the standard model that gives you all sorts of nice results, equivalency between first and second price auctions and all these things. And it's true, a lot of auction research it generally starts with that standard model and needs to tweak it somewhat to get to something that actually applies to the particular real-world auction they're dealing with. But when I looked at it a number of years ago, I was struck by the thought that I didn't think any of the assumptions, any of the standard assumptions matched the CCP auction. So this presents sort of a novel challenge that, the structure, the institutional details of the auctions don't seem to match up with the standard model. And so what do we do at that point of view? And so part of the motivation for this paper was whether we could start bridging that sort of chasm between the theory and the practice. So our contributions. We're going to try to develop a simple, because we need tractability, a simple model of a derivatives market. you'll see it only has one good, so it's simplifying things a great deal. We're going to try to include clearing members being risk averse, which seems an important part. We are going to explicitly include information leakage. For those of you wondering what information leakage is, it is the term of art used to not talk about front-running a market, because front-running a market is illegal. But it basically means that the idea that there's information in the auction that might actually affect valuations in the actual traded market in a way that's negative to the outcome of the auction. So that there's some sort of information accrued by being in the auction that has a negative effect on the value of the thing you're auctioning. Again, which sounds a lot like front-running a market, but that's illegal, so we're not saying that. I got chastised at the Chicago Fed for using the other term at one point. And to be clear, information leakage is given a good bit of ink in the CPMI OSCO report. This is an ongoing concern. We are going to try with that to maintain a reasonable information structure. It's very easy, as simplified as we've gotten, to give the CCP as the auctioneer so much information that the problem becomes trivial. So we're going to try to think well about who knows what and when. And we're going to have an accurate CCP objective. What is the CCP trying to do in the auction? And I'll come back to that. And we're trying to then we're going to have an auction participation decision. We're going to try to have that endogenous so that the people, the clearing members or whoever, chooses whether or not to join the auction based on whether that's in their best interest. Now the results. So there's going to be a participation folk theorem that's broken. For those of you who know auction theory, for all the structure of the theory and so forth, it's usually the case that the best thing you can do to make sure you do better in your auction is invite more people. That's almost a universal truth. That goes away. We're intentionally sort of breaking that. We're going to lose the equivalence between the reserve price and the entry fee, which is another standard result from the standard model. Nevertheless, we're going to prove the optimality of an a priori entry fee mechanism for getting our auction participation decision to come out well. That's sort of the main result of the paper. And that enables us to end up having self-selection of participants without special knowledge or CCP judgment. So hopefully all that will become clear as we do it. The most important parts are really the explicit information leakage, the accurate objective, the auction participation decision, and then that proven optimality. Now, as I said before, let me give a few examples. The auctions sort of are an important part of CCP's risk management. So we're all familiar with Lehman defaulting. When Lehman defaulted, LCH held an auction of $9 trillion worth of interest rates, which is more money than I carry in my digital wallet. CME auctioned off its portfolio here in the US. The margin alone on that portfolio, not the value of the actual portfolio, but the margin held was $4 billion. So again, fairly substantial amount. In 2018, one of the motivations for actually doing this, there was a failure at NASDAQ Nordic where in the auction of the portfolio, it led to a loss of $114 million over the defaulter's resources. That used up the CCB's own capital and sort of dug into mutualized resources. In 2018, the chief risk officer of NASDAQ Nordic sat next to me on a stage in Chicago and lied through his teeth to everybody, because as it turned out, a year later it was found out that they didn't actually successfully auction the portfolio. They had held onto it against their rules, and a year later they were fined by their regulator for not actually auctioning the portfolio. And a lot of discussion, a lot of ink. This caused a big reputational damage to NASDAQ Nordic at the time. So again, that's trying to establish these things are important. Now, when I said there's a disconnect, I'm going to get into the bigger disconnect. We do have, there is an empirical literature on CCP auctions. Fortunately, there's not many empirical literature on auctions in general. Fortunately, we don't have too many actual CCP default auctions, so we don't want to get there. So we don't have much information to do anything empirical. It's a good thing, but it makes it harder for the research. And I said before, a lot of papers relax the standard assumptions, but not sort of essentially or wholesale. So here's the big disconnect. I looked at a bunch of auction papers, and while they relax various assumptions, they all start on the basis that the auctioneer is a revenue maximizer. you're selling a painting, you want to get the highest price you can for the painting. CCPs aren't revenue maximizers. At the very least, there's a big range of outcomes where they make no money. They're not trying to make money, they're trying to avoid sort of the tail loss that could come about from auctioning this. So that's sort of the fundamental breakdown. They're not a risk-neutral revenue maximizer, and as much as things change in the auction theory, as much as people adjust assumptions, the first assumption is a revenue maximizer, almost always risk-neutral, maybe not always risk-neutral. That doesn't really apply. And we're not going to try to break every single assumption in the standard model, but we just start with sort of assumption number one, and that causes issues. So the big thing with the CCP is that if the difference between the valuation of the portfolio, let's say they sell it and actually make money, all that money goes back to the defaulter's estate. The CCP doesn't get any. The defaulters provided certain resources. If they take a price where they lose money and it's covered by the defaulter's resources, they don't get any money, but they don't lose any money. They give the remainder back to it's only when they get past that that they start facing a loss on the portfolio, and they want to avoid that. Additionally, if they take a large loss, if they go past the defaulter's resources, that calls into question how well they were risk managing in the first place. So they face implicitly or even explicitly a reputational cost going past that. So the basic idea is that the CCP minimizes its expected losses, but that isn't actually equivalent to maximizing revenue, but that there's a whole set of auctions that they're indifferent to. So give an illustration. Let's say they have $1 million in resources from the defaulter. Our argument would be that if you gave them a choice between an auction where they only lost $500,000, but with 1% probability they would lose $1,001, they would have a $1 loss, versus one where they lost $900,000 with certainty, but we're only going to lose $900,000, they would actually prefer the one where they would lose $900,000 because they know they face no chance of actually losing a dollar, because their revenue is actually equivalent in those two cases. If they lose 500,000, 900,000, they have $1 million, it doesn't matter to them. If they lose $1,000,001, they've started losing money and they've started having reputational costs. The second incompatibility, as I said before, the Folk theorem is that expected revenue generally increases with the number of participants. Now that result is produced by arguably some unreasonable standard assumptions. Someone like Pinskin relax that. But if you are forced to, like I am, read a lot of the discussion around CCP default auctions and planning and so forth, they often talk a great deal about what participants to include in the auction. That's in the CPMI OSCO report. There's a variety of reasons for why you might not want to invite everybody, like transaction costs, evaluating the portfolio. But information leakage has been raised as a concern, and we want to take that seriously. And if you look at the limited data I did before, when LCH auctioned off trillions of dollars of Lehman's portfolio, they only had 6 participants, a small number. And NASDAQ Nordic, their auction only included 4. And then, of course, because it didn't work well, it was all criticized for why only 4. And matter of fact, people also raised why those 4, because in that case, the CCP actually chose 4 people. They exercised judgment. That's the thing we're trying to see, is can the CCP do something where they don't have to exercise judgment? So even if it fails, they can say, well, we didn't pick the people who participated, and therefore we're not quite as subject to that criticism. Like I said, there's 3 other papers in the literature, but those 3 papers don't tackle the CCP's objective or the sort of endogenous participation. One of them talks about participation, but the CCP sort of has full information and picks the right people to participate, so it gets around the problem. Others, the first one, the one published by colleagues of the Bank of England, is closer to ours, but they have sort of a fixed number of participants, so they're not looking at the same type of questions. So a little bit of details on central counterparties. They basically collect resources. They generally collect variation margin and initial margin. Variation margin is designed to cover moves that have already happened in the portfolio. And then variation margin, initial margin is designed to protect against further moves that could happen if there's a default. So the way default happens is there's not a variation margin payment. So I've now used the word payment Elena, right? That's where I could fit it in. So basically, they have, the portfolio moves yesterday. You collect variation margin to cover up the exposure you've gotten from that. If it's not paid, then the initial margin is supposed to be enough to continue to cover that move. That's a number that they're calculating from their models over some period of time. So our model looked at a single risk factor. Sort of conceptually, we tried to make it as close as possible to a commodity future or other type of future. We have risk-averse private valuations. So there's a public value, a price. Everyone knows the public price of that good. But everybody has their own private valuation based on their size of holdings. So we're effectively penalizing you, like you get more and more risk-averse the more and more unbalanced you have. So if I have lots of longs and lots of shorts in the derivative, but I'm balanced, I'm not that risk-averse. If I'm really directional one way or the other, then I become more risk-averse. The key thing for informational purposes here, we're assuming both centrally cleared by the central counterparty and non-centrally cleared positions are included in my overall portfolio, so that the CCP doesn't know exactly how risk-averse I am. The central counterparty would know how many positions, would know exactly my cleared positions. So if we only had clear positions, the CCP would know how risk-averse you are. By having both, the CCP doesn't know. I could be really, really directional in my centrally cleared, but maybe I'm actually balanced because I have offsetting positions in the OTCs, in the non-centrally cleared part of things. Or I could actually be even further directional by going up, and the CCP doesn't know that. It's a little bit artificial here, but it sort of is designed to characterize in the real world, just because a CCP knows your clear positions, it doesn't necessarily know everything the firm is doing and what its overall risk aversion might be. The basic idea is, I guess I'm almost tall enough that I could reach up here. I've got the microphone on.
Good job. I was very ready.
So there's a default that happens at T0, and the portfolio falls in value through time. And it first falls through a level that's covered by the margin provided by the defaulter. And I haven't talked about it, but guarantee fund. This is basically all the resources you have from the defaulter. If I sell it, if I am able to get rid of it as a CCP for a price up in there, I take no loss. Then typically CCPs have some of their own capital. We call it skin in the game. It's usually very thin, where the CCP would literally start doing a loss. And then there's an additional portion of the guarantee fund. That's a pooled level of resources. So you've already used up the defaulter's contributions to it, but now you have everybody else's pooled resources there. Effectively, once you're down into the G minus GD level, other participants in the central counterparty, other clearing members, are actually taking a loss due to the price that comes out. And so we're going to basically say, if the auction occurs and you're up in the margin plus guarantee fund of the defaulter, you're happy as a CCP. You've had a successful auction. As soon as you go down past that, you start becoming unhappy, because not only are you facing a relatively small, but some losses yourself, your other clearing members are starting to take losses, and they're going to be really unhappy, and your reputation is going to be hurt. And obviously, the further and further it goes, it's possible you could actually even exhaust those resources, and so on. So we basically have a profit or loss on the defaulter's position. We have the CCP's realized profit or loss. As I've said before, there's no real value. The issue is if you're in the range and sort of the right, you're going to get zero, regardless of how good the price is, because you're taking the minimum of that piece. The P, you would be in the profit side, the first term in there, only if that P is negative, so you're basically taking a loss. So there's no real value of a better and better price. There's only a disutility of a lower and lower price. So as I said before, a clearing member has this risk aversion based on their size, and we can set up that there's if the clearing member looks, it says, if I add another position to my current portfolio, I'm going to be indifferent to it if the new value, which is the first term in the top equation, minus how much I bid, equals my old risk aversion. So I can basically equate that. This means that there's a rational bid threshold where if I could get the price for this, I would bid up to this level to get the portfolio. I know I'm going through that part fast, but the key thing here, we assume, and it doesn't really matter, that the value is being driven by some random normal variable. It could be fat-tailed, it could be anything you want. We just need to have some variation going on. It doesn't really affect anything. The key thing we have is that the more bidders that enter into the auction, the worse the auction will do, the worse the value becomes because of this information leakage. So that's the second thing in here, the gamma times n-1 raised to the power of q. Now we've used this as a very specific form of the information leakage. I don't really think the form matters so much. The key thing is that the information leakage gets worse and worse the more participants that come in. If Q could be 1, so I could drop out. The key thing is we have some number that is getting worse as more and more people come in. So the issue now is you have a private valuation. You come into if you enter into the auction, you would then look around and say, wait, there's a whole lot of you guys here in this auction. And that immediately starts lowering my value because I'm now going to assess that there's going to be a bunch of information leakage, which is actually going to affect the market. So even though I know my current valuation based on current market price and my position, I'm actually lowering that valuation because we let in everybody. And that's going to be a bad thing. So the bottom thing is within bidders, you get this discounted value that goes on, where you have this discount from the information leakage. That enables us to get a maximum value of bidding. We can sort of set the one term to 0. What's interesting about this, we started out with a common value, but then we had private valuations because of my own positions that matter. But because of how many people participate in the auction, it actually affects the overall value. Our valuations have just become affiliated. So even though we have private evaluations, they're actually privately affiliated because of this interaction in the auction itself. So here's where we're going to really change from auction theory. We're going to set up a CCP objective is simply to maximize the probability of receiving a bid such that the losses are covered by the defaulter's losses. So we're trying, rather than having a revenue, we're just saying, what I care about is maximizing the odds that I don't face any sort of loss going on. I'm in that MD plus GD section of the thing. So we've now, that objective with the information leakage, which gets worse the more people we get in, we now actually have 2 competing pressures for the CCP to balance. More bidders increases the odds that somebody comes into this auction and has a valuation good enough that they would bid a price such that the auction succeeds. The problem is everybody's price is going down the more and more people I let in. So I have this other, that the more and more bidders I let in, the worse and worse everybody's prices are going to happen. So the less likely anybody has a price that's good enough to bid for the auction. So I got to try to balance these 2 competing forces. The one is the standard, let everybody in. The other is sort of this, wait a minute, if I let everybody in, it's not good for the actual value of the portfolio and the outcome of my auction. So the question we're trying to answer is, can CCPs get sort of the right participants in without knowing who they are? Or alternatively, can they get the wrong participants to not come in? So effectively, if you think about it, let's assume that this room is ordered where the people who value the portfolio most are sitting in the front of the room and those in the back value it less. I want to have a mechanism that says the first 2 tables come in. Obviously, if I knew this order, I could use a mechanism. The first 2 tables come in, or better yet, if it's really ordered, just Rod comes in. He's the guy who has the highest valuation. I just let Rod in, and I'm perfectly happy because there's no impact of this. But obviously, we don't know that sorting. That's the thing we're trying to keep from happening. So we want a mechanism such that when I announce this auction, you guys all stand up and move to the right table. The people who value it a lot come to the front. The people who value it in the little go to the back, and then we split it up. That's what we're trying to get to happen. So, that probability is basically the equation on here. We do a second price auction because that's sort of helpful in the theory here. The one variable that's not haven't defined is the K is a random variable depending on how many bidders enter the auction, conditional on an entry fee we set up. That's the mechanism we're going to try to use. Can we put an entry fee that gets people to self-select? And so the entry decision with the fee, the bidder's information, they know the direction to default, but not the magnitude before entry. So we need them to learn something by coming to the auction. We also don't want to act like they have their heads in the sand before the auction. So they know what the market's done. They know what the market went up or down. So they know the person who failed to make a payment, I used it twice, they were losing money based on that market move. So if it went up, they knew they were short. If it went down, they knew they were long. And so they know that already. But they don't know how big it is. So they don't know exactly if I win this auction, what it'll do to my valuations. They also don't know how many other people are going to enter the auction, which will also affect my valuations. So we can basically establish, in the paper, a relationship between entry fee and the S sub 0, which is sort of the threshold entry, and the value SD, which is a function of the cumulative distribution of all the values. And we have a condition that if one or more bidders enter, the auction succeeds as long as certain conditions are satisfied. It basically comes down to the auction succeeds if and only if a high value bidder who has a high willingness to pay enters and also bids. It solves this maximization problem. That first term is really the sort of let everybody in is good. The second term is really letting lots of people in starts costing you. And so intuitively, we want these to be relatively equal. If one's really low and one's high, then the low one's always bonding. So we want them relatively close. We have a few propositions. Basically, if the entry fee is high enough and nobody enters, then it always fails. That's sort of intuitive. We also have, just to be clear, information leakage is bad. For any entry fee, more information leakage makes a lower and lower probability of success. I don't want anyone to think we solve information leakage. Information leakage is a bad thing. But we can prove there exists an optimal entry fee, which could be 0. That's the sort of standard result. We wouldn't want an entry fee that maximizes their objective. We are able to get an analytical solution for the probability of success, which is this nasty-looking math thing here. And I won't try to put you through the derivation. But the key result is that if gamma, which is the marginal cost of information leakage is gamma times n minus 1 raised to q. If it's high enough, going from 0 to a positive entry fee increases the probability of success. So that's basically the idea is we have an existence, but we can't rule out the 0 entry fee. But if gamma is high enough, we can actually get an interior solution that there is a positive entry fee that actually improves the probability of success. And so here's a numerical example. For very small change, we actually take this probability from 50% chance of success up to 80 in an example using Laplacian distributions and an exponential distribution for the defaulter. So it's fat-tailed. And it's single peak going over. That's sort of consistent with the results. We also do an example where we have multiple gammas, and you can see the results here where the curves get lower and lower the higher and higher we get gamma. There's another proposition in the paper, the optimal entry fee increases. Basically, as gamma is higher and higher, that trade-off between letting people in and keeping people out becomes more and more painful. So you want to raise entry fee, you want to keep fewer people, you want to take the chance of not getting the right person in, but make sure you don't get too many people in, so you start moving it more and more. So that's basically the paper. Let me wrap it up with, so I said before, default auctions, not studied very much and really important, and they're really weird. Possibly put this paper out as the strange problem of CCP default auctions, but that is a little untechnical. So we've developed a model where we account, I think, much more accurately for those features. But to do so, we had to really trash standard auction theory. We had to radically remake it. Particularly, we had to get rid of the revenue maximization objective that is standard. We broke the information theorem intentionally by information leakage. We wanted to do that. We're actually able, despite doing such damage to the theory, we're actually able to analytically solve the auction maximization decision with an endogenous entry decision. and show that under certain conditions, a positive entry fee will actually get people to self-select, will get the people to stay out who we don't want to come in, and get incentivize the right people to come in instead. So we're not claiming we've just solved CCP auctions, but we are thinking this is hopefully something that is sort of encourages more research in this area. And the entry fee is novel. It's not been done in CCP auctions. So we think it might be an interesting mechanism that CCPs even in practice should think about. Again, CCPs talk a lot about who they should invite. Should they only invite clearing members, or should they have clearing members and clients? And when they've actually had to do this, they've said, well, we're going to invite you and you and you, and then when it's not worked, they've gotten a lot of grief. This is a mechanism that enables them to say, hey, where's an entry fee? Oh, I'm not having to do judgment. I'm not having to say it can only be clearing members. We could have it posed so clients can come in too, theory of man off the street, I suppose. But this is an effective sort of mechanism with limited information for them to actually improve the odds of them having a successful auction. And that's it.
Okay, thank you, Travis. So this is my discussion. So I should say in advance that I'm not a payments guy, right? There were a frightening number of acronyms and other terms in this paper which I did not understand. So I'm primarily going to be talking about, how does this paper relate to issues that come up in the more standard auction literature? So obviously, as Travis explained, there's going to be some different assumptions which are tailored for the setting that Travis and Rod and the co-authors have in mind. What I want to stress is that I would actually say there are some ideas in the standard auction literature that I think would be worth, thinking about, understanding where they could suggest some alternative kind of mechanisms that might be used, which at the very least you could compare with the entry fee kind of approach. So the particular assumptions that are critical here, and this was obviously consistent with what Travis explained, is, the one I would really highlight is the value is going to decline in the number of people who end up entering the auction. Emphasis is also given to the idea that the seller has a non-standard objective function, so is more worried about the downside. So I can understand the motivation for that. I guess I would temper it a bit by thinking, in the long run, obviously, the clearinghouse is setting kind of a wide range of fees that it has to collect from time to time, and that if defaults are unfortunately not too uncommon, we could think, actually, designing this market, you would want something closer to revenue maximization as the objective. Okay. So, the setting is well motivated. I learned, a huge amount that I didn't know that maybe should know. The pre-announced fee, I'm going to, in some ways, criticize it a bit, just taking other ideas from the literature, but I do think it does make some sense as a very straightforward way to dealing with the problem that the paper lays out, right? So think of my criticisms or the issues I'm going to raise as being a little bit more theoretical, but ones that may well not be the key ones that an auction designer would think about in practice. So really what I'm trying to do is, as I said, place it more within the literature. Okay, so what is the standard, selling a painting, selling some timber literature kind of say? So it's true there's this idea that all else equal, encouraging participation is good, right? The Wilson doctrine that people talk about, kind of says that. But that does not mean that people believe that just having what I'm going to call free and simultaneous entry, so everyone simultaneously decides that they're going to enter the auction, is optimal. And it's not optimal for a couple of different reasons. So one of them is, even if you are a revenue maximizing seller, right, you have market power. There's only one of you, there's only one good being sold, these people want it. The question is, how do I exploit my market power? Now, under some assumptions, yes, it could be true that you wouldn't want to use an entry fee, but as a general matter, if people are taking an entry decision and then bidding, the optimal thing to be doing is going to be using a tool that looks at the entry decision to extract revenue and a tool that affects, the prices that can exist post-entry. Okay, so there are papers that lay out the fact that entry fees can be optimal, particularly when you have heterogeneous bidders. Okay, obviously there's also the common values literature that knows you get more, the more entrants, the winner's curse is exacerbated, you may bid less. That's not the mechanism here. It's private values and we have information leakage. But there's obviously something in that literature where, yes, they want to be controlling of entry. But even then, even adopting revenue maximizing seller, symmetric bidders, entry fees might not be optimal. There's this additional problem the literature thinks about, which is simultaneous entry is simply too uncoordinated, right? So if we don't know each other's values, we're entering, we're going to have some threshold in our perceived own value, but we're not coordinating. So from the seller's point of view, there's too big a risk of having, sometimes too many, sometimes too few bidders, and the social planner would be having a more coordinated entry process, right? So there are things in the literature, one reason why the Levine-Smith paper is going to say expected revenues go down in the number of potential entrants is because everyone's using mixed strategies. Mixed strategies are really bad for coordination, okay? So this leads to this literature thinking about other mechanisms, so I want to mention two, right? So one of them is to auction the right to entry, right? So to say we're only going to have 2 entrants or 3 entrants, and we're going to auction that right based on the information that you have before, say, you look at the books of the firm that is defaulting. That structure, it's been shown in empirical setting by my work with Vivek and Bhattacharya and Jimmy Roberts, but also theoretically, that can raise the seller's expected revenues. It can also raise efficiency, right? So what I would say is there is a literature that thinks about what's the efficient mechanism as well as the seller optimal mechanism. And because in this literature, what's typically the true is the seller is only going to choose 2 bidders, that's pretty good in the setting you're thinking about, okay? And what's good is with the fee, once again, you can't react to any information the bidders have. It's been said in advance. It might sometimes be too high, too low. At least with the auctioning the right, things can be more sensitive to information. And then the second one is to go for a more sequential structure where there's sequential entry and bidding. So you invite someone in, they can place a standing bid, then you go to the next person and say, do you want to match it? Or do you want to try and beat it? They can choose to come in, and then you're going to have a knockout before it goes to the third person. Okay, so and once again, with work with Jimmy Roberts, there is a result in the Boulan-Klemperer that says this is not what you want to do, right? That this is bad. But in fact, once you let bidders have some information about their values before they decide to enter, that flips over, right? And actually, sequential entry and bidding can be more significantly more efficient and seller revenue maximizing. Once again, you get less entry and less dispersion in the number of entrants, so you get coordination. Okay. So what are my just final suggestions? I do believe under the assumptions entry fees being optimal makes a lot of sense. I think in some ways you could reduce the number of assumptions. I don't think you need anything about the structure of the information leakage. You just need it to be there to generate that. I think some generalizing, could be possible. What I would like to see is some comparisons with things like entry rights in 2 possible dimensions. So one of them could just be saying, no one would do this in a real world default auction where time is of the essence. I'm not going to deny that. But maybe even as a matter of contributing to the auction literature more generally, you could do a comparison of, are there assumptions under which a simple entry fee really is optimal, whereas, there's, sometimes maybe a sequential bidding and entry model could be ideal, right? But I think if you generalized it, you'd be making a contribution to the auction literature as well as, obviously, this important real-world policy setting. Okay, thank you.
We have some time for some questions. I don't know, Travis, if you want to start by responding, or if you'd like to take questions directly.
Let me respond really quickly. We possibly oversell that we don't mean to imply that we have the optimal setup for entry. We were trying to figure out how to improve it, and we were, given the damage we were doing to sort of the objective or the novelty of the objective we were introducing, we were actually quite pleased and surprised to get a constructive result at all. So I appreciate Andrew's suggestions. We have not explored, we did not mean to suggest that this mechanism is absolutely the best mechanism that could be produced, and the suggestions are really helpful. We do think this is potentially a structure that we can start exploring more and more questions, and while not sure whether we would do those in this paper, I think there's like very helpful suggestions for, like, papers two through whatever. Really appreciate that. Any other questions?
I just had a question about information leakage. There's a little bit of a feeling that I felt a little bit hard-coded in with, like, one kind of NQ thing. And I was kind of wondering, like, what the kind of practical concern is of information leakage, and, like, what could be a micro foundation for that functional form.
Yeah. So the key intuition between why it's very much right. We were sort of changing the objective function in a fairly general way. We were very specific about the information leakage. We picked what we thought was a pretty flexible functional form, but what is really key about it is that sort of monotonic in how many people actually enter. It becomes, and that's partly for tractability. We were looking at the discussions. There's lots of discussions on this. Nobody has any particular estimated form for this. And in some ways, you might think of it in terms of sort of an expected value, that the expected cost of information leakage is just going up, where really it may not be that most people would do anything, but there's like one bad actor, and so I just want to keep the odds of the bad actor getting in from coming in. But you shouldn't put too much into the actual numbers of the simulation, because that is very much a hard-coded. I think we could pretty much do anything in the structure we have. It would work as long as more people coming in works out to be a bad thing, and that just seems to be the way people have operated in the actual real world too.
I just was asking for some intuition of, like, suppose I show up at the auction, why am I scared that there's 5 other people in the room?
Yeah. So the basic idea is that once everyone knows, from the idea, you come in the auction, you now actually know what the portfolio really is. And so therefore you know that somebody is about to win this large portfolio potentially. And what are they going to do? It's possibly this is a transaction, they're going to go out and sell it. And so you might go out and start trading ahead of that position. That's the illegal front running, but that's the sort of intuition that you are going to start adjusting your value. By the time you execute the auction, you receive the portfolio and go try to sell it yourself because you've now moved your risk aversion, somebody else is going to be out there going, I know he's selling it, so I'm positioning myself ahead of that, and you're going to not actually have as good a value. So you're sort of just worried about that type of interaction. It's basically, in some sense, a whole bunch of, the more people know what's about to hit the market, the worse the market might perform for that particular portfolio. Is that helpful?
We should probably move to Rod's paper.
All right. Thank you very much.
Great. Well, so first of all, the disclaimer. So the views are mine and not necessarily those of the BIS. Thanks also to the organizers for inviting me. And I think they made a good choice making this the last paper, because this isn't a very complicated paper. In fact, what I'm going to present is not so much of a result as it is just an observation we made. And it's an observation that depends on a bunch of assumptions, which I'll go through. And then if you buy the assumptions, then it allows us to think about how the volatility in cryptocurrency prices is quite different from the types of volatility we see in regular financial markets. Let me also say that this is joint with Martin van Oort from Vrije University in Amsterdam. Okay, so let me just start off with sort of the motivation, which is in terms of thinking about overall high levels of volatility in cryptocurrency markets versus, in this case, a comparison to the volatility we see in exchange rates of conventional fiat currencies. This can be represented in many ways. Let me just explain how we're doing it here because I use this measurement, this way of measuring volatility later in the analysis. So the idea is that we take say a 90-day rolling window and look at the cryptocurrency prices, and then we look at the standard deviation of those prices, and then we measure that standard deviation in terms of a percentage deviation from the mean. So this gives us a measurement that's in units of percent. And so what we see is that we get high levels of volatility between 2 and 10% for cryptocurrencies. But of course, if we look at the same measurement for the volatility of fiat currencies, these are rarely above 1, if ever. So high volatility in these markets. So there's a literature that tries to explain this volatility and characterize it. So first of all, there's a large empirical literature that started with a paper by Yermak in 2015, which explains the volatility and how it's different and whether or not it's correlated with other financial assets. And then there's a theoretical literature that looks at this and tries to think about why are Bitcoin prices, why are other cryptocurrency prices so volatile, how can we predict these prices? I'm going to just talk a little bit about my own paper on this, a paper I wrote with Neil Wallace. And what this does is it explains volatility in terms of indeterminacy. So what my paper with Neil does is it builds off of Carrican and Wallace. Many people are familiar with that paper. This is the paper on the indeterminacy of equilibrium exchange rates that basically points out that if you have a money and it's valueless and you can't counterfeit it, then its price is going to be somewhat indeterminate. It's going to depend on rational expectations equilibria. And what we show in this paper is that if you add additional monies that are perfect substitutes, so the title of this paper is actually Bitcoin 1, Bitcoin 2, Bitcoin 3, then that indeterminacy just becomes much greater. Because at any point in time, you can move off of one rational expectations equilibrium that's directed towards one equilibria, one cryptocurrency, and move towards another. So we get these high degrees of volatility. But what this doesn't do is it doesn't explain the mechanism behind the volatility, particularly if you're staying on one particular equilibrium path, that is if you're focusing on a price which is based on a particular rational expectations equilibria. So what this paper does is it tries to understand a mechanism by which we can think, or give a mechanism by which we can think about the volatility of cryptocurrencies. And so we introduced something which we call the crypto multiplier. And so this is going to measure the response of cryptocurrencies market capitalization to the aggregate inflows and outflows of investor funds. So one thing I want to clarify is that this isn't about this is about a change in the composition of the holdings. So it's going from people who are holding Bitcoin as users for transactions purposes and speculators who hold it as a store of value or for an investment purpose. And what happens when we change that composition? So there's a literature in traditional finance that looks at this. There's a paper by Antti Petajisto, which is called Why Do Demand Curves for Stocks Slope Downwards? And this paper, it does sort of a similar thing in terms of it has two classes of investors that have different elasticities of demand, and it looks at what happens to stock prices when the composition of those two investor groups changes in the marketplace. So that's similar to the type of analysis we're doing here. We're thinking about what happens if more Bitcoin, say, is held by speculators and less is held by people that are holding Bitcoin for transactional purposes. Okay. And then the one point that I want to make, or last point I want to make before I get on to talking about what we actually do in terms of developing this observation, is just make this obvious point that, we often talk about market cap of Bitcoin, and this is just a terminology that we took from traditional finance, but it's not market cap in a conventional sense. There's no sense in which, the price of Bitcoin times the number of Bitcoin shares represent future earning power of the Bitcoin enterprise. And so in fact, when when we think about what happens when there are, in some sense, shocks to the market, and I'll explain what I mean by that, the price changes are very, very different in nature, driven by a completely different dynamic, and that's what we're going to explain. Okay, so I'm going to start off, I'm going to derive a tractable formula for a crypto multiplier, and it's based on the Irving Fisher's quantity equation and a few simple assumptions, and it's going to take on higher values if a smaller share of cryptocurrency is used for payments. So this is the lesson that I think a lot of people are starting to recognize, that cryptocurrencies that are held almost entirely by speculators or investors tend to be more volatile. So we're going to also provide some empirical support for that idea. So we're going to look at just exactly that. We're going to look at how the volatility of cryptocurrencies relates to the share of the coin that's held by investors instead of by people that are using it for transactions purposes. And then I'm going to actually relax one of the key assumptions and give you some idea under which circumstances we expect that crypto multiplier to be greater than 1. And the sneak preview is that typically it is. Okay, so I'm going to now go through the assumptions. So the first assumption is that the cryptocurrency is not used as a unit of account. All right, so in other words, the prices of cryptocurrency are perfectly flexible with respect to changes in the exchange rate and the price denominated in dollars. So if you just look at the equation on the bottom, P would be the Bitcoin price. This is going to just depend on the dollar price and the exchange rate. All right, and if you think about it, that's how Bitcoin purchases are usually done. So if you want to buy a Bitcoin, buy something and you want to pay with Bitcoin, generally speaking, you'll go to a website. The website will show you a dollar price for the good, and it'll give you an option to pay in Bitcoin. And then when you go ahead and, if you go ahead and pay in Bitcoin, the amount of Bitcoin that you actually need is just calculated. You give that Bitcoin, and then that Bitcoin is usually transferred into dollars, and dollars are given to the retailer. So the unit of account is still the dollar price, okay? And so in fact, just going back to this equation, think about a situation where a car costs $60,000 and the exchange rate is $30,000. So Bitcoin's worth $30,000, roughly where it is today. It's a little bit higher. Then the cost is going to be 2 Bitcoin, all right? If the exchange rate falls to $20,000, the cost is going to be 3 Bitcoin. Okay, there's just an automatic adjustment in terms of what the price is. So the price in terms of Bitcoin is determined entirely and automatically by the dollar price and by the dollar exchange rate. Okay, the second assumption is just that the cryptocurrency must be used as a means of payment, because ultimately the way we're deriving the value here is in terms of its use as a medium of exchange in the economy. So we need there to be some velocity. And then we can apply the standard Fisher equation. So PT equals M times V. So this is expressed in terms of Bitcoin for now. So P is the price, how many Bitcoins were paid on average. T is the transaction volume, okay, how many goods and services were paid for with Bitcoin. M is the money, how many Bitcoins actually exist. And then we have the velocity. So the velocity is what's the average, how many times was the average Bitcoin used to make a payment for goods and services. So we start off with this basic quantity equation, right? Value of goods and services measured in Bitcoin has to equal how many Bitcoins change hands for payments. So then we recognize the following thing, which is that, as I've been saying in my lead up, not all Bitcoins are actually being used for transactions purposes. A lot of Bitcoins are just being held for the purposes of speculation by people that hold them in hopes that Bitcoin goes up in value. And the velocity of those coins is of course, not the same as the velocity of coins that are being used for transactions. And in fact, this idea is not new. This is in Irving Fisher's original paper. All right, he allows for the idea that different money in different accounts can have different velocities. So this idea isn't new. But in this case, we're thinking about one of the velocities being 0. So all we're doing here is we're saying, let's take M times V, and let's break down it into 2 categories. So Z is going to be the category of Bitcoins that are held purely for speculation. And M minus Z is the quantity of Bitcoin that's being used for transactions purposes. And so we'll let V star be that velocity on the currency that's actually being used for transactions, and we'll let 0 be the velocity on Bitcoins that are just being held as a store of value or for speculative purposes. All right, so that's the new left-hand side of the equation. And then we have a change to the right-hand side of the equation. We're going to do this just through a simple transformation. So we're just going to multiply and divide by P star. The reason we're going to do this is because of assumption 1, the idea that Bitcoin is not used as a unit of account means that we don't have to worry about P and P star independently. Okay, we can actually lump those two together and just think in terms of the single variable, which is the Bitcoin exchange rate. So P over P star is just 1 over the Bitcoin exchange rate. And then just for notational simplicity, I'm just going to call P dollar times T. So that's the dollar price times the transactions in Bitcoin is the dollar value of Bitcoin transactions. That's T times dollars. Okay? And so then we get a nice simple expression whereby we can write the Bitcoin price, the price of Bitcoin in dollars, in terms of a ratio where the numerator is the dollar value of Bitcoin used to make payments. So T star is the dollar value of transactions divided by V. That gives you the dollar value that's actually used to make payments. And that's divided by the number of Bitcoins that are available to make payments. Okay. So now we'll go to the next two assumptions. The next assumption is that the total number of cryptocurrency units is non-responsive to market conditions. All right, well, that's true, right? Because Bitcoin, the M, it's not constant, but it's not determined by market conditions. It follows a protocol. There is a small sense in which it depends on market conditions because Bitcoins are introduced when blocks are mined. And the amount of mining power depends in part on the price of Bitcoin. So when the price of Bitcoin goes up, more miners may enter and Bitcoin blocks may be produced faster, but as most people know who study this, the protocol adjusts in that case. So if people start mining, if too many miners enter the market and Bitcoin gets produced too quickly, the protocol adjusts to make mining harder. And so on average, it grows pretty much the way it's supposed to. Okay, so the protocol is specifically designed to make it non-responsive to market conditions. So there's really no problem with assumption 3. That's just showing the growth of Bitcoins over time. And then assumption 4 is that a change in the number of coins that are held as a store of value will not affect the transactional demand for cryptocurrency. So how much you want to spend using Bitcoin doesn't depend on how many people are holding Bitcoin for investment purposes. Right? One can actually tell stories that why that might or might not be true, and in fact, that's an assumption that I'll relax at the end of the paper. Okay? Show what implications it has for the crypto multiplier. Okay. So with those assumptions in our pocket for the moment, then we have this really simple expression, again, that we derive from this original quantity equation, where we have an exchange rate, and the only variable in this is Z, is the share of Bitcoin that's held by people who are holding it as a store of value or people that are holding it for speculative purposes. So we can take the derivative of that. So we're going to look at the change in that exchange rate with respect to Z. That's not quite what we want because, as I said, we're going to look at how market cap changes when we have more dollars put into Bitcoin by investors. So we just do a simple transformation. We just multiply by M, divide by the exchange rate, and that's it. That's the crypto multiplier. So again, this is telling you the change in market cap, the exchange rate S dollar per coin times the number of coins. As we get an increase, one more dollar invested into speculative holdings, and it's just this simple expression, M over M minus Z. So this is the observation. Okay, and this is what we're calling the crypto multiplier. So if you buy those 4 assumptions, then you have a very, very simple way to think about how the market cap of Bitcoin changes when you get a change in the composition of Bitcoin holdings, a shift from users to investors or from investors to users. Okay, so that's the observation. And then, of course, the next question is, this is pretty simple. The assumptions may or may not hold. Let's start to think about whether or not we can test this empirically. So first of all, we wanted to think about, is this even an important issue? Are cryptocurrencies being used for transactions, or are they being held for investment purposes? In fact, this has come up in a number of talks yesterday. But our first thing to just point out is that if you just look at the share of inactive coins, right? If you look at, this is what the chart on the left is showing, and then the chart on the right is just doing it by aggregating more coins. But the chart on the left, focus on that. That's looking at Bitcoin and Ethereum. And it just shows you the share of coins that are in wallets that have remained, where nothing has moved in 180 days. So the idea is that if money is sitting there and it never moves, then this is at least a floor on what share of money we think is held for investment purposes. If money moves, we don't really know it's being used for payments. There's lots of other reasons to move money around in the crypto world, but this is at least a reasonable way to think about what a floor would be. Okay. So then we decided to do an analysis. We were going to look at testing this idea of what would be predicted by this idea of a crypto multiplier. And if it's true that a large speculative holding corresponds to a large multiplier, then as we look across different cryptocurrencies, as we expect to see movements in and out, various shocks that lead to more investors entering the market or investors leaving the market, then we should expect bigger price swings in the coins where the multiplier is larger, that is in coins that are held by, where the share of coins held by speculators or by investors is larger. So our first approach at looking at this was to look at the following two proxies for speculative share. So one is that is the share of coins held by, they're held not for transactions purposes, but they're held for investment purposes. So on the left, we look at a number of well-known cryptocurrencies, Bitcoin, Bitcoin Cash, Dash, Ethereum, Dogecoin, XRP, Litecoin. They all have different, and what we use as a proxy for the share of coins that are held by investors is the share of value in addresses holding more than 0.1% of the total currency. And we plot here the positive relationship. So this is just an imperfect proxy. See, again, remember that I should have said this first. There's no way to identify what share of coins are held by people for investment purposes or for speculative purposes. So we have to look for proxies that we think might be correlated. This is one attempt. Another attempt is the share of value in the top 1% of addresses. All right. So all we did here, this was just a preliminary check. This is just two examples. And in fact, these trend lines are not statistically significant. One reason for that would be that the theory isn't true. Another reason for that would be that these are not good proxies for the share of speculative holdings. So we do a more formal regression analysis. So we're going to measure the dependent variable in the analysis is this way of measuring volatility that I talked about at the beginning. Okay. We're going to look at a 180-day window to compute these volatilities. The independent variables are going to be, that we're going to consider are three different proxies for the speculative position. So this is, by the way, this is done with a much larger data set. So we're now going to do this with 23 coins. And we're going to do this using data from 2016 Q1 all the way up to 2023 Q1. And so we're going to run this regression using our volatility measure. And we're going to consider these two measures I just mentioned. And we're going to consider a third measure, which is extracted using principal component analysis. So the idea, of course, this is from Hausman, 2001 paper, the idea is that if you have variables that are not so good proxies for what you're trying to measure, they're not going to be as likely to be significant in a regression. But if you come up with an optimal combination of these variables, you can get a single variable that performs better. So we take the two measures that we already had for speculative holdings, and we add two others. One is the share of coins held in the top 100 addresses. We expect that to be positively correlated. And then the fourth variable is a variable that depends on the number of addresses with positive balances that holds less than 100 USD. So the idea is that people that hold small amounts of Bitcoin could be more likely to use this for transaction or for transaction purposes. Sorry. All right. So that one we expect to be negatively correlated with the share of speculative holdings. So we produce a variable that's based on these four using principal component analysis. We also add some controls. The controls include transactions per second, market capitalization of the coin, and the mean amount per transaction. So when we run this regression, so this is just showing you just the descriptive statistics of the variables we use. But all I'm going to focus on right now is the results. So again, even with the larger data set, when we regress the individual volatility measures I mentioned, the first and the second, we get significant in one case, not quite significant in another. But I think I'll just point to the column on the far right. So this is the regression using the principal component variable and using fixed effects, which I think are appropriate in this case. And you get a significant coefficient of 0.675. Now, what does that mean? Well, if you go back and you look at the variable that ranges, the 10th percentile of the principal component variable ranges from negative 1.8. Remember, the one variable is negatively correlated, up to 1.9. So it's like negative 2 to 2. So that's a span of 4. So if you multiply 4 by 0.675, you get a value of around 2.5. Right, so so in other words, if we move from the lower end of the speculative variable up to the high end, that's an increase in volatility of 2.5 percentage points, not percent, but percentage points. So quite a large increase in the overall volatility. Okay. Again, if you think back to the original diagram I showed you, where according to this metric, the volatilities range from 2 to 10, a change in this variable is explaining a large share of that span of differences in volatility. So what are the implications? The implications of a higher crypto multiplier is that, well, one thing, we should be pretty cautious when evaluating the value of a large block of holdings to cryptocurrency. So the liquidation may be substantially below the prevailing market price. So if someone's posting crypto as collateral, and then you call that, and they have to liquidate that, they're not going to get anything near the value, if it's a large amount, anything near the value of what's posted, in stark contrast to what we would think of in terms of most collateral, which don't have such big swings on price. And in fact, if it's a cryptocurrency that's held largely for speculative purposes, we would expect that swing to be even larger. So just a couple of examples to sort of think about, more casual evidence about whether or not this effect is true. Back in 2014, there was a really interesting episode in the crypto world. So Jed McCaleb he was actually the person that founded Mt. Gox. And then he sold Mt. Gox before the trouble with it started. And then he founded Ripple. And then when he was moving on to other things from Ripple, he decided he was going to sell his holdings of XRP. But before he did it, he wrote this letter where he told the crypto community that, look, I love you all. Before I go ahead and sell this, I want to tell you that this is what I'm going to do. All right? So we're economists. We know what the impact of that is. He might as well have just sold it. So that immediately had a large impact. So the idea is that obviously Jed McCaleb wasn't holding XRP for transactional purposes. And so when he sold it, presumably shares of that are going to go to people that are going to use it for transactions. And so we had a negative shift and we had a drop in the price. And by the way, all this graph is doing is that's, one might think that there was some large drop in the value of cryptocurrencies at the same time. So this is just reproducing the same thing in terms of Bitcoin instead of dollars. Okay. One other thing I should say I wanted to say about this is there was a couple of really interesting high-profile examples. Does anyone remember when Elon Musk said that Dogecoin was his favorite? Was his favorite, might be my fave cryptocurrency. That led to a 50% jump in the price of Dogecoin. Why is that? Is it because we think people are going to start transacting in it more? No, because we think investors are going to flow in and start buying up Dogecoin, reducing the share of people that are holding Dogecoin for transactional purposes. There was a similar effect when Kim Kardashian in 2021 said that she liked Ethereum Max. Okay, and then she ended up getting in trouble with the SEC for this, I believe. Okay, so just to sort of conclude, these were the 4 assumptions. I think assumptions 1 through 3 are pretty easy to defend. I think 4 is the difficult one. So we can talk about what happens if we relax assumption 4. This was the assumption that the number of coins that you hold as a store of value is not affected by a change in the number of coins that are held as a store of value or held for speculative purposes will not affect the transactional demand, how many things you want to buy using cryptocurrency. So this just means that we're going to take the same derivative and we're going to not hold basically T dollar over V star constant. All right, that's that transactional demand. And we simply get to an expression that in order for that to be greater than 1, we need what's on the left to be greater than what's on the right. What's on the right is the fraction of coins held only as a store of value. And what's on the left is this equilibrium impact of an additional dollar of store value demand on transactional demand. And so all we need is that effect to either be positive or not too negative. All right. So just to conclude, we define this thing called the crypto multiplier, which describes the quantitative impact of investor flows on cryptocurrencies market cap. We think it is useful to explain the substantial price movements that we see following announcements by large investors, celebrity endorsements, or even other severe shocks to the financial system. If you think about the fact that cryptocurrencies often surge when we have things like banking crises after SVB, then what you can think there is that this is people flowing into cryptocurrencies for investment purposes. For this reason, we warrant, as I mentioned before, this idea of using caution when evaluating the value of a large block of holdings, especially if it's posted as some kind of collateral that you're expecting someone to liquidate. And just this last point is just that when we think about volatility in crypto markets, when will this volatility subside? We expect this volatility will only subside as the currency becomes used more and more for transactional purposes. All right. Thank you.
All right. Thank you, Elena, for having me. It is beautiful evening, Friday night. I don't want to keep everyone on whole stage, so I will be quick. It is a beautiful paper, very needed, and you may think it is simple, but it is also very basic. So the accounting quantity have to be true. So which I think is the beauty about of this paper. So essentially, it is the one slide for what is happening for this paper. So essentially, it is a quantity theory to explain the crypto pricing. So on the left-hand side will be everything will be in terms of the crypto in the Bitcoin, for example, or other thing. So T will be the transactional volume in terms of the US dollar, but not crypto, and divided by the price of the Bitcoin. So then this means everything on the left-hand side will be the total transaction volume in terms of the Bitcoin, right? And on the right-hand side will be the supplies of the Bitcoin minus some store of value or investment fund, which is not used for transaction, right? So M minus C will be the number of Bitcoin is circulating for transactional purpose, and V will be just the velocity, right? So the typical quantity theory. So if we do some very simple manipulation, then we have the multiplier, right? So I take the differentiation with respect to with C. Then we have the multiplier called in this way. So will be the volatility responding to the with the demand, which is C, will be always greater than 1. Very simple formula, right? So on the right-hand side will be always equal to 1. And Rob mentioned there's some evidence for the multiplier. The regression will suggest, okay, the multiplier may vary from 1.1 to 3.7. That implies the stored value demand or investment fund, and a fraction of it will be vary from 0.09 to 0.73, which is quite in line with the figure, right? So if you see the figure, so it is vary in between 0.09 to 0.73. So this means the multiplier seems to be quite consistent with the actual data of the stored value demand, or at least the non-transactional demand of the cryptocurrency. And these are the evidence, and the regression provide more detail about how to back out the multiplier. That is the idea, right? So how we change the non-transactional demand of the crypto will have the impact on the price of the crypto. And if you look at the quantity theory, it is very simple, right? So if there is a more demand for C, more fund floating to the crypto space, then that means there will be less crypto circulating for transaction, right? So M minus C will be lower when C is higher. Then the price of the crypto have to be higher, right? If you want to support the same amount of the dollar transaction, right? Have to be, right? Otherwise, you cannot have the same dollar circulating, but less crypto is circulating. The price of the crypto have to be increased more than 1. So that is the idea of the crypto multiplier. Super basic, but elegant, right? So have to be true, the quantity theory. So I have 3 comments. The first one is the cheap one, so it's the easiest one. So there are 2 big views of the exchange rate volatility, right? So one extreme will be Caracan wallet indeterminacy. That means anything can happen, right? So the QJE and Rock also have a paper on that extreme. So this paper is another extreme. So everything is determined. So it can be pinned down by the flow of investor or the non-transactional demand. So what will be the world will be look like, right? So the idea of Caracan wallet will be, okay, let's say there are 2 pieces of paper. So today I can call one piece $1, another piece $10. Tomorrow I can call it $20 and $100, right? Then the exchange rate of the two pieces of paper can be anything. That is the source of indeterminacy in principle. And how about in data? So here is the graph. I'm talking about the Q will be the real exchange rate. So even more puzzling than the nominal exchange rate. So the nominal exchange rate will be what is the price of yen in terms of dollar, right? So that is the nominal exchange rate. So what is real exchange rate? The real exchange rate will be the price of a coffee in Japan in terms of the price of coffee in United States, right? So which you take into account the price level, right? So the nominal exchange rate doesn't take into account of the price. So Q is the real exchange rate and of the US. So and the C will be the consumption, change in consumption. So usually the evidence for the Caracan wallet indeterminacy will be say, okay, let's see the history of the United States. So the Bretton Woods period before 1973 and after the Bretton Woods period, right? So you see, during the Bretton Woods, so the real exchange rate is kind of constant. And after the Bretton Woods, we no longer have a gold standard. The exchange rate become crazy, fluctuate. But the fundamental is still the same, right? You see the change in consumption. So it suggests, okay, the exchange rate can be anything, have nothing to do to tie with the fundamental. So in the literature, it also refers to the Musa puzzle, right? So it may suggest there's something else non-fundamental driven the fluctuation of exchange rate, the real one even, right? So if Bitcoin is not unit of account or Japanese yen is not unit of account, then the real exchange rate will be equal to the nominal exchange rate. So everything will go through. So maybe for Rob and also Martin, maybe good to see, okay, which one is more explaining the volatility of the crypto, whether it is the indeterminacy or something fundamental like the stock value or the non-transactional demand. So, and another thing would be what will be the difference with what we already know in the foreign exchange market, right? So, so which is the first comment. Okay, I may not have time to talk about the paper of Chris, and he's not here, so anyway. So another thing will be endogeneity. So far, in order to divide the crypto multiplier, so we have to hold fixed the transactional demand is constant, at least independent. The volatility, the velocity is constant given. And everything can be just take the derivative of C, right? Then we divide the multiplier. So in reality, it's likely endogenous, so as Rob mentioned. So it is not a big deal, so it won't destroy everything. It's just you have to put more terms, which we can do that. So the comparative setting is just not that simple. Rob also showed the formula. But maybe one more subtling point will be, if it could also be driven by some confounder, right? So, and then the confounder will depend on the mechanism you have in mind. Then that means that we may need to look for some instrument when we run the regression, right? Cannot be just so simple, okay, we run a regression on some stock value demand on the volatility. So the, C can be driven by something else, right? And then confounder with the error term, that drive everything. And the mechanism, how endogenous it is, might depend on the detail we want to model. Essentially, so it is the whole literature of monetary theory trying to explain what is the money demand, right? So what is the factor driven it? And there's a whole bunch of the variety, right? So for the quantity theory, so we know from the Leccolini M1J, so there's a long history of the quantity theory, seem to match the data of money for a long history of time and across time and space. It seems the quantity theory is making sense. Then that means that, okay, the monetary theory, the monetary policy will determine the money demand and the transactional demand. Then we need to take into account of it, right? So maybe now the Fed was having a super low interest rate, and then we have a hike. So that could change the transactional demand of crypto, right? And also changing the C as well. So then in this case, the confounder will be the monetary policy. If the Fed reduces the interest rate, it will increase T, but also increase C as well, right? So then we cannot just run the regression simply. So and then there's a big literature about, okay, how the capital account will matter for the foreign exchange, right? For example, for the Gabet and Maggiari QJE paper recently. And that is something interesting because another thing related to, so one evidence will be, okay, we're looking at something look like the stock value demand or non-transactional demand of crypto, which is if we see there's some Bitcoin sitting at some address not moving, then it most likely they are non-transactional, right? So while you are sitting there for a year not doing that. But that may be related to the concentration of ownership. So one paper really nice by Wilcon, which is the management science, will be, so if we have a lot of the concentrated ownership, like the, in this case, that means, okay, there's a lot of share concentrated in someone, right? So the share of concentration is really high. So then what will it mean? So it means, okay, it might be more benefit to do wash trading. So wash trading will be, okay, I am selling my Bitcoin because I own a lot of it to another address, which is also owned by me, to inflate the volume. And then in this case, I can manipulate the Bitcoin, the crypto price as well. So then this means, okay, go through the wash trading, there is a connection between the concentrate ownership and the volatility, right? Then that could also explain the positive slope relationship Rob had mentioned, right? It may be just there are more wash trading along this one. That's why you see more volatility, you see more ownership concentration. That could be possible as well, right? So another thing will be maybe driven by the belief, right? So there is old literature in Harrison Krebs. Let's say, okay, the price of the asset may be driven by the optimism, pessimism. That could also be possible as well. So in the end, so how we write down the transactional demand might depend on the model. Then many things can happen, right? So my last slide will be, okay, what might be the major source of the volatility? So maybe the major source is come from a lot of crypto daily die, right? So and we know that when the price tends to zero, so the volatility explodes, right? Because of how we calculate volatility is the change of price divided by the price itself, right? When the price tends to zero, the volatility will explode, right? And in the data, so actually most of the crypto, they did die, right? So counting for the number of crypto, 90% of them already died. And the median lifetime is just merely longer than 1 year, right? So if we want to explain the volatility of the crypto price, maybe we want to explain why crypto die, right? Why the price tends to zero, no one trading it. Maybe there's the major part of the volatility, right? And that related to a paper I have was about, okay, how we can write down a finite bubble paper and explain, okay, when the crypto will be stopped trading and price tends to zero. But in the quantitative theory, it might be very difficult to explain, okay, why the price can tend to zero, right? If you think about the formula, right, you cannot have the Z go to zero and generate the price go to zero as well, right? So you need something else to make the price of the crypto to tend to zero, right? That's why generating finite bubble is very, very difficult, usually. You need something else to capture it. And that's it. It is beautiful paper, simple, easy to understand, and have a lot of implications. Thank you. Yeah.
We have time for maybe one question for Rod. If anybody, well, there you go, Jamie. Go right ahead.
Thanks. Great paper, Rod. Can you add gold, for example, into that same approach?
Let me think about that. So first, let me just respond a bit to Russell. So thank you for those comments. They're wonderful. Should certainly think about the endogeneity idea. I think that the answer on the third point might be that the V goes to zero in those currencies as well, which gives you the zero price. And then on the indeterminacy issue, I think to the extent that this is a useful observation, it's thinking about a situation where indeterminacy often refers to sort of a shift in equilibrium from, say, one coin to another, where the value of one coin goes to zero. Here we're thinking about a situation where we're still focusing on the same coin, but we're thinking about shifts in market composition of the investors. So not people leaving, new people leaving or entering, but more of a shift, and that's what leads to this sort of high idea of volatility. So let's see. So in terms of thinking of gold, the fact that it has a fundamental value is difficult. But yeah, I guess I don't know. I'll have to think about that. Yeah.
All right, and with that, let's move on to closing remarks.
Good afternoon. Matthew Eichner, Director of the Division of Reserve Bank Operations and Payment System here at the Board of Governors. One thing I've learned during my career is that if you're closing out a conference at 5 o'clock on a Friday afternoon, you ought to do that pretty quickly. So I'm going to I'm going to behave accordingly here. But I want to say I'm just absolutely thrilled that this conference took place here, that you all were able to come together in person. It's been a number of years since we were able to host this, and I'm thrilled that we were able to do it. As you heard from both Governor Waller and Vice Chair Barr, the Fed has had a very, very long-standing interest in analyzing and better understanding, both the traditional payment systems and then some of the newer things, for example, what we've just heard about now. These types of research projects absolutely and directly support the institution's goal of a safe and efficient payment system, and the kind of research that has been talked about here over the last 2 days has really moved us further in that direction. The breadth of topics that are covered in this conference really underscores the range of work that goes on within the payment space. People think of it as an esoteric area. I assure you it isn't. The series of talks we have heard touched from really traditional payment methods that would have been familiar to people a century ago, like cash, to some of the most innovative things, for example, what Rodney and Russell just discussed. I also would emphasize how much I appreciate the international aspect of this conference. Even after the challenges of several years of pandemic, it is clear that the world is connected even more than it was before. And within payments, that cross-border angle has been a topic of really unusual attention lately. And of course, John Cunliffe highlighted that in his remarks yesterday. So I just want to wrap up by really thanking each and every one of you for being here, for presenting your work, for engaging so much over the course of the last 2 days with one another, and for making this conference successful and one that we look forward to occurring again in the future. Before we head for the doors, I want to just make absolutely sure that I mention a number of the teams that have been working not just today and yesterday, but for months now behind the scenes to make all this happen. There's an AV team that makes all of this technology work. Thank you. The nice thing about this new space is you don't see them as much as you used to. You used to see them more, but they're back there, rest assured. We also have the folks who've been out at the desk the last 2 days, some of my colleagues from the Division of Reserve Bank Operations and the Payment System, Kim, Courtney, Ken, and Keisha. And they regularly and creatively addressed all kinds of confusing things that came up that we didn't think about in advance. And of course, I want to thank the organizers, first and foremost, Elena in the back row. And sitting next to her, Karen, who really stepped up in a lot of different ways, including some real-time troubleshooting on various slide issues. So many thanks to all of these people who demonstrate, again, it takes a village to put on a conference. I understand there's some more food back there waiting for you. You can grab as you head for the airport or the train station. So I don't want to stand in your way any longer, but thank you again for being here. Thank you for your contributions and for really making this a really exciting and important 2-day discussion. So safe travels home, and thanks again.